£0.9 billion for Schroders. Certainly that will be in focus and can lift the broader sector around financial services. DAX futures pointing to gains of 0.4%. The CAC count should be mentioned as well, because Hermès came out with a beat, and CAC count futures are pointing to gains as well, Anna.
Tom, let's have a look at some of the individual stocks that could be in focus. We've talked about it a few times. We will continue to do that. We've got the CEO on shortly. Schroders is in focus. Nuveen is buying Schroders for just under £10 billion, creating one of the world's largest active asset managers, of course. Siemens in focus, raising its outlook. Demand for factory automation products, boosting returns. Orders including, of course, for data centres, so that's a focus. And EssilorLuxottica could be an area of movement in the markets as well, riding a boom in demand for AI-powered glasses of all things. Guy.
Let's take a look at this market open. You can fold in Mercedes, you can fold in German industrials, you can fold in what impact high chip prices are having in names like Ericsson and Nokia. So much going on in terms of the corporate activity that we're watching at the moment. But it cancels itself out a little bit. Today we're going to see maybe a little less of that. So we're expecting actually markets to climb reasonably strongly today here in Europe. 6/7 maybe is what we're anticipating. But below the surface again, there's some really interesting corporate activity. We're a bottom-up market. It feels like it's been a top-down market for a long time. Are we starting to see a little shift in that? FTSE 100's up by 0.6%. 600's up by 0.6%. IBEX is up by 0.5%. Took ages to get the CAC count open yesterday. What are we going to see this morning in terms of the activity there? And Germany's got so many single stocks that we need to be focusing on. There's a sector story below that, above that as well. Let's focus on that. Tom, what are you seeing?
Yeah, let's dive into the sectors then. You're seeing a bit of a relief for the tech stocks, actually, on a sector basis. Just getting the latest reading. So tech at the top of the list across your sectors so far. Names like Relex gaining a little over 4%. It is now third best performer across your sectors. So tech up 1% as a sector. Consumer products, so therein lies luxury gaining 1%. Basic resources, after a strong session yesterday, also posting gains so far of 1%. On the downside, just three sectors so far in negative territory, including the safe haven tilt of utilities, down 0.4%, along with real estate and chemicals. Just three sectors in negative territory. Broadly, that positivity is there on a sector-by-sector basis.
Yes, we talked at the top of the last hour about the numbers out of Hermès, and it's been so busy, we haven't mentioned them since, but that is it seems, a positive story for the luxury sector, and so that's pushing that particular sector higher. So Hermès itself is up by 2.9%. I see that Bruno Cucinelli and some of the other names in the luxury space up around 1.5%. So we've had earnings already, and they've been kind of mixed from the sector, but Hermès just underscoring some of the positivity, I guess, this morning. Lots of the German names not open, it seems, yes.
We'll wait for those.
Yes.
They'll be here in a minute. You're getting a rotation away from what has done well, I think, over the recent days. This kind of defensive tilt that we see in the market. Yeah. British American Tobacco, National Grid, beginning to roll. Unilever's in the mix there as well. So the stocks that have done kind of okay recently may be beginning to maybe move off. But on the other hand, just to kind of flip that around, Anheuser-Busch is doing really well this morning. Second best performing points stock, third best, up by 3%. So I don't know. I'm trying to find a line through this, and I guess the corporate news and what we're seeing elsewhere maybe confuses that picture.
Yeah, it does a little bit. Let's get some analysis on these markets this morning. Banu Buwaja joins us, Chief Strategist at UBS Investment Bank. Banu, good morning to you. We spend a lot of our mornings over the last couple of weeks talking about AI and which is the sector that is the market's concern that day, and it seems day in, day out to rotate from one sort of subsector of white-collar jobs to another. Yesterday was real estate. I mean, how are you navigating these waters where the overarching indexes aren't necessarily responding to this story, but underneath the hood, there's quite a lot of volatility?
Yeah, there's a lot of rotation. Many people call it broadening, but there are quite a few different types of trades going on, right? So what you've seen over the last several months is low quality, I'm talking about the US primarily here, low quality companies have significantly outperformed high quality companies. You've seen small caps beginning to outperform large caps, which is interesting because that says that the equity market believes this is early cycle, because they're thinking we're going to get a fiscal boost, we're going to get a monetary boost, economic growth is doing just fine. So the equity market thinks that this is early cycle, which is actually quite interesting because the credit market and the labor market, which are more reliable sort of cycle clocks, they're more relible indicators of where you're in the cycle, they're telling you you're late cycle.
Yeah.
You know, the default rate cycle has come down and it's now just about beginning to pick up. Unemployment has come down, well, just about beginning to pick up. This is late cycle stuff, whereas the equity market's behaving, I think, primarily because of the fiscal boost, behaving like this is early cycle. And I think that rotation from large cap to small cap and high quality companies to low quality companies, I think that should be faded. We should go back towards high quality companies. And I think at this minute, we should be quite careful with small caps, whereas the market actually is going headlong into that.
Is that because you think we are actually further through the cycle? Or you think that actually the cycle isn't, the cyclical story isn't setting the agenda, it's a structural one?
It's a good question. That's two reasons. First, because I think we are further down the cycle, and also because I think while there is some sign of revival, like you saw it in the ISM, you saw it in CapEx orders, you saw it yesterday in the labor market, things are looking just a little bit better. But you're also going to see higher tariff inflation come through. Tomorrow is a big number on inflation. And that number, we think, is going to be above consensus. Consensus, I think, is about 32 basis points on core month on month. We're looking for 38 basis points, but not just next month. Over the next 3-4 months, we're looking at high inflation at a time when savings rate for the U.S. consumer is at 3.5% at a low ebb, at a time when real disposable income growth is barely positive. That, we think, will tell on the consumer, and I think that will lead to a rotation back towards high-quality companies, back towards large-cap stocks.
Funny, you haven't mentioned AI yet. So the rotation is a cyclical story. It's not an AI defensive play.
So the market is moving away from AI, right? But it is moving into low-quality companies like profitless tech in recent weeks, in recent months has done quite well. They're moving away from the AI names, they're moving away from tech, but they haven't moved necessarily into the most defensive names. They moved into consumer discretionary, they moved into financials, they moved into mining, energy, so they moved into deep cyclicals, the kind of stuff that in the Q3 earnings season had done extremely well, but the Q4 earnings season is a much more mixed season.
It's a cyclical story, but it's also a defensive AI play because their sector's less likely to be disrupted by AI. That's another factor, isn't it?
Well, I'm not sure I would call it defensive, because if you look at the low-quality companies, it's hard to put a line through this. The guy is right. If you look at low-quality companies, they have significantly outperformed high-quality companies. So I'm not sure the market's playing defense. It's going into deep mining. It's going into energy. It's going to financial. So I think it is an early cycle story in the U.S. That's the way the market has been playing it. And I'm sure that I'm thinking that this probably should not be the case. We should probably be moving towards high-quality companies.
So not a broadening. Broadening's the wrong way of thinking about this.
No, actually, it is a broadening because if you think about performance, Guy, in the last 12 months, 9 companies out of the Russell 3000 drove 72% of the gains. That's going to broaden out.
Okay.
Right? That's going to broaden. So the performance is going to become broader. So more stocks are going to drive it. But it is, I think, going to be higher quality stocks than sort of the low quality or the
Is tech going to be, when I come back, is what I want to come back to still going to be there?
I think so. I think we eventually do want to come back to tech. I think software names have derated quite a lot.
Okay.
Semiconductor names have tremendous visibility in terms of their earnings over the next 12 months. So the market is not taking down their margins, but their margins, expected margins for the next 2 years are extremely high. This is 40 to 45% margins in the semi name. They're extremely high. I don't think the market will be able to sell them right now because every result that you get from a semiconductor company, whether it's ASML or it's TSMC or anything along the food chain.
What about the memory companies? Samsung and ST Hynix look like they're going to go toe to toe.
I think they will still be quite strong. In the near term, I think the semi cycle will go quite strong.
Okay.
I think it's the software names that we will probably come back to first. I think market is still invested in the semis. That's quite a big overweight for the market. Until that comes down, I don't think we can go headlong into tech and say tech is now cheap. I think we first have to start bargain hunting in the software names before we do it in the semis.
Let's talk about that bargain hunting in the software names then, Banu. Does that mean then that all that we've seen over the last couple of weeks has been overdone? I mean, if we indiscriminately sold, we don't want to indiscriminately then buy back. So what are we looking for? What have we learned about which of these businesses in the software space will be resilient and find an opportunity in AI and which will be eaten?
Yeah, that's absolutely right. So look, I mean, AI is not just going to be about LLMs, right? It's not just going to be about ChatGPT and so on and so forth. In the future, quantum computing right now is still somewhere between reality and fantasy, but you have robotics, you have the medical applications of AI. The companies that can move into those spaces, robotics and medical applications, the companies that can sell software into those spaces, I think that is going to be, those are the companies that are going to survive. I'm not going to go into individual stocks, but we do think the Microsoft, for instance.
But that's specialist software then?
It is specialist software, but as a whole, I think that sector can do well. So it's not like those margins need to go to zero. Last year, it was a bit of a surprise that DeepSeek came and went, and nothing happened to software margins. This year, Anthropic did for the market what DeepSeek couldn't last year and put these margins under a cloud. But I think that the sell-off has been indiscriminate.
Sorry, you were about to say something about Microsoft.
No, we do think that it has come off quite a lot already. So that is a company which we think is a quality company that we would actually be going back into right now, rather than going into small caps and thinking about a major renaissance in the US economy.
It's interesting as you're talking about embedding AI and tech. You've got Luxottica up double digits, and of course they have this partnership with Meta. They've been very successful in selling those AI enhanced glasses. So that's maybe one example. A lot of our guests are talking about diversification outside of the US, into Europe, into EMEA, into Asia. Guy was talking about SK Hynix and Samsung. Where is that story in terms of how much diversification do you want out of the US at this point?
I think you want tactical diversification, right? I mean, let's be clear. US's earnings profile is one that is very ambitious, right? The market is overall looking for about 15% earnings growth. That needs to come down, right? But let's also be clear that US does deliver earnings, right? In the last 3 years, the average CAGR of EPS in Europe has been 0, right? So at this minute, if you think about European earnings, they are beginning to look slightly better. Japanese earnings are looking much better. Real disposable income in Japan is just about to get positive at a time when US real disposable income growth is going to come up. So I do think that geographical diversification over the next 3, perhaps 6 months does make a lot of sense. I don't think that's your structural asset allocation. I think your structural asset allocation is still long the US. Tactically, it does make sense to be in Asia. It does make sense particularly to be in Japan. It makes sense to be in Europe. Australia, Canada, you're seeing decent numbers coming out of these countries.
What I'm seeing at the moment is US, with all this churn, US equity markets are just doing this. Like, at an index like nothing is happening.
Absolutely right.
And does that carry on?
That carries on for the near term. I mean, we're expecting the S&P to be at 6850 by the end of March, right? So we have been expecting this for some time because we think that there is this real tussle. Even at a macro level, there's a macro tussle, there are micro tussles between moving away from tech. Do you move to small caps? Is the rotation to an equal weighted S&P or to Russell?
But most people invest at an index level.
Yeah, and that's the problem. So at an index level, for the passive investor, for the ETF investor, I don't think you're going to see tremendous gains in the S&P. This is one of the reasons why we want to diversify away from the US for the next 3 to 6 months, but not for the long haul. So at a macro level as well, does the fiscal give you help, or does the inflation, which I think is going to be higher in the next 3 months, take away from you? So at an index level, we're expecting the market to not give you strong returns in the next 3 months. Later in the year, the S&P heads towards 7,500, but by end of March, we'll probably be here where we are.
Okay. Always a pleasure. Nice to see you, Barney. Thanks for stopping by. Barney Wager, Chief Strategist, joining us from the UBS Investment Bank. Course X looks like this. Let's quickly show you, because I want to talk about Schroders. I want Chloe to talk about Schroders. That is what the market looks like. Generally, we are seeing some decent gains across the board. Luxury is having a particularly good morning on the back of MS. Let's talk about what else we're talking about this morning. Schroders is, hope, top of the list. Chloe Melly, over to you.
Good morning, Guy. Indeed, this is the big M&A story of the day. So Schroders is getting bought by Nuveen for £9.9 billion. And this marks the end of 2 centuries of independence for this asset manager, the largest standalone asset manager in the UK. And this is a company that had been struggling lately. And therefore, the fact that it is getting snapped up in this way is being taken very well by the market this morning. And we are up almost 30% for Schroders. Moving on to Essilor, and that is also doing very well. Sales for that glasses company came in much higher than expectations, and that is thanks in particular to really strong demand for its AI glasses. So that is the partnership that it has with Meta, and that is doing really, really well, and we are up more than 9% for Essilor. Siemens is also in the green this morning. It raised its outlook, and that is because it has made that move towards more industrial automation, more AI solutions, and that means that it is benefiting from really strong demand from factory automation customers and from data center customers as well, and so it had raised its outlook as a consequence, and that is up more than 5.5%, almost 6% for Siemens. Adyen is in the red this morning. This is a payments processing company. The revenue missed in Europe and North America, and so that is creating some concern about the growth momentum going forward for that company, and we are seeing a major drop in the shares this morning, about 19%, and then the car sector is also in the red, led by Mercedes, which said this morning that it expects margin to remain under pressure this year because of that tariff uncertainty, because of that continued competition from Chinese rivals, and it is dragging down the rest of that sector, and we're seeing BMW and Volkswagen also in the red this morning as a result.
Okay, our equities reporter Chloe Millet with some really fascinating individual corporate names and stock moves to focus in on this Thursday. Coming up, another one. Storied asset manager Schroders agrees to be acquired by a subsidiary of Nuveen in a deal valuing it at just under £10 billion. We will speak exclusively to Schroders CEO Richard Oldfield. That is next. Stay tuned. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Anne-Marie Hordern in Davos, Switzerland, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
17 minutes past the hour. Let's talk about the big story out of the City of London this morning. Nuveen is buying Schroders. £9.9 billion is the price tag. It ends more than 2 centuries of independence for the UK's largest standalone asset manager. The Schroders brand, will they be retained? And London will serve as the combined group's non-US headquarters and its largest office. The deal creates one of the largest active asset managers in the world, $2.5 trillion. AUM, assets under management. Joining us now for an exclusive interview is the Schroders CEO, Richard Oldfield. Good morning, sir. Why are you selling?
Well, Guy, I'm going to take us back a second. So there were 2 announcements this morning. The first one was our results, and it's important as context to the deal. Our operating profit was up 25% to 757 million. EPS is up 39%. This is a great business. It's in a really strong foundation. But what we are doing here is creating this powerhouse of asset and wealth active management. It's going to have an unparalleled breadth of public to private capabilities. And at 2.5 trillion, it gives us the firepower to actually invest in our business and make ourselves more relevant to clients. it's a business combination that's almost perfect on paper. We have total complementarity. There's no overlap in geographies, really. There's very little overlap in products. So we're about growth. We're not about taking money out of the system. We actually drive this business and create something really powerful. And the cultures fit. The heritage, the 300 years together, so it's not just, you mentioned our two centuries of history. Nuveen comes with more than 100 years of history as well, and that actually helps us have very similar cultures. And as you mentioned, Guy, this is all about the City of London. We put that right at the heart of the deal, making commitments to the UK and London.
Richard, did they call you? Did you call them? Where did the conversation start? How did it go? Kind of just give me a bit of colour here.
Well, as you'd expect of the last year, I've been talking to many of my peers around the world about how they respond to the industry challenges that we've got. And what became clear as I met Bill is that we had businesses that were very similar, and we discussed the complementarity. And that led to them approaching us with an offer earlier in this year.
Richard, good morning to you. So you mentioned there that this is about having the firepower to invest. Would it be right to say that AI has changed the landscape, and the requirement to invest in that technology to find that an opportunity rather than a threat means that it's better done with a larger business? Is that one of the drivers?
Well, that's definitely one of the drivers, because the scale of this operation will be able to create more capacity to invest in our business. And it's not just about AI. Actually, when you think about our industry, it's about tokenization and distributed ledger technology. It's about reshaping our industry, about different distribution models. And yes, it's about AI in terms of how we do research, how we do portfolio construction, how we access wealth clients. So I think there's a whole range of technologies here that are going to transform our industry as other industries, and we need to be right at the forefront of that change.
You talked about making commitments around the City of London, Richard, and we read in our stories this morning that London is going to be the headquarters of the non-US business. What do those commitments look like, though? How watertight are they?
Well, they're all listed in the 2.7 offering document, and I think Nuveen have been pretty clear. London will be the non-US headquarters for at least 5 years. There are commitments about jobs over the subsequent 2-year period. We'll have about, to put this in context for you, Anna, there's 3,100 people in the combined group right here in London, and that's the largest location of any office for Nuveen, and it would be about a third of the overall workforce. So this is a big, sizable presence here in London. We're not stepping back at all from our commitment to support the UK capital markets, be at the centre of how policies are formulated, be at the centre of how people come to market. So I think the commitments are very watertight and they're very real, and I think it just shows the size of the UK and London in the overall group.
Richard, what are your commitments on jobs? Should we expect that there will be jobs that will go as a result of this acquisition?
Well, Tom, look, it's a great question, and lots of people are asking that. But there's a very firm commitment that there won't be job losses from this. Go back to why we're doing the deal. It's complementarity, right? We don't have overlapping investment capabilities. We're taking the strength and depth of Nuveen's private markets capabilities, fixed income and US distribution, and we're putting that with our public markets heritage, some of our specialist capabilities in private markets, and our UK, European and Asia distribution. So there isn't an awful lot of challenges here in terms of overlapping headcount. So there is a very firm commitment that people will keep their jobs, except for some PLC functions. Obviously, we won't need that going forward. And of course, we already had some plans from a transformation perspective. But I think it's a really firm commitment to keep jobs here, to keep talent here, to keep capabilities here in London and in the other investment centres that we've got across the world at Schroders.
What do you think it tells us about the broader cost structure pressures for active fund managers?
Well, I think what we've done really well over the last 12 months is show that we can actually take our own medicine, Tom, right? So we've been through a transformation program. We've taken more than £75 million out of our P&L successfully this year. That's allowed us to drive the revenue up. So there's a lot that we can do to manage our own cost pressures as an industry. But as Anna talked about, there are new areas where we need to invest, where we need to develop new products. And that is best achieved when we actually have scale and broader capabilities for our clients.
Richard, Was Bill the only conversation you had, Bill Huffman, the CEO of Nuveen? Did you talk to anybody else? Were there others in the bidding for the business? Would you expect somebody else potentially to come in? This is an interesting asset. Is there possibly somebody else that could be interested in it? Again, I'm just curious as to how this developed and why you've ended up with Nuveen rather than somebody else.
So this business has never been up for sale, and that's quite important because we are confident in our own plan, Guy, and actually we have conviction that we can deliver value for shareholders. When this offer was made, it comes from an organization that I respect enormously. It comes from an organization that will drive value for our clients, for our people, and actually it is a price that I think is super attractive to our shareholders. At 17 times 2025 earnings were compared very well with similar transactions. We have got a premium on spot, I think, of 34%. We are at a 61% over a 12-month VWAP. So I feel really confident. Sorry, it's a 30% premium to spot. It's 34% over the last 30-day VWAP. So this is really attractive for our shareholder base. And what it does is it crystallizes immediately the value in our organic plan, as well as actually the future benefits that we think we can achieve through that combination with Nuveen. There is support from our principal shareholder group. So that's sort of locked at 41% of the shares.
Okay, can I ask you, you mentioned AI. Are you clear on what AI will do to wealth management, asset management and research? Because the market seems to be wrestling with this question.
Well, I don't think any of us have the actual answer, Anna, and I think AI will change the industry, not just wealth management, but asset management as well, in ways that today we can't see. But we're already using it here at Schroders. We're using it in terms of how we connect with our clients. We're using it in terms of how we provide research. We're using it in terms of portfolio construction. So it's already changing the industry, and I think sometimes people think we haven't been changing because of AI over the last few years, but that has been happening. We'll continue to see change, but people also want to see people in wealth management, and that's a really important thing we've got to remember.
Rich, before we let you go, are you staying on as CEO or moving on elsewhere?
I am. I'm really excited by this deal. We're going to drive value for our clients, for our people. I think this is a great opportunity. Okay. So I'm committed to being here. I'll be the CEO of Schroders still, as from an international business perspective.
Richard, thank you very much indeed. What a big day for you and the team. Richard Oldfield, Schroders CEO. Coming up, the UK economy grew less than expected in another blow to Keir Starmer's premiership. We're going to dig into the numbers with Vanguard's Jumana Salahin. That is next. This is Bloomberg.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
This is the opening trade. We're 30 minutes into today's session. On the front foot, there's some activity in the equity markets this morning. Some decent gains at the headline level, up 0.5%. The FTSE 100 is actually the laggard right now, with gains of just 18 points. The strength's really coming through over in France. The luxury sector is getting a lift, up 1.3%. Worth noting, of course, that financial services are one of the biggest gainers, as are banks. We're looking at Schroders, of course, a massive pop there on the back of the Nuveen deal. Up 0.9% on the DAX as well, gaining 226 points. Guy, what are you looking at?
So I'm getting slightly obsessed with this number here, okay? 370 up, 275 down. Day by day, you're getting a little balance, a little bit of more balance one side than the other, but basically the market continues to just kind of pivot. You get a little bit of upside one day, a little bit of down, but we're going sideways, and that's the narrative that we're getting. In so many ways, again, 277 down, 317 up. It's basically one for one, so that's the narrative we're looking at. Volume's a little better today, which is good. Let's talk about the deals. Let's talk about what we're seeing in terms of the numbers. Schroders is obviously up. We've just been speaking to Richard. The deal's been done. We're up by nearly 30% on that stock. A few wobbles, kind of, whether we're up 31% or 28%, but we're basically at the kind of the offer price. Luxottica's having a great day. It's up by 8.41%. The kind of is a glass is the next form factor. Are they going to take over from the phone? Don't know about that. Siemens is up by 6.4%. So there's a number of kind of M&A deals, single stock stories, tech deals that are kind of impacting this market this morning. Downside, Adyen's under real pressure. That stock is down by 19%. So again, you're getting some real volatility in this kind of fintech space at the moment. Adyen down quite hard. Ice creams are also not having a good day, which is never a good day for anybody, to be honest. And Mercedes-Benz Group is down by 4.35%. That's rippling into names like BMW as well. So you've got you've got to be focused on almost the single story narrative this morning to understand what is happening at the index level, which is really interesting because the index level continues to go sideways, Anna.
Yes, absolutely. Let's get an update on some of the other big stories we're covering this morning. Bloomberg has learned that Anthropic is nearing the completion of a deal to raise more than $20 billion in a funding round co-led by investors including Peter Thiel's Founders Fund, D.E. Shaw, and Dragoneer Investment Group. The funding round has become a who's who of Silicon Valley and Wall Street investors. Other participants include Blackstone and BlackRock. Sources say Anthropic is set to be valued at about $350 billion in that deal. The Republican-led U.S. House has passed legislation aimed at ending President Donald Trump's tariffs on Canada. The vote signals growing anxiety over the White House's economic agenda before midterm elections focused on heavily on affordability. Trump is almost certain to veto any bill calling for a repeal of tariffs. And the UK economy grew less than forecast in the fourth quarter as business investment shrank and services stagnated, adding to pressure on the embattled Prime Minister Keir Starmer. Gross domestic product rose by 0.1%, lower than the 0.2% in Bloomberg's survey of economists. Tom.
Well, let's stay on that story and get some more insights and bring in Jumana Salahin, Chief European Economist at Vanguard. Jumana, good morning. Let's start on the UK economy then. How concerned should we be? How does it change your forecast for the year?
So it doesn't actually change our forecast for 2026. 2025 actually came in line with our expectations. because, you know, you see ups and downs month on month. So I wouldn't read too much into the numbers.
And 2026 forecasts are?
1% for
1% growth for the UK?
Yeah.
Okay.
Yeah. So that is below what we saw, 1.3 down to 1. So we see a weakening of the UK economy in 2026. And the story, I can tell you the story if you want.
Yeah, what's the biggest drag?
The biggest drag is obviously, you know, wages. Real wages are going to come down. Inflation is falling, but real wages are falling by more. So the consumer doesn't have that money, income to support the spending. So we see that weakness coming through.
Okay.
Inflation. Yeah. What does inflation do? Because you can have kind of 1% growth, but if inflation's kind of higher than that, we've got a problem. What is inflation going to do?
So inflation, we expect, is coming down.
Okay.
Right? So we've seen a little bit of movement up and down, 3.4 the last number, but we see it coming down to 2% by the end of 2026. So we're quite positive on inflation.
Which bits of inflation are going to come down? Because it feels like a lot of the inflation at the moment feels like it's regulated.
That's right.
And so I'm wondering what happens in terms of actually how the consumer feels in terms of the regulatory, in terms of the inflation picture.
Yeah, absolutely right. And we know that the government's taken some measures with its packages to reduce those regulated prices. So our estimate was it's going to take 0.2 off of inflation just from the regulated price adjustment. So we're going to see that coming down. And also across the board, we will see inflation, don't forget, it's the change in prices.
Yep.
Right? So we are going to see that easing across the board for goods and services coming down. So it's not like one particular sector, but definitely regulated is going to come down faster.
Jamala, what story should I be telling about the UK economy right now? Because it's possible to tell a kind of gloomy one around services not living up to expectation based on the numbers out today. It's also possible to look at some maybe green shoots, we say that quietly, for the UK economy and think about that into 2026. Have we turned a corner from the budget? Is that what that narrative depends on?
Yeah, so I think the budget was a little bit positive news, positive on growth because, you know, on the margin, there was a little bit more front loading of spending, so that pushed up. So in terms of our forecast revisions post-budget, we revised up GDP from 0.8 for the whole year, 2026, to 1. So there was some positive, and inflation down by 0.2. So it was good news. But there is a structural force here, which is the UK economy has been at a 1% economy, not a 2% economy like the US. So there are some underlying forces here that, you know, we do say the UK economy is stagnating, and we do get that in the latest data today.
Yes. We spoke to the Treasury earlier on, Dan Tomlinson from the Treasury, saying that they are obsessed with growth. They're investing into a fast-changing world, though, aren't they, with AI very much at the forefront of everybody's minds. How does that play out for an economy like the UK, which is very services-focused? It is very white-collar, and we spent all of the last 2 weeks seeing story after story about concerns about white-collar jobs and industries.
Yeah, absolutely. Great question. We think in our Vanguard Economic Outlook for 2026 that AI is going to be the most important long-term trend, the mega trends that we call, shaping the economy. Now, in the US and China, they're doing most of the innovation. Headline numbers for investment, 2 trillion. What is the UK doing? 100 billion. So we need to be doing more investment. Maybe we can't do the innovation, but can we do the adoption? Can we be using that technology plug and play that those big Mag 7 companies are doing the investment for? And that's really where the challenges is. And, you know, the job story, white-collar jobs, whenever we see a transformative technology, what we call a general purpose technology, internet revolution was the first one. The second one we're seeing is AI. We are going to see jobs adjust. There will be, with everybody's job, there will be tasks which can be automated. So that's how we see it. It's more task-based.
You don't think the UK is specifically exposed? I have seen some research that says that, you know, the UK is more exposed than others because of the makeup of the economy.
No, I wouldn't say the UK is particularly exposed. Okay. No, it's more about can they adopt fast enough.
What are the productivity gains on that adoption story?
So the productivity gains are, you know, they are numbers that are sort of less than 1%. We're talking 0.5%, the productivity gains that you can get from innovation. So that's kind of what we see, but on a long-term basis. So we're talking about the next 5 to 10 years. That's quite good, right? So if we can go up from 1 to 1.5, that's actually pretty good from productivity, from innovation, from AI, adoption from AI. Sorry, not innovation.
The BOE has views on AI, and I want to go back to your take on 1% growth and inflation coming down to 2% by the end of this year. Does the BOE have room to do more on rate cuts?
Yes, we've got 2 more rate cuts priced in. We think that probably next month there will be a rate cut, particularly on the back of the numbers today. So that's what we've got priced in, taking interest rates back to neutral territory, which we think is 3.25%.
Just before we go on to other subjects, if we see political instability in the UK, how upended do you think your models could be? If we see yields going higher, what's the effect of what will be the effect? If you plug in a high yield, what effect do you get in terms of some of the outcomes you see in terms of your models?
Yeah, so if you get the higher yield on, you have to think about, like, there's 2 sides. First of all, the real economy.
Sure.
And that really depends on that investment and that productivity. And I would say some of the political instability is already priced into markets in terms of, the investment cases. So that's kind of in. On the margin, what happens if you have those higher long-term rates due to political instability? That feeds back to hurt the government debt. So you start paying, more in that interest rate, right? So it's the long end of the yield curve which drives the amount that we're paying back for the gilts that we've borrowed. And that could lead to that negative feedback loop, which we're trying to get out of, right? The whole purpose of the budget, the narrative is, hey, if the budget can give us that growth, that allows the Bank of England to cut. That allows us to get into that positive feedback loop, and that's really the challenge.
Meanwhile, Germany is investing heavily, isn't it, on infrastructure and on defence. Excuse me, we get 2 stories here when we talk about this. Some people say it's not showing up in the numbers yet because they can't get the money out the door quick enough. Others say, yeah, it's all coming through. What are you seeing in the numbers?
So we're actually positively surprised. So they said 500 billion over 10 years. That's about 50 billion a year, right? So we actually saw spending close to 40 billion, which is great news because, as you said, people are like, will they be able to spend it? Now, the question is, what are they spending on? So it turned out that they have twisted it more towards consumption rather than investment. And we would like to see, for the long term, if you can tilt it towards investment in defence, in infrastructure, in technology, that gives you that longer-term boost.
Jumana, thank you very much. Indeed, Jumana Salheen, Chief European Economist at Vanguard. And we will get and continue to focus on the German economy, particularly the polls coming through from Siemens, which is having a very strong session after an outlook upgrade to its earnings per share. So the stock price is up about just over 6% right now. I spoke to the CEO of the German industrial powerhouse Siemens on the back of those earnings then, and found out what he had to say as well about the AI impact and the potential impact on Europe's largest economy. Take a listen.
We will see how dynamic, how fast AI is hitting really the real world. We believe that this happens very fast. But from that perspective, we see still there's a good growth. There might be shortages on power supply or supply maybe on GPUs. But since the supply chain is also ramping up, we believe that this keeps on going.
And you think that the CapEx spend, the commitments from those hyperscalers, $650 billion US potentially this year, that is rational?
I mean, I didn't make the math of all the commitment which everybody gave, including the investment banks. Adding that up, there might be a slippage, but if you take even a slippage into consideration, still enough money for a market to keep on going.
And you've got a record backlog now. About 120 billion euros is the backlog. What are the constraints around delivering that backlog? Are you able to deliver on those orders?
Clear, yes. I mean, we really invested early enough. So we doubled our manufacturing capacity for medium low voltage in the United States, exactly for data centers. We increased capacity for rolling stock. By the way, big backlog comes also for rolling stock. So we have capacity. We invested in capacity, also in capacity for our automation devices. So that's not a problem. We will deliver.
There is a currency impact. How and to what extent is FX impacting you, particularly euro strength, and how are you looking to mitigate that? Are you taking any hedging strategies around the currency?
I mean, we always do some hedging in the background. The impact, I think, is something like 50 basis points, and we planned the fiscal year on this weak dollar, and so therefore that's part of our planning. if that stays in that ballpark as we see today, that's part of our forecast and our planning.
Okay. You talk about the software part of the business. We've seen a significant sell-off, including industrial software names, in the last couple of days. What do you make of what we've seen there? How defensible is industrial software from the evolution of AI and some of these products being put out into the market now?
So we know that AI has the potential to disrupt some of the software businesses. I mean, if you talk about software which runs on call centers and the like, I mean, that's fully on the block. But if you go on the other end, on industrial software, simulation software, physics-based software, we don't see that at all. We rather see an enrichment of the software, which allows more and more customers to use it. Take, for example, simulation. Simulation is costly, takes a lot of time. Using GPUs, we can accelerate it 100 or even 1,000 times, making it accessible. Yet, the point is that you always want to frame it with the physics, because hallucination is not an option on a shop floor, neither in your designs. And this is where physics comes in. It always gives you a confinement of what really is right and wrong.
The Siemens CEO, Roland Busch, speaking to me there on the back of those earnings. And again, it's the data center push that's coming through, really offsetting. They continue to see weakness in the auto industry. He made that pretty clear. He wants to see a turnaround in the German economy. He says that more needs to be done. He thinks the government are putting in place the right policies. He wants to see growth of above 0.7%, clearly. He thinks that maybe they can get there. But data centers and that backlog, they have this huge backlog now that they have to fulfill.
He's a real believer, isn't he? Yeah. And despite acknowledging that in some cases there'll be hallucinations still at the moment, that's not an option in some of the ways.
In industrial software,
and that's not an option in the factory, is the way he ended that, which I thought was really interesting. But yeah, a real believer in the potential for his business to benefit.
You just see the numbers. You have to. I think if you're seeing these kinds of numbers as a CEO, you just got to go, I need to invest into this. You can't have any skepticism. You have. It's like the TSMC CEO. I'm a little nervous. I'm worried. Is this actually going to deliver? But the numbers I see in front of me compel me to work with
you invest through the worry. That seems to be the thing. We asked the ASML boss about that in the context of the TSMC comments. You know, are you nervous as well? He says, if you're not doing your job properly, if you're not worrying about that, that's what the job of the CEO is to do, to worry if the investment is the right one and the right scale. But clearly they see a lot to invest in.
Yeah, because these are real orders that they have to fulfill. And the question is less about whether those orders are going to transpire and more about whether they can actually deliver on those orders.
It's still a supply chain story. It's still a kind of, can I get the kit I need? Can I get the labor I want? All of these issues remain ever present, and you see it in the United States. You see it in the construction data yesterday, the payroll numbers. Can you build enough? Can you get enough people to work on the data centers to build the data centers?
Yeah, and interestingly, we were talking to Germano about the German investment story, and some people had said to us, you know, this is going to, you know, the numbers aren't going to get out the door quick enough. Germany has a history of not being able to spend the money it allocates to fiscal spend quickly enough. She was saying that there is some evidence it's getting out the door, but actually she wants to see it more on the structural side, on the infrastructure side, rather than on the more consumer-facing side. So that's an interesting one, because that's something we'll return to. And it's a big day for German earnings, German corporates, isn't it? We've had Mercedes out with numbers, and that stock's under pressure, down by 4.3%. So it's another day where some of those granular stories are perhaps more interesting than where the index sits.
But again, that's kind of how do you draw a line through this and come up with a narrative at the end of it? Is everybody just going to have to become a single stock investor, a theme investor? Can you figure out a strategy around that? People keep telling me that this is the time for active management, but active managers must be whipsawed at the moment in terms of the price action they're seeing.
And Bana Boejo of UBS coming out with a different view to many of our guests on this, which is that actually the cyclical story that he's starting to see. He's not compelled by that. And maybe tactically, over 3 to 6 months, that's where you go. But after that period of time, you want to be back in those stalwart US names for the earnings strength.
Yeah, precisely. Why do you want to come back? Because how long does this boom in America last? How long does the data continue to be supported? Is it just up until the midterms, or the market's going to price beyond the midterms quite soon? So do you start to fade that trade at that point? It's really difficult.
It's interesting from the political landscape, you know, how you respond to the global threats at the moment, and the fact that you want to promote your country's product, but you don't necessarily want to put up barriers to trade. And this came up when we were talking about the UK economy. You were asking about that of the Treasury. Well, Emmanuel Macron and Friedrich Merz seem to be on different pages when it comes to this. So on the German side, they seem to be saying, you know, we don't want to put up too many barriers. leaders on the French side. They're saying we really need to push the Made in Europe story.
Yes, so that debate between the leaders of France and Germany. I think we get more perspective now on the German economy. I think we've got someone standing by to talk about this because, of course, we have had the earnings story coming through as well from a number of big industrial players in Germany. So for a broader context, let's bring in William Wilkes in Frankfurt. William, what does it tell us about the kind of impulse that we're seeing? What is the strength of corporate Germany? It seems to be a mix. Siemens is firing on all cylinders, it seems. Mercedes, the auto sector, continues to be under pretty significant pressure.
Good morning, Tom. Yes, you can see exactly in this morning's earnings some of the challenges facing German industry. On one hand, you've got Siemens, which is doing very well. They restructured a few years ago and shifted to focus on software, and that's starting to really pay dividends. It's higher margin business. It's a bit less vulnerable to shifts in demand. Whereas on the other side, you have the problem really that's hitting German industry, which is this new competition coming in from China, which you're seeing in the Mercedes-Benz earnings, where really what's going on there is you've got a company with very high costs and it's struggling to keep up in China against rivals that are getting better at engineering and manufacturing and have a much lower cost base.
And on the Mercedes side, we keep asking, William, whether we're at the end of the pain for the German auto sector, but now with the rise of China, feels we started another leg on that story, that competitive threat really having an impact.
Yeah, indeed, and there's still quite a long way to go. Mercedes still sells a lot of cars in China, so there's room for further decline if they can't turn it around. And obviously, the other cloud hanging over them is no one really knows what the tariff outlook really is, or not just in China, but also Europe is becoming more protectionist. The United States is becoming more protectionist, and China might do more to support their own manufacturers and shut out Western ones. And basically, that's a real headache for a company that, since the fall of the Berlin Wall, has made its business model about exporting between all these different regions, and now they have to kind of manage worsening global fragmentation, and that's a very, very difficult situation for any globally active manufacturer.
Okay, William, thank you very much. Indeed, William Wilkes on some of the corporate challenges, particularly in the auto space, that continue with Mercedes, of course, and you can see the share price down around 4%. Very different story for Siemens as it leverages that software play and exposure to data center demand. Financial services is one of the best performing sectors. It is top of your list right now. Banks following as well with gains of 0.9%. And we'll stay on that. We'll get some more details on the specificity around the comp for a particular CEO. What has Morgan Stanley's CEO, Ted Pick, been awarded in terms of the salary? We're going to give you the answer when we come back. This is Bloomberg.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back. Before the break, we asked, what has Morgan Stanley boosted CEO Ted Pick's salary to? The answer is $45 million. Morgan Stanley have pushed up Ted Pick's pay, up from $34 million after a record year for the Wall Street firm. The stock is up about 33% in the last 12 months. Pick took charge of the bank in early 2024 after years of leading its trading operations. Morgan Stanley posted its strongest year last year, with earnings per share hitting a record. The company has been helped by its push into debt capital markets, arranging financing for projects tied to that AI boom. Pick's pay compares to $47 million for David Solomon of Goldman and $43 million for Jamie Dimon of JP Morgan.
Okay. Kind of takes us to our next subject, I think reasonably neatly. Morgan Stanley, big asset manager now. Schroders, now part of a bigger asset management group. So that's kind of my symmetry on this. So the company's been taken over. The stock is rising. I thought it was interesting. It sounds like it was kind of the Nuveen conversation was one that started. The offer was made earlier on this year, but it looks like they didn't put the business up for sale, which I think is interesting.
Yes, absolutely. Let's listen into what we heard from the CEO of Schroders, Richard Oldfield, speaking to us earlier on. And we were keen to understand what it was that was driving this decision to do this deal.
What we are doing here is creating this powerhouse of asset and wealth active management. It's going to have an unparalleled breadth of public to private capabilities. And at $2.5 trillion, it gives us the firepower to actually invest in our business and make ourselves more relevant to clients.
The firepower to invest in your business, that was the thing that I took away from this. And also bringing more private markets.
With $2.5 trillion of assets under management, that's probably a fair assessment. Powerhouse.
But the AI was definitely part of the conversation. Yeah, this kind of this need to invest.
Yeah.
Like you have to be a powerhouse.
Yes, even if he fully acknowledges, like a lot of other people, we don't know who exactly the winners and losers are going to be just yet.
That is it for the opening trade. The Pulse is up next. This is Bloomberg.
Welcome to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Succumbs. The storied London company agrees to a £10 billion takeover by Nuveen of the US, creating one of the world's largest active asset managers. Well, Donald Trump's trade policies face their biggest political challenge to date as 6 House Republicans break ranks to vote against his levies on Canadian imports. Plus, traders bet on fewer Fed cuts this year after a strong U.S. jobs report, payrolls rising by the most in more than a year. So good morning, everyone. It's Thursday. There's quite a lot going on in the markets. We're also getting ready for our coverage of the Munich Security Conference later, tomorrow and then onto the weekend. The European stocks seem to be climbing. Overall, again, we had some pretty strong company reports. Look, I'm looking at the stock 600. It's gaining some 0.5%. Again, companies like Essilor, Luxottica, but also Hermes rising after posting some pretty strong sales. And then oil rising also as tensions in the Middle East seems to be outweighing concerns that there's a supply glowing. We look at sterling 13640, and then Bitcoin also sliding to trade around 67,100. The Bloomberg Dollar Spot Index pairing earlier losses. So let's also have a look at the markets map here in Europe. But again, it is really one of earnings. Siemens up more than 6%. Schroders, our top story in terms of corporate news, jumping some 30% on the news that Nuveen is buying the asset manager. Now, we are also getting the IEA, so we'll have a full debrief on oil. Stockpiles actually swelling last year by the most since 2020, and that's according to the IEA. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the Republican-led U.S. House has passed legislation aimed at ending President Donald Trump's tariffs on Canada. The vote signals growing anxiety over the White House's economic agenda before midterm elections, focused heavily on affordability. Now, Trump is almost certain to veto any bill calling for a repeal of tariffs. For more, we're joined by Brendan Murray, who leads Bloomberg's trade coverage. Brendan, the man who never sleeps, how much of a blow was the vote to Trump's political agenda, and what does this setback actually mean?
Well, one of the hallmarks of President Trump's past year in office is his ability to keep a unified front and keep the Republicans on side to go along with his tariff policies throughout some turbulent several months there. But what we saw in Washington late yesterday was some cracks starting to form in that united front. I think it's worth remembering also that this vote was focused on Canada, and so certainly there are some states where there is a lot of U.S. trade with Canada, and so American public opinion toward Canada is a lot different than it would be if this vote were against the tariffs on Chinese imports. So you don't want to read too much into this, that this is some kind of sweeping rebuke of the tariff policy, but it's the beginning and perhaps a turning point. If the economy doesn't start to heat up from here, we could see more and more votes like this and more Republicans defecting and voting against Trump's tariffs.
Does this mean any tariff relief for Canada, Brendan? And what might this mean actually for the North American trade deal known as USMCA?
Right. So the message here from Canada, from the U.S. Congress was maybe we should ease up a bit on Canada. President Trump has really picked on the U.S.'s neighbor to the north. He's gone after Bombardier. He's gone down the aircraft maker. He's targeted this bridge that's about to open. And so he's really kind of focused his frustration on Canada at the moment. And the message from the U.S. Congress is, maybe we shouldn't go so hard with tariffs on Canada, a close trading partner, and certainly one where there's a lot of support among especially the northern states for good relations with Canada.
Brendan, thanks so much. Brendan Murray there, who leads Bloomberg's trade coverage. Now, a strong U.S. employment report caught investors in the $30 trillion Treasury bond market off guard, sending yields surging as traders lowered their expectations for Fed interest rate cuts this year. Now, the Sell Now, Ask Questions Later trade sank real estate service stocks as investors rotate out of companies vulnerable to AI. So to walk us through what's happening at the macro and micro level, we're joined by our senior markets strategist, Neil Campling, and Beata Mathy, of course, head of European equity strategy at Citi. Beata, thanks so much for joining us. Neil, we come to you every day because every day there's something else actually that we worry about in terms of business strategy or business model. So what did we learn this week, and who's next?
Well, that is the trillion-dollar question in many respects. So if we take the example yesterday with these commercial real estate stocks that were hit hard, there wasn't a new agentic AI model that was released. It was more the perception of there could be a model that's released and that could impact this particular sector. So we've moved away from previously the actual models being released and seeing the companies affected to now the potential for models being released. We're definitely seeing we saw indiscriminate selling last week of all software stocks. This week, we started to see some of the software infrastructure companies actually rebounding because they own the data. So there is some sort of awareness now that not all should be treated the same. I think I was talking to a very experienced tech investor yesterday, and he was explaining to me that what we have to understand is that with these new models, they are now focused on very specific tasks. Yeah. So we can't assume that the cloud models we had in the past can be used in these models. It's like trying to use a Toyota Prius to run an F1 race. You need to have a very...
My heart. Toyota Prius, an F1.
But it's not an F1 Ferrari, is it? So that's the problem. You need to build the models that produce the fastest, most accurate results and prediction in the future. And I think there's an awareness now in terms of trying to value these companies that there are, a lot of companies that will lose from this race, but there are a few specific winners.
I mean, Beata, this is the concern, I guess. This is not really about valuations. This is about business models, right? It's nobody really wants to be Kodak. I'm sorry about Kodak, but the point is that we don't really know how much disruption there is.
Absolutely. So it seems that the market is trying to figure out all the losers in the space of 2 weeks. Every day, another identified supposed loser, right? But as Neil has mentioned, there'll be nuance. The market is just selling everybody in the same sector, but proprietary data is key, of course. And we've been arguing that this year is the year of bullish stock market, but a very volatile stock market, and the volatility would be induced by the AI trade, which is evolving. So right now we are concentrating on losers. We don't know what the terminal value of these companies is. We know that they've come down a lot, but is it enough? It's really quite unknown right now. But also what we need to discover what the new winners are going to be, right? So adoption, and very effective adoption this year is key, and this is one of our main themes for the year.
So, Beata, you think this week was challenging, and I don't know whether, again, because of these quick rotations, whether, I mean, it is sometimes difficult just to catch your breath, actually, from one day to the other. So are you expecting this kind of intensity to continue? Underlying fundamental, like, European reporting season was also not bad.
Absolutely. So there are a few things here. First of all, the reaction to the reporting season. Okay, not great, but all right reporting season. And we are seeing very disproportionate price reaction to these reports, right? So when you miss, forget about it, you get punished a lot. But actually, on average, if you beat expectations, average price reaction in Europe, at least, has been negative. It doesn't happen very often, right? So this is one. That's to do with the markets being very rich. You've mentioned it isn't about the valuations. Of course, for the individual stocks, it is about the terminal value and how disrupted they can be. But for the overall stock market, it is a stock market price for perfection and over-delivery. That's been the case with the US for some time. Now, actually, perhaps with the exception of the emerging markets, Europe is also one of these markets that is priced for perfection and over-delivery. So you need to really over-deliver a lot to get it in. And then the weird thing is, of course, is how calm the index level is, and you have these crazy moves underneath the surface. So what we notice is...
What is it, dislocation? Like broken correlation?
It is ferocious rotation and huge dispersion. So dispersion has been climbing already, and in Europe is the highest since the global financial crisis. It has been higher in the TMT bubble build-out. And then, so that actually, it's not necessarily a bad thing for stock pickers. It tells you that there are opportunities, right, if you are on the right side. But as the rotation happens, you need to be very nimble and change all the time. And on the other side, you have very low correlations. So stocks are not moving together. The difference between the two, the gap, is the lowest since it's been only lower in 1999 and 2000. The same can be said about instead of correlations, you could use volatility of the index level. Very high, not as high as the gap between the other two, but historically, when we looked at the forward performance from these levels of gap between dispersion and volatility, at best, you're flat over 1 to 3 months. Yeah. Over 6 months, market up. But in the near term, it tells you that this volatility or a bit of anxiousness in the market could continue.
I mean, a curiosity, Neil, I guess, is like how much of this is market, angst because too much was priced in. I mean, I don't believe a lot of the big sell-offs that we've seen in software. I mean, the CEOs will be on top of this. All we talk about is AI disruption. Yeah. So are there any steps that they can take to not go, not to have their business model shattered?
Well, I mean, it depends on whether you have a moat, whether you have a real business moat or not. And to Beata's point as well, you talked about terminal values. This is the discovery process taking place today, I think probably in both public and private markets, because a lot of these deals, if you like, in terms of private equity deals in software, as well as the public companies, we are now starting to question the terminal values. Yep. We're now starting to have to adjust the calculations for the DCFs, and that's where you get the markdowns. But that's also where, if we look at previous tech cycles, the likes of a company like an Oracle, for example, was being disrupted by someone like Salesforce. But what Oracle actually did is it took advantage of the depressed valuations to buy JD Edwards, to buy PeopleSoft. It built up a huge arsenal of companies under its hood because it had that structure and it could buy in the cash flows. I suspect the next wave we will see is actually a wave of M&A from the leaders buying some of the other companies that they can then sort of improve margins and improve their moat around their offering.
Beata, I mean, going back to like reporting, repricing, rotation, is there anything that looks more or less attractive after the week that was?
That's an interesting point. And of course, in this rotation, everybody is piling into outside of tech stocks, and we have rotation into mid caps away from large caps. Actually, when we look at valuation after last week and we look at forward PEs versus where they are trading percentile-wise in the last 25 years history, in the US, one of the most attractive sectors right now is tech. Right? Software is a big part of that cheapness, but it does look the most attractive. So value, where everybody's rotating into, actually looks more expensive now than growth. So that's something to contemplate on. Outside the US, it's still the opposite. Value is much cheaper versus its own history than growth, right? So
time will tell.
Yes.
As always. Very quickly on, I mean, in terms of AI in Europe, is there anything that you're looking at specifically?
So, of course, AI, in like the first phase of AI that we've gone through, hyperscalers, the build out of data centers, Europe didn't, outside a few individual companies, didn't have too much to offer or participate. However, if indeed this is the year of the market demanding evidence that this big capex spend is going to yield some returns via, well, labor productivity gains, for example, this is where Europe can really kick in and could be very interesting. So physical AI, broader set of sectors applying it and seeing some gains.
Is there a name?
Siemens Energy is a good example, and Siemens numbers today, record highs in the stock. You know, you have to have the pipes, you have to have the infrastructure to enable AI in the first place. So there are infrastructure ways of playing the AI trend across the globe, and Europe's included.
Okay, thank you both for a great conversation for this Thursday. Neil Campling, our Senior Market Strategist, and Beata Manthe, Head of European Equity Strategy at Citi. Now, coming up, the UK's largest standalone asset manager is being bought for nearly £10 billion. We have the details next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Nuveen is buying Schroders in a £10 billion deal, creating one of the world's largest active asset managers with nearly $2.5 trillion of assets. Well, speaking exclusively to Bloomberg, Richard Oldfield, the Schroders chief executive, said the deal will give the company more firepower.
what we are doing here is creating this powerhouse of asset and wealth active management. It's going to have an unparalleled breadth of public to private capabilities. And at 2.5 trillion, it gives us the firepower to actually invest in our business and make ourselves more relevant to clients.
Let's bring in Tom Metcalf, our managing editor for finance in the EMEA region. Tom, firepower, I mean, how critical is this for actually an active manager?
Oh, it's absolutely essential. So it's all about scale, right? And Schroders, long time, been one of those where they've clearly been needing to, address that. I think that the shock here is just how quickly it's happened since Bruno Schroeder died. The family's always been, a hallmark of its independence. So I think in the sort of halls of Schroders, people are kind of waking up this morning going, did not see this coming, because total shock to the city.
2.5 trillion. I mean, again, we're a bit blasé. Where does that rank?
Oh, as an active manager now, it's definitely one of the big players. So the largest is something called Capital Group, a very low profile, but has about 3 trillion. So it's basically top rank. But then, of course, you want to compare that to the BlackRocks, the Vanguard. BlackRock has 14 trillion. And that's just a sign of why, active managers, there's all these pressures on them, lower fees, all that stuff, which is why they need to, Schroders was not that small, but it really needs to be, top tier in the industry to survive.
Tom, how big of a loss is this for London, for the UK, and the City of London?
Yeah, I think it's certainly an emotional one, actually. It's kind of a real link back to, the old City of London. Schroders, probably along with Rothschild, one of the last hallmarks of that. I think, really pragmatically, something like this had to happen. But I think, there'll be a lot of, probably quite sad people, actually, because it's a real institution. And whatever happens, moving out of family ownership, American owners effectively, something's going to change, whatever the CEO was just saying about, oh, this is fantastic. I imagine a lot of people are quite nervous today.
Yeah, I know we'll continue, of course, some of our great reporting in this, Tom. As always, thanks so much, Tom Metcalf, our managing editor for finance in the EMEA region. Now, oil climbing for a second day as traders remain concerned about U.S.-Iran tensions with the potential for military strikes and risks to supply oil. With us now, Nadia Martin-Wiggin, director of Svealand Capital. Nadia, thank you so much for joining us. I mean, every day we talk about crude, and the sentiment, because it all ties back to geopolitics. But what are you seeing in terms of refining and where the oil price goes next?
Well, we actually see a very strong market for refining. We see that runs in January were up 2 million barrels per day versus expectations in December. And we saw that the U.S. increased runs year on year by 1 million barrels per day, despite the fact that we had all that cold weather. So I think in that regard, the market has been much too bearish in terms of expectations, and inventories are still low.
So is there a glut? Again, I've never seen a market where actually there's two narratives that seem to be really competing and no one can get on the same page.
Well, I'd say the glut narrative has definitely been the dominant one, and that is really continued since the second half of 2024. But what we see now is that really the inventories haven't built. The IEA report this morning, it only shows a 3.9 million barrel build in December. OPEC was showing 6.5 million barrels. And yet the IEA is talking about a 3 million barrel per day build last year. In supply versus demand, they expect the call on OPEC to be 600,000 barrels per day lower this quarter than last quarter, and for that to continue. And I just can't find the oil.
But so how do you read that? Is it a problem with the economy, that there's just not enough consumption? Is it Russian oil that's sitting somewhere?
Well, I think the demand is actually higher than they're capturing, first of all. There is inventory, of course, building in China in particular, that we expect to continue at least through the first half of this year, if not the next year. Geopolitics are a part of that. I think on Russia, we're finally really seeing a logistical problem. So when War 2.0 started, the IEA was saying we could lose millions of barrels per day of oil. That didn't happen. Now we could increasingly start to lose from 100,000 barrels per day up to 600,000 barrels per day because of logistical problems. It's not a production problem, but it's where to put this sanctioned oil that isn't getting bought.
And so this is not basically the U.S. telling India, look, if you want a deal, a trade deal, don't buy Russian oil.
Well, it is a part of it. I mean, in that, we already see a pullback of around 500,000 barrels per day. There's still more than 1 million they could buy. But also China's taking almost all they can of Russian oil at this price. They want an even steeper discount. And of course, they're not taking Venezuelan so much anymore because it's expensive. So I think they're putting that pressure, and that will resume a bit. But we do see that it's tricky. The dark fleet has to continue rising for Russia to keep able to produce.
What's China doing? Are they still building stock?
Yes. And in our view, easily they could build 1 million barrels per day this year. If we think about Xi and his address, we could see something happen in Taiwan next year. They are preparing. They're not only buying oil, they're also, we see that there's a pull to the east to own tankers. We even see stockpiling a bit on the metal side in China, and that's in preparation in our view.
So if you think, this is maybe what, like an invasion of Taiwan, a takeover of Taiwan? What happens to the price of oil if that happens?
Well, then I think it would go higher because that is that demand pull. We get more of this kind of splintering off of the world. And even if they were not going to invade Taiwan, I think they want to be prepared because we're in such a divided world. So everyone needs to have their resources in line. And we see that being led by the U.S.
Iran and then gold. Iran, again, we're on tenterhooks. Is there going to be a strike or not? And there's a huge danger for the Strait of Hormuz. But what does it mean if there was a strike, let's say surgical strike from the U.S. to get rid of the leadership? What does that do to the price of oil?
Well, it depends. Well, first of all, it's bullish. I think what we saw with Venezuela, though, the U.S. focused on blockading the oil. So one thing is the closing of the Strait of Hormuz by the Iranians, which, we're on the fence if they would actually do that because it's so bad for them. But on the other hand, the U.S. could control shipments going out, and they could control Iranian crude, which is the focus, not the rest of the crude coming out of the Middle East. And that's what we saw with Venezuela. So I think that shows things. We saw also with Venezuela, Maduro's out, not a complete change. In Iran, it's very difficult to see who would replace the government. The way I like to think of it is they've never been weaker, the government right now, but who is going to step in? And that's where I think it's complicated. So more strikes rather than a complete regime change, I think, in the near term to start.
Gold.
Yes.
So is this just a pure play against U.S. assets?
Well, I think it is about nervousness in the world. And this started with central banks. We had Russia buying before they invaded Ukraine. Then we had the Central and Eastern European central banks being the huge buyers since the invasion of Ukraine 2.0. We saw LatAm coming back into the market end of last year. Oh, Venezuela happened. Suddenly they were buying again. And then the big new player is really Tether, with their stable coins and their U.S. and their gold coin. And that's the last 2 quarters of last year. They were the biggest buyers in the market. And that's diversifying away from just having a U.S. Treasury-backed cryptocurrency, which is what the governments around the world are doing. And, then we have discussions of ADNOC issuing a bond in won. And that is just indicating that we're going to diversify our centers of universe and our supply chains.
But so gold goes higher? We saw quite a big violent pullback, actually.
Yeah.
Was that a blip?
Well, no, I think part of that was driven by silver. I think we saw a big jump in ETF buying at the end of last year in December, especially in Asia. And that's more nervous money that kept buying. But the long-term buyers are there, and we expect to break through the previous highs this year, no problem.
And then it just keeps on going higher? Is there a 3-year target that we need to be looking at?
Oh, it's a lot of geopolitics in the world, changing trade patterns and so forth. But, we definitely think $6,000 is a target, and then we just see.
Nadia, this is a difficult question, but could you see, if something happened with Taiwan or even Iran, could you see gold actually moving more than oil because it's almost like an asset worry, a worry asset?
Yeah, and it's also a trade concern, right? Yeah. So that absolutely, and what we've seen so far is it's been moving so much more than oil. Oil's been stuck in this range bound, but I think the market is understanding how much this short, bearish, negative narrative on oil for the last year and a half has actually pushed out a lot of interest out of oil. And once they start to see that this market is actually getting tighter, then we'll see a lot of flow coming into that oil side to push up prices.
Nadia, thank you so much for joining us. Nadia Martin-Wiegand, Director of Sveland Capital. Coming up, we'll delve into the world of peer-to-peer luxury fashion with the Chief Executive of the clothing rental app By Rotation. That's coming up next, and this is Bloomberg.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top of the bottom, make the sushi shape more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Anand, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Schroders succumbs. The storied London company agrees to a £10 billion takeover by Nuveen of the U.S., creating one of the world's largest active asset managers. Donald Trump's trade policies face their biggest political challenge to date as 6 House Republicans break ranks to vote against his levies on Canadian imports. Plus, traders bet on fewer Fed cuts this year after a strong U.S. jobs report, payrolls rising by the most in more than a year. So traders have lowered their expectations for Fed rate cuts this year after strong employment data. Let's bring in Ven Ram, Bloomberg Markets Live cross-asset strategist. Ven, I'm going to ask you about correlations. I'm going to ask you about rotations. But first, is this kind of jobs report good news for traders, even if it gives the Fed a little bit more room to stay put?
Morning, Francine. I think, yes, it is good news for traders, particularly for equity traders, because it means that, the jobs market is doing fine. The U.S. economy is roaring. So, and the Fed is going to be in a situation where they want to be cutting rates, even though perhaps they shouldn't be cutting rates. So that's the bowl is fully flowing over. The punch bowl is fully overflowing for equity traders. But if you look at treasuries, Francine, I think there's a message there. If you look at the 2-year yields, we haven't meaningfully come off 350, and we keep coming back to that level. Since September, we have bounced, we have not able to go below that level. And if you look at the long-term 10-year yields and above, they are also not coming off 420 levels. So there's a message in for the Fed there that even if you cut rates, the markets are going to be increasingly skeptical whether yield should accompany them lower together.
Ven, the dollar's reaction to payrolls, a little bit anemic. So, this quiet quitting, how should we look at tomorrow's CPI?
Well, I think that, the dollar is moving a bit away from the data, if you will, Francine. But I think there is a bit of risk premium. There's considerable risk premium priced into the dollar. That's to the tune of 4% and more. And that's down to erratic policy making and also the fear of investors that the U.S. administration wants a weaker dollar, despite all that they say outwardly, particularly because President Trump said so explicitly last month. And we are also heading into the midterm elections. So there's a fair bit of skepticism. Dollar shorts are building. So I don't think there's a good atmosphere to be constructive on the dollar.
Okay, Ven, thanks so much. As always, Ven Ram there, Bloomberg Markets Live. cross-asset strategist. Now, onto a bit of fashion, a bit of luxury. Hermès sales grew on robust demand for its coveted Birkin bags. The French bag maker is one of the industry's most resilient players, chalking up gains across all of its markets and most of its products. Well, for more, we're joined by Deborah Aitken, senior analyst at Bloomberg Intelligence. So what are we to make? I mean, I feel like they can't do any wrong, Deborah. I mean, it's a bag maker. It's like the luxury company that everybody wants to be or wants to own.
Absolutely, a totally unique model, so true. But, you know, one of the things, so we saw 10% growth, the market's struggling in the first quarter. We saw that growth move from 7% in 1Q to 10% in the fourth quarter, a solid outlook for next year. But actually, their leather goods is 45% of the business now versus 5% a few years ago. It's only on limited number of designs, but then it's doing really well in ready-to-wear, in home, in jewelry, back to growth in second half in watches as well. So you're right. So compared to so many of the peers, you could label it in that way.
I mean, if you look at the PE valuation, right?
Yeah.
I mean, it's just also really strong.
Yeah.
They haven't put prices up by as much as some of the others.
So they always put the prices up in the way that manages their cost base. So actually, in the for 2026, they say 5 to 6%, which will still be quite robust versus probably 3 to 4% elsewhere. And that's on the back of their artisans, the new products to market, their production sites, and others. But also, these companies in France are facing bigger corporation taxes again into the second year with that surcharge, high currency exposure. And then you have the US tariff as well. They can manage that. And what separates them really, aside that top line, is very much the fact that they grew gross margin, operating margin, beat consensus, and they run their EPS in line with reported revenue growth last year, 2025.
Deborah, we love talking luxury on this program, and it always also often comes back to look where, there's too many luxury products, there's maybe too many luxury companies, but also we're going to have a good conversation with the founder of Buy Rotation about secondhand. This is peer-to-peer lending. But actually, are you seeing more of a resurgence of secondhand, and does that mean that people are buying less?
You would think, if I look at social media, there's a lot more, for example, Hermès and Louis Vuitton, because Louis Vuitton is much higher volume. There's a lot more around, and there are those who wish to have real heritage, something that is 20 years old plus, which is craved for, and also with Christian Dior and others, Chanel. However, it is high end. And then there's the mid end, which doesn't really hold the price so well. No. So, for Hermès, you're waiting in a queue often still for the product. So it is a way to own prior to where you would be in the queue. Yeah. And so the Hermès CEO would say he's not bothered by that. It opens up the brand to the mid-market type of thing, but he's doing that from a lower volume. And I think there is for use, for pre-love, for second-hand, a way forward for all of this industry, because we are getting growing middle classes, and that is helping, with some of that demand to be swept up in that area.
So interesting, Deborah. Thank you so much. Deborah Aitken, they're a senior analyst at Bloomberg Intelligence. Now, if the typical Hermès bag is out of reach, but you'd still like to raid the wardrobes of style icons like Dame Helen Mirren or Ellie Goulding, you may have come across Buy Rotation. Often described as the Airbnb of designer fashion, this peer-to-peer platform offers a red carpet look at a fraction of the cost, or helps you build a side hustle by monetizing your own wardrobe. Well, Buy Rotation's founder, Ishita Kabra-Davies, is with me now. Ishita, thank you so much for joining us. I remember speaking, almost when you launched actually Buy Rotation. And again, the idea is that if I have a wedding or just have a big event, I can rent from someone else and then rent it for a couple of days. Like, are you surprised by the kind of growth you've had?
Yeah, and I think the interesting thing is that we started off with a pretty low average order value, where it was more about contemporary clothing, which Deborah just spoke about, and now you can rent things like a very rare Hermès Anemone Kelly Puchette bag on the app. So it's really become much more about rare, vintage luxury and access rather than ownership.
Yeah, and it's amazing how actually I do feel, especially for the younger generation, there is a little bit of a shift. It's a lot of them say, well, I don't need to own it, but I'd like to wear it for social media. Or, I mean, is it different, depending on the age of your customers, on what they want to buy and where?
Certainly. I mean, we've obviously categorized our customers. You've got some who are renting for things like graduation, some who are renting for holidays and weddings, and then you've got some who are actually trying to rent and try items before they actually invest in buying them. So, I recently rented this Chanel bag, which is worth over £9,000. It's from 2019, so you can't even buy it anymore. And I rented it for £150 for a week, had lots of fun with it, and then I realized it's not something I would actually buy. So it's something that you can use even to try before you invest in that piece. And we talk a lot about investment because we are seeing fashion as an alternative asset class of its own. So you can rent out your pieces and make more than £200,000 on the Buy Rotation app, and that's in addition to your full-time job.
That's really quite impressive. You're also announcing a strategic partnership with Uber, and this is, again, it just goes back to people want things pretty fast.
Yeah, and we're talking about fast fashion, but not as in fast, low-quality fashion. We're talking about fashion on demand. This beats a lot of luxury e-com retailers who can only do next-day delivery, whereas with our partnership with Uber, you could rent something that's in your neighborhood because you can find out what is around you at the moment on the app, and essentially send an Uber courier, as we have a partnership with them, and get it within the hour.
Ashita, I mean, we talk to a lot of entrepreneurs to try and figure out what you think the funding environment is like. Is it tough being in the UK at the moment? Is there demand? Do you have enough funding? Is the government helping?
Yeah, I mean, we are very lucky that I believe we are the winners in the UK when it comes to rental and peer-to-peer. We really position ourselves more as a tech company, so more of the sharing economy, and we have partnered with the likes of Uber and Airbnb. For us, there is a lot of growth potential in the US, where we launched a couple of years ago, and we're also looking at the UAE. So for me, while UK is very much our headquarters and we're very proudly British, we dress Lady Starmer, for example, we are very much a global company with global ambitions, much like myself as a private citizen.
Is there more, I mean, is there more, I guess, is there more rivalry, or do you have more fierce competitors in the UAE or the US?
I would say probably in the US, because in the UAE, secondhand, they're still kind of coming to terms with it. I'm from Singapore myself, and there is a big stigma around secondhand. But I think attitudes and, the way that they look at secondhand will eventually change. The US is more rife for it, I think. You've obviously got the tariffs, which make secondhand much more attractive. You've also got access to European goods, again, the Hermes, the Dior's, and you can get them secondhand by renting them, forget even buying them. So the amount that you're spending to rent these items, for a week is like 3% versus buying them secondhand for 70%.
Ashita, when you look at the UK, is there anything that the government who could help actually entrepreneurs like yourself?
I think, continue to support and champion, especially investments into female-founded businesses. I think there's a lot of lip service around that. There's a lot of mentoring programs. I have said before at the UN as well that women don't need mentorship. We need funding. So stop telling us about all these programs and actually put your dollars where your mouth is, or whatever that saying is.
Is there enough capital going into female-founded companies?
Not enough. Never enough. There could definitely be more. And I think on the consumer side as well, especially since we position ourselves as a social network, a lot of the social networks are all born in the US. There seems to be no winner in the UK and Europe, which is such a shame because there's so much culture here.
If you were to start the company now, would you do anything differently?
I don't think so. I love peer-to-peer, and actually, very interestingly, we are the business model that has survived and, been through the trials and tribulations. If you look at quite a lot of the other players out there within rental, they're very inventory-based. They're very heavy on their CapEx and OpEx, sorry. And I think what's really interesting for us is that we are transforming how fashion is consumed altogether by unlocking a third of your wardrobe that's just sitting there and not doing anything. It's really an asset class.
Ashita, thank you so much for joining us, and check out Buy Rotation. Ashita Cabra-Davies, founder of Buy Rotation. How much growth are you expecting?
We're expecting 3x.
There you go, 3x. Now on to another corporate news, and Siemens has raised its outlook on growing demand for data centers and its factory automation products. Now the German industrial company benefiting from its move into industrial software and artificial intelligence solutions. The chief executive has been speaking to Bloomberg's Tom McKenzie.
We will see how dynamic, how fast AI is hitting really the real world. We believe that this happens very fast. But from that perspective, we see still there's a good growth. There might be shortages on power supply or supply maybe on GPUs. But since the supply chain is also ramping up, we believe that this keeps on going.
And you think that the CapEx spend, the commitments from those hyperscalers, $650 billion potentially this year, that is rational?
I mean, I didn't make the math of all the commitment which everybody gave, including the investment banks. Adding that up, there might be a slippage, but if you take even a slippage into consideration, still enough money for a market to keep on going.
And you've got a record backlog now. About 120 billion euros is the backlog. What are the constraints around delivering that backlog? Are you able to deliver on those orders?
Clear, yes. I mean, we really invested early enough. So we doubled our manufacturing capacity for medium low voltage in the United States, exactly for data centers. We increased capacity for rolling stock. By the way, big backlog comes also for rolling stock. So we have capacity. We invested in capacity, also in capacity for our automation devices. So that's not a problem. We will deliver.
There is a currency impact. How and to what extent is FX impacting you, particularly euro strength, and how are you looking to mitigate that? Are you taking any hedging strategies around the currency?
I mean, we always do some hedging in the background. The impact, I think, is something like 50 basis points, and we planned the fiscal year on this weak dollar, and so therefore that's part of our planning. If that stays in that ballpark as we see today, that's part of our forecast and our planning.
Okay. You talk about the software part of the business. We've seen a significant sell-off, including industrial software names, in the last couple of days. What do you make of what we've seen there? How defensible is industrial software from the evolution of AI and some of these products being put out into the market now?
So we know that AI has the potential to disrupt some of the software businesses. I mean, if you talk about software which runs on call centers and the like, I mean, that's fully on the block. But if you go on the other end, on industrial software, simulation software, physics-based software, we don't see that at all. We rather see an enrichment of the software, which allows more and more customers to use it. Take, for example, simulation. Simulation is costly, takes a lot of time. Using GPUs, we can accelerate it 100 or even 1,000 times, making it accessible. Yet, the point is that you always want to frame it with the physics, because hallucination is not an option on a shop floor, neither in your designs. And this is where physics comes in. It always gives you a confinement of what really is right and wrong.
That was Roland Busch, the chief executive of Siemens. Now, Verisure shares slumping today after the security services company reported fourth quarter earnings that missed estimates. Verisure's shares fell below their IPO price for the first time last week after being caught up in the AI disruption sell-off. Now, the chief executive has been speaking to Bloomberg about the impact of the technology.
We're obviously actually an AI beneficiary. We're going to demonstrate that progressively over time. We're already using AI to great benefit in many aspects of the business. If I take maybe the core of what we do, which is the security service that we provide, I mean, it's basically what we call detect, verify, intervene.
Yep.
We're actually using AI algorithms already to do a better job of analysing incidents, right, of confirming whether it's, in a sense, a false positive or real. And we think we do that better than anyone else.
Coming up, normally on the same page, but maybe not right now. President Trump hosts the Israeli Prime Minister in the White House. We have the details on what the visit means for Iran. That's next, and this is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg. Nuveen is buying Schroders in a £10 billion deal, creating one of the world's largest active asset managers with nearly $2.5 trillion of assets. Speaking exclusively to Bloomberg, Richard Oldfield, the chief executive of Schroders, says the deal will make the company into a powerhouse.
Well, Guy, I'm going to take us back a second. So there were two announcements this morning. The first one was our results, and it's important as context to the deal. Our operating profit was up 25% to 757 million. EPS is up 39%. This is a great business. It's in a really strong foundation. But what we are doing here is creating this powerhouse of asset and wealth active management. It's going to have an unparalleled breadth of public to private capabilities. And at 2.5 trillion, it gives us the firepower to actually invest in our business and make ourselves more relevant to clients. It's a business combination that's almost perfect on paper. We have total complementarity. There's no overlap in geographies, really. There's very little overlap in products. So we're about growth. We're not about taking money out of the system. We actually drive this business and create something really powerful. And the cultures fit. The heritage, the 300 years together, so it's not just, you mentioned our two centuries of history. Nuveen comes with more than 100 years of history as well, and that actually helps us have very similar cultures. And as you mentioned, Guy, this is all about the City of London. We put that right at the heart of the deal, making commitments to the UK and London.
Richard, did they call you? Did you call them? Where did the conversation start? How did it go? Kind of just give me a bit of colour here.
Well, as you'd expect of the last year, I've been talking to many of my peers around the world about how they respond to the industry challenges that we've got. And what became clear as I met Bill is that we had businesses that were very similar, and we discussed the complementarity. And that led to them approaching us with an offer earlier in this year.
Richard, good morning to you. So you mentioned there that this is about having the firepower to invest. Would it be right to say that AI has changed the landscape, and the requirement to invest in that technology to find that an opportunity rather than a threat means that it's better done with a larger business? Is that one of the drivers?
Well, that's definitely one of the drivers, because the scale of this operation will be able to create more capacity to invest in our business. And it's not just about AI. Actually, when you think about our industry, it's about tokenization and distributed ledger technology. It's about reshaping our industry, about different distribution models. And yes, it's about AI in terms of how we do research, how we do portfolio construction, how we access wealth clients. So I think there's a whole range of technologies here that are going to transform our industry as other industries, and we need to be right at the forefront of that change.
You talked about making commitments around the City of London, Richard, and we read in our stories this morning that the London is going to be the headquarters of the non-US business. What do those commitments look like, though? How watertight are they?
Well, they're all listed in the 2.7 offering document, and I think Nuveen have been pretty clear. London will be the non-US headquarters for at least 5 years. There are commitments about jobs over the subsequent 2-year period. We'll have about, to put this in context for you, Anna, there's 3,100 people in the combined group right here in London, and that's the largest location of any office for Nuveen, and it would be about a third of the overall workforce. So this is a big, sizable presence here in London. We're not stepping back at all from our commitment to support the UK capital markets, be at the centre of how policies are formulated, be at the centre of how people come to market. So I think the commitments are very watertight and they're very real, and I think it just shows the size of the UK and London in the overall group.
Well, that was Richard Oldfield, the chief executive of Schroders, speaking exclusively to Bloomberg. Now, U.S. President Donald Trump says he intends to press ahead on talks with Iran, despite reservations from the Israeli prime minister who was in the White House yesterday. Let's bring in Ethan Broner, our Israel bureau chief in Tel Aviv. Ethan, thank you for joining us. So President Trump and Netanyahu normally aligned in their worldview, but will Netanyahu be disappointed this time?
Well, I think you're right that in this particular case, the president is more eager for a deal. The Israelis really don't believe that it's worth negotiating with Iran, that this is a regime that is uncompromising and will not step down from its anti-Israel, anti-Western ideology. So I would say that the Israelis were certainly Netanyahu was certainly somewhat disappointed, but, you know, we have to wait and see. There's another carrier group possibly on the way into the region. And, you know, there are several issues the Israelis want the Americans to press Iran on. I think that President Trump is aware that a quick military activity is unlikely to take down this regime, and he doesn't like long engagements. He wants quick, decisive action, and I think he's hoping that a deal will get further in that direction than a strike. So we'll see. There is tension, it would seem, between the two over this.
Ethan, also the agenda, Trump's so-called Board of Peace. So what was discussed?
You know, I mean, the big issue for the Israelis is disarming Hamas. And so far, there's no evidence of anyone able to disarm Hamas except for the Israelis, or if they go back to war, to do so. The Americans say they have a plan in which Hamas will disarm voluntarily, and perhaps the arms will be held somewhere in storage. Everyone is pretty skeptical of this. I think we have to see where this goes. But it does feel like, to be on this particular issue more than on Iran, that the Americans are willing to see the Israelis go back in, if necessary, at least on a short-term basis, if nothing else works. At least that's what's being held up as a threat, in the same way that these carrier groups are being held up as a threat. It's very hard to sort out, you know, the theater of it from the reality of it, and my guess is that the leaders themselves aren't quite sure the difference at the moment.
But Ethan, what does each party want from each other?
You mean between the United States and Israel?
Yeah, and Israel. Mm-hmm.
Oh, I mean, the Israelis want, of course, no daylight between them and the United States. They want the United States to agree that the future of this region is only secure if the regime in Iran is ultimately taken down or forced out, or enough pressure is put on it for it to go. That's certainly what they want. The Americans, I think, have more belief in diplomacy. They also seem to think that this government shouldn't last, but it's not clear to me how much they want to invest in taking it down.
Ethan, thank you so much. Ethan Broner there, Bloomberg's Israel bureau chief in Tel Aviv. Now, The Pulse is live from the Munich Security Conference tomorrow. We'll be joined by big guests, including the executive director of the Aspen Strategy Group and the vice chair of PIMCO. Up next is Bloomberg Brief, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically
that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's 5 a.m. in New York City. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Traders paring back rate cut bets following that payrolls report. Jobless claims up next. Stocks recovering from another AI scare trade, while Anthropic inches closer to a deal that would value the firm at $350 billion. And midterm anxieties rise for President Trump as the House passes a bill targeting his levies on Canadian imports. So futures are pointed higher today. Now, yesterday we had another AI rolling scare. This time it was real estate stocks. The previous day was wealth stocks. Every time an AI tool gets rolled out, the whole industry seems to decline. We did have a positive session in Asia, though, and maybe the market is moving on and from these scares. But we are seeing a very definitely positive futures session. Now, yesterday the S&P was unchanged and the Nasdaq was up 0.3%. So these sessions are being capped by whatever the current AI story is. Let's take a look at the bond market because, of course, the payrolls report is really what's in focus as well. It was stronger than expected, but was it really enough to change minds at the FOMC? We're back really into the range that we've been at. The curve, albeit flatter. We're at about 66 basis points on the 2-10 spread now, with the 2-year yield at 350 again, the 10-year yield just below 416, and that 30-year yield below 480. Not a whole lot happening with metals, but we are seeing gold continue to stay above $5,000. All right, we'll get into all of this in just a few moments, but first let's get to some individual movers. For that, we'll go over to London and Abir Abu Omar. Abir.
Hey, Vonnie, we're sticking with the AI story this morning, starting with Cisco, which is pretty down this morning in the pre-market, almost 8%. And why? Their results yesterday that came out post-market suggested that the sales were good on the AI outlook, but their margins are really hurt by this crunch, this unprecedented crunch in memory chips. So that crunch and Cisco is obviously a user of those chips. That crunch has sent prices skyrocketing, and that's been affecting what we're seeing in the stock this morning. Although the company did say that they're handling the shortage better than peers. And again, sticking with the AI trend, we turn to AppLovin, another stock that is down this morning in the pre-trade, almost 5% down. It spared some of those losses from earlier, but it's really suffering from the AI boom. It's been painted as one of those stocks in the laggards basket of AI. It's down 30% so far this year, and we're seeing that investors are not taking kindly to the results from yesterday. Finally, we turn to some good finance, good old finance, with Schroders, which is trading this morning in London, up almost 30%, and that's on the back of the Nuveen deal that we heard about this morning. Vonnie, we had an interview with the CEO who said that the UK will remain a key focus for the combined asset manager, but the majority of the AUM will be in the Americas, over 50%. Vonnie?
Yeah, lovely move there for Schroders. Abir, thank you so much. We'll chat to you again later in the hour. That's Abir Abu Omar. Also coming up this hour, more data on deck this week. We're going to take a closer look at the economy with Priya Misra of JP Morgan Asset Management. So, traders pushing out bets for a first rate cut this year after that stronger than expected jobs report, now seeing a first cut in July. Kansas City Fed President saying that the Fed should hold rates at a, quote, somewhat restrictive level, adding that further rate cuts risk allowing high inflation to persist even longer. Bloomberg's Ven Ram joins us now for more. So Ven, is the economy in good enough shape, and can we tell from just that one jobs report for the Fed to wait literally a whole 7 months for a first cut?
I would definitely say so, Vonnie, because the jobs report was pretty strong and it laid low the claims that, you know, this is a low-fire environment. If you juxtapose the strong jobs report together with the productivity gains stemming from AI, it kind of suggests that the US economy has got plenty of momentum behind it. Now, should you be cutting rates into that environment? Now, the Fed thinks that the economy is going to grow 2.3% this year, with core PCE at 2.5% this year. Those inputs mean that the Taylor rule rate is suggesting that the Fed funds rate should be 3.75, exactly where we are now. So where is the room to cut rates, especially if the economy is going to overshoot in terms of growth and inflation also staying much above 2.5%, the Fed's inflation target. So there is no wiggle room for rate cuts here, and which is why you hear Fed speaker after Fed speaker say that there is no room for rate cuts. We are already at neutral. Any more would fan inflation. So it's definitely not the prescribed measure here.
Sure, but then were those fears over the labour market that we had before the holidays, so at the end of last year when the Fed switched its focus really to the labour market side of the mandate, were they then misplaced? And can we tell that from just this one delayed job report?
Well, I mean, that's a fair question, but I think that on the whole, if you read the tea leaves in the economy, Bonnie, I think what you get, I mean, you can barely argue that there is a case for back-to-back rate cuts here. This is an economy that is firing well on all cylinders. Okay, we are in a low-fire environment before we got this latest report. But so that kind of suggests that the economy may be cooling, the jobs market may be cooling, but there are productivity gains stemming from AI that can't be wished away. So I think that, you know, the Fed has to err on the side of caution and can't be cutting rates and stoking inflation when it has already missed the target, inflation target, for several years in a row now.
All right, well, we do get CPI tomorrow, and we did find out that wages grew pretty healthily in that jobs report as well. Ven, thank you so much. That is Ven Ram there of our MIve team. Turning to tech now, and Anthropic close to raising more than $20 billion, one of the largest startup funding rounds ever. Backers, including Peter Thiel's founder fund and D.E. Shaw, it would value the company at about $350 billion. Joining us now is Tom McKenzie, host of Bloomberg Tech Europe. Tom, in some ways it feels like we're back in the old VC era where people just didn't want to be left out of anything that might turn into, you know, the next, what used to be a unicorn, right?
Yeah, Vonnie, and to the extent they don't want to be left out, you're getting investors who are invested in two major competitors at the same time. You've got OpenAI, so some names on that list, on that cap table for Anthropic, also on the cap table of OpenAI, two fierce competitors, of course, so that speaks to that desire, as you mentioned, to not wanting to be left out in terms of the developments and evolution that's coming through. So, Anthropic, $20 billion, that's according to our reporting in terms of this latest fundraising deal, valuing, to, as you said, the company at around $350 billion US dollars. Just for size and scope and for context, that puts it above, in terms of market cap. If you're looking at Netflix, it's a similar kind of market cap to Netflix. The market cap of Netflix is similar to that level of valuation. It puts it above the market cap of Goldman Sachs, significantly above Disney. So that's the kind of size we're talking about in terms of the value of this company now. So yes, we had Peter Thiel's VC fund backing this, one of the co-leads, but also you had Cotu, you had MGX, and other significant names getting behind this deal. And this, of course, after a really significant spotlight on the Anthropic, with the latest model coming through, very much focused on the coding space and on the financial space as well, financials and engineering, and on the back of this plugin that really disrupted the legal sector. And so Anthropic has been getting a lot of headlines. Now it's racking up this additional investment. And again, there has been reporting suggesting that this is a company that's looking to IPO at some point this year. It seems they're finding no trouble, at least, raising capital in the private markets.
Well, bets in these types of companies, in this case OpenAI, seem to be paying off. At least they did for Masayoshi Son. SoftBank swinging to a profit on the valuation boost from OpenAI, but it's very tethered to that now, right? It's very tethered to the success of ChatGPT, essentially.
It absolutely is. Look, we're talking about the quarterly earnings of SoftBank, and central to that was that stake, about 11% stake that SoftBank now has in OpenAI. It has sold down its stakes in NVIDIA. It's under a bit of pressure because it has 90% stake in ARM, the semiconductor maker, of course, or at least designer of those platforms, and that company is under pressure. But it is the OpenAI story that's paid off for them in the most recent quarter. They came through with a profit. It was actually a miss versus the estimates, but it's the fourth straight quarter of profits, and year on year, you were looking at a loss, and now they turned to profitability. So that's positive. The gains from OpenAI in that bet, around $20 billion in terms of the value of their stake right now, and the increase that they've seen on OpenAI. And SoftBank are in talks, according to reporting, to potentially put another $30 billion. They've also already invested about $30 billion US in OpenAI. They're looking, according to reporting, to invest potentially another $30 billion in OpenAI.
We got some more positive comments about the AI industry, if you like, if you can call it that, from Siemens, the CEO, saying, look, essentially, you know, industrial demand is off the charts. I mean, how is Siemens benefiting from this that the likes of, say, Cisco is suffering from because Cisco can't get enough memory?
Yeah, so I was speaking to the CEO, Roland Busch of Siemens, about this. You can see the share price reaction there. So investors welcoming this news, and they have really benefited from shifting away from industries like the auto sector. They still see challenges there, to really focus on the data center, on the electrification story, on the design software story as well. They've been quite acquisitive in terms of buying design and industrial software companies. And I asked the CEO whether he's concerned about AI disruption in that space. He said absolutely not, because of the complexity of that kind of software. He thinks it's very, very defensible. But the key takeaway was that they are seeing this massive demand, huge backlog, in fact, for the build-out of data centers. They have a lot of skin in the game on that front, and that really is driving momentum for Siemens, both on the software front, but also on providing that electrification for the data center growth. And he said the US market is looking very strong for Siemens.
We'll have to take a look at that Siemens interview once again. Tom, thank you so much. Great interview. Bloomberg's Tom McKenzie. And do tune in to Bloomberg Tech Europe with Tom as he takes a deep dive into quantum computing. That's this Friday. In Europe, Schroders surging in London as Nuveen set to buy the asset manager in a near $14 billion deal. Bloomberg spoke with Schroders CEO Richard Oldfield earlier.
What we are doing here is creating this powerhouse of asset and wealth active management. It's going to have an unparalleled breadth of public to private capabilities. And at 2.5 trillion, it gives us the firepower to actually invest in our business and make ourselves more relevant to clients.
Joining us now is Bloomberg Asset Management reporter Leo Kenscherper. So thanks for joining, Leo. What do these companies have in common, and what will be additive to the combination?
Good morning. Yes, so I think it's fair to say that these are two companies with strong legacies. So Schroders was founded more than 200 years ago, one of these big City of London institutions. And you also have Nuveen, which was founded in the 19th century. So the companies were really keen to tout that. Schroders' issue over the past 20 years has been that they haven't been able to build that scale in private markets that they really that they really needed to become a one-stop shop, you know, for institutional investors. And this is where Nuveen comes in. Schroveen, as one of my editors has called them earlier, will have about 17% of combined AUM in private markets, and overall the group together will have 2.5 trillion in assets under management, and this, you know, puts them in a position to rival players like Capital Group, for instance, which is the world's largest active-only manager.
Yeah, I mean, and it's a phenomenal premium for Schroders as well. Was Schroders undervalued, or what's the story? Why the 30% move up to the deal price?
Yes. Yes, exactly. So the share price hit an all-time high in 2021. That was the post-COVID liquidity, post-COVID boom. But since then, it's been down roughly 25%. And so this premium, I think 29% to yesterday's close, sort of reflects that. So it's not a, I wouldn't say it's a massive premium. It's just, you could argue, if you were on the board of Schroders or if you were a shareholder, maybe should have done this deal 4 years ago.
Yeah. Leo, what else should we be looking out for in terms of deals in that space? Any more huge ones potentially on the horizon?
Yes, so anyone you ask in financial services deal making will confirm that US asset managers are increasingly looking at European players and UK players in particular because they trade at a slightly larger discount. So now who's left here in the UK is Aberdeen. They still manage around 500 billion in assets, and there have been various rumors, at least over the past few years, about them. There's also Man Group, which is more of a hedge fund player. They're also London listed, and of course you've got slightly bigger players in Europe, DWS and Amundi, similar size to Schroders, DWS in particular. But, of course, they are still very much digestible for a larger US player.
Yeah, absolutely. Fascinating space. Leo, thank you so much for joining today. That is Bloomberg's Leo Kensherper. Now, to other top stories trending on the terminal this morning. The Republican-led House has passed legislation aimed at ending President Trump's levies on Canadian imports. The vote is the strongest political blow yet for the president's tariffs policies and signals growing anxiety over his economic agenda ahead of the midterm elections. President Trump is almost certain to veto any bill. The US and Japan are closing in on the first 3 projects to be funded by Tokyo's $550 billion investment vehicle. The projects are part of a bilateral trade deal, and sources say that 3 considered finalists in a review process are related to a data center, a deep-sea oil terminal in the Gulf of Mexico, and synthetic diamonds for semiconductors. And Morgan Stanley boosted CEO Ted Pick's pay to $45 million in 2025 after a record year. That's a 32% increase over the previous year, Pick's first at the helm. 3/4 of the bonus will be deferred over 3 years. Coming up, Hermes says strong sales were in line in the quarter, and it's all thanks to the Birkin bag. More on how the French bag maker remains one of luxury's most resilient players next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. 24th, as affordability, immigration, and national security dominate the headlines leading into the midterms, President Trump will deliver his State of the Union address. Balance of Power will bring you live global coverage starting at 8 p.m. Eastern.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Shares of Hermes are rising after demand continues for its coveted Birkin bags. The French bag maker is one of the industry's most resilient players as it caters to the most exclusive clients. Joining us now is Deborah Aitken, senior analyst at Bloomberg Intelligence. So a fantastic quarter for Hermes, but it wasn't thanks to perfume or beauty or anything like that. It was really all thanks to the Birkin bag, Deborah. And my first question would be, is this because people are buying an investment? Or is it genuinely that they have dollars to spend on luxury items? Because they would be very different reads of the US and foreign consumer.
Hi, yeah, it's very much domestic driven, and it is by those individuals who generally own more than one of the product within the brand range. You know, and actually, we've seen the Birkin bag, yes, still very strong. Other brands and styles strong too. But now leather goods is 45% of sales. It used to be 55%. So also for Hermes, there's quality within homewares, ready-to-wear, jewelry, and others, which are also driving this growth. So we saw growth 1Q 7%, 4Q 10%. So some momentum building.
How is Hermes dealing with the global tariff environment and just this turn inwards on the part of many countries now? Can it, you know, get the raw materials it needs, you know, get the labor it needs, and still keep those margins healthy?
So very vertically integrated, that's one of its core strengths, a major core strength. It's artisans. It takes on around 250 new artisans a year. It adds one production factory per year. And what it did last year, particularly for the US, we saw high single-digit pricing. Generally, across the board, it's 5 to 6% pricing, which they'll carry through into 2026 as well. And for it, and why it stands out versus its peers, its premium valuation, is because that helps it absolutely to not only manage margin, but to grow margin. So we actually saw operating margin up over 100 bips, beating consensus very nicely. Gross margin up over 100 bips, beating consensus nicely. Operating margin up as well, and carrying through what it did on the net on revenue to the EPS line, despite those tariffs, the extra surcharge on corporation tax in France, headwinds from currency and others. So that's a very solid set of results.
Hugely impressive performance. Deborah, what about L'Oreal? Because we get results from L'Oreal later. A little bit of a different consumer, but what should we expect?
Yeah. Again, momentum from 1Q through to 4Q. So the market generally is looking at just over 6% sales growth, like-for-like sales growth in the 4Q. We're hoping L'Oreal will come through and give market growth projection for the whole beauty market of around 4% this year, 4% plus, which would be a little bit better than 2025. 20 bips operating margin improvement, which is typical for their model, and that we're expecting to see looks come back. All these companies have big exposure in Asia. China duty-free would still be a drag, but China domestic should be rebuilding. Luxury over there rebuilding. Derma globally rebuilding. And actually the biggest growth is set to come from around 7% from the US. Wow. So we're looking at them doing very well in premium in the US and holding their own in mass.
All right, Deborah. A nice quarter for some of these players. Thank you so much, Deborah Aitken of Bloomberg Intelligence. Coming up, AG Pam Bondi under fire over her handling of Epstein in a congressional hearing. More on that. And what else is making headlines in your front page news next? This is Bloomberg.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Used to be one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
For your front page news. And first up, the Washington Post leading with Attorney General Pam Bondi defending her leadership of the Justice Department before House lawmakers. She testified before the Judiciary Committee, where she was pressed on her handling of the Epstein files and prosecution of President Trump's political foes. The Post says the hearing comes at a critical time for the Justice Department. Next up on the Wall Street Journal, the Pentagon has told a second aircraft carrier strike group to prepare to deploy to the Middle East. This as the U.S. military readies for a potential attack on Iran if negotiations fail. U.S. officials caution that President Trump hasn't yet given an official order to deploy the second carrier and that plans could change. And finally, the Financial Times reporting Microsoft is pursuing true self-sufficiency in AI by building its own powerful models and reducing its reliance on OpenAI. This according to an interview with Microsoft AI chief Mustafa Suleyman. Do stay tuned. We're going to be speaking with Priya Misra of JP Morgan Asset Management next.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Bloomberg has learned that there are discussions around a potential all-cash offer for Warner's studio and streaming businesses.
For the past few years, we hadn't really seen any deals above $30 billion, and now we're seeing,
Warner Brothers, $80 billion, the big railroad deal. And what we're hearing from sources is that next year we're going to see more of the same. It's just going to be the mega deal.
I would expect next year will be an even better year for M&A and IPOs.
That's just kind of what we do at Serena Ventures, is just kind of learn how we can fill in different gaps in different areas that are being missed. And by the way, these gaps tend to be really, really massive.
I know you've been very bullish on the return of M&A. Do you expect more deals, if they are of this size, to have the same sort of structure and contours?
I think we're going to see the return of large transactions, and I think they're going to avail themselves of both private credit options and public options.
There's a lot of merger talk. There's a lot of firepower.
You know, investors wanted to know at what price would this deal be, and now they answered that question at $70 a share.
So congratulations to Bloomberg's Deals team for getting it first.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
It's 5:30 a.m. in New York City. Good morning, I'm Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Traders paring back rate cut bets following that payrolls report. Jobless claims up next. Stocks recovering from another AI scare trade, while Anthropic edges closer to a deal that would value it at $350 billion. And midterm anxieties rise for President Trump as the House passes a bill targeting his levies on Canadian imports. So let's look at those futures, all in the green after a flat day for the S&P 500 yesterday. The Nasdaq 100 was up just 0.33%. Those gains capped by the latest AI scare trade. It was real estate yesterday. We did have a good session in Asia overnight, though, setting the tone a little bit today as well. And of course, the payrolls report, which came in better than expected. Let's look at bonds because we have a bit of a flatter curve. 66 basis points now, the 2-10 spread, 350 on the front end, 479.81 on the back end. I do want to point to Yardeni Research today coining the whole AI trade AI-phoria or I-phoria, but also admitting that it's taking no prisoners, and that's indeed what we're seeing in corners of the market. But does it all play out in a week, or does it take longer than that? Well, we'll see. Let's get to some of those stocks, though, moving. Let's get to London and Abir Abu Omar. Abir.
Good morning, Vonnie. We're focusing on the winners and losers of the AI trade, starting with Cisco, which is not really having a good morning in the pre-trade, down almost 8%. Now, why is that? Their results were not terrible yesterday, but the stock is really hammered by this crunch in memory chips that is sending those prices soaring. But the CEO did come out and he said that although, you know, the memory chip crunch is weighing on the stock, it is set to benefit more, or it's set to do better than peers that are struggling with the same issue. Turning to another stock, Vonnie, that is doing incredibly well this morning, we turn to Fastly first. So Fastly is one of those stocks that are benefiting from the AI boom. Essentially, what the CEO has said is that as we turn into this year, 2026, Fastly is going to be one of those companies that is really benefiting from the tailwinds of AI. So we speak a lot about, you know, the macro picture when it comes to artificial intelligence and disruptions in different sectors. But Fastly is one of those winners of the AI trade. And finally, already trading Schroders, and Schroders was up more than 30% this morning. It's pared down some of those gains, but still massive increase in the stock, and that's on the back of some good M&A news. It's being acquired by Nuveen for a deal that is worth almost 10 billion pounds or $13.5 billion. So the stock is rising on that news to create one of the biggest active asset managers in the world. Vonnie.
Abir, thank you so much for that. Much appreciated, Abir Abu Omar. Investors are now looking ahead to jobless claims and CPI data after getting past yesterday's NFP report pretty unscathed. JP Morgan Asset Management's Priya Misra still concerned about the labour market, writing, quote, "We continue to characterise the job market as a low hire, low fire one, despite the higher than expected payrolls on Wednesday. Labour market's a bit fragile in terms of hiring trends and breadth." Priya joins us now. Priya, Why are you still concerned about it when nobody else seems to be that concerned about it, including the Fed, which was before the holidays and seems to have forgotten about what might be fragility in the labour market?
Sure. So I think we've had a lot of data. There's, right from whether it's ISM employment that looked like it was sort of stabilizing. The Fed's already cut a lot. So I think the Fed is hoping that the labour market is stable. We do think it's sort of stable, but it's stable at a low level. You look at whether it's household surveys, whether it's business surveys, hiring numbers are still weak. And then, yesterday's report was good, but when we look at that breadth of hiring, it's really education, it's healthcare. We're getting older. That's sort of a secular trend. It's not clear that we're sort of seeing this upswing or any sort of re-acceleration. So in our view, we're in this low higher, but I think we're one number away from, nervousness again. If you see initial claims pick up, if you see another challenger job survey picking up, I think the market will get nervous that if we're transitioning from a low higher to a low higher pickup in firing, I think then the market gets really nervous because I think the market wants to move on to this broadening, this broadening out of the recovery, the fact that, maybe we're sort of re-accelerating with the tax refunds. And I think that then starts to become a question. So I would say we're stabilizing, but we're not re-accelerating.
Was there anything else, though, that gave you a little bit of hope in the report? So we saw wage growth, for example, and it came in better than expected. Now, is that because inflation is a problem and employers are forced to give these wage growth numbers, or is it just because the economy is healthy and they can?
So I think wages, again, the average hourly earnings was picking up, but if you see ECI or the employment cost index, which we got earlier in the week, that was actually weaker than expected. So I would again say we're getting like mixed data signals even on the wage front. Overall, though, and we're going to get CPI on Friday, so we're going to be looking at service inflation. Overall, our sense is, yes, inflation's above target, but a lot of those trends, whether you look at shelter inflation, ex-shelter service inflation, they are sort of heading low. I think that's what will give comfort to the Fed. We do expect rate cuts later this year, and I think it's going to come from inflation, but I agree with you. If wages start to pick up, then maybe there's signs that the slack in the labor market's going away, that is getting tight again. The Fed's going to be watching that. So that was a sign of, maybe the slack being less, but I would say I'm not convinced that essentially wages are picking up.
If there is fragility under the surface and it just hasn't popped out in the data yet, then can we really wait till July for the first next rate cut?
I think the market's pricing in July because the market's looking at the inflation side. And it's going to take some time because we're going to get, some of that tariff-related inflation show up in the data. We don't expect CPI to get closer to 2.5%, until the second half of the year. So to your point, if the labor market stays okay, we stay in this low higher, I think the market's okay with second half of the year rate cuts. If we see a rise in initial claims and we start to see a pickup in layoffs, I think then the market's going to price in sooner cuts. It feels like the market's somewhat on edge. With every data point, we're moving things around. But I would look at the 10-year, and that's where there was nervousness, whether it was Japan-driven, Sell America. Look at the 10-year. We've been in this very narrow range, 375 to 4.25 for a while. It tried to break out. I think the fundamentals of the economy don't argue for much higher rates. So, I think that range is fine. It's telling you that maybe we stay in this K-shaped, soft landing economy, and I think we don't need rate cuts for risk assets to do okay, as long as the labor market stays
So is this a potential scenario that plays out? Labor market fragility shows up little by little over the next few months as we get sort of on-time data. In the meantime, we get the process where Kevin Warsh is potentially the next Fed chair, and that's going to be in the second half of the year as well. And inflation doesn't rear its ugly head as much as maybe some had been thinking. And it all works out beautifully for 2 rate cuts in the second half of the year, and we're fine.
Great point. We do have a leadership change at the Fed, and we know that potentially, Kevin Warsh is going to talk about, potentially cutting rates some more in the front end. But I would argue he's got 1 vote at the committee. There are 12 voting members. He's going to have to get the committee on board. I think for more rate cuts, or even any rate cuts right now, he's going to need to see it in the data. I think the rest of the committee is going to want to see inflation heading closer to that 2%. I don't know if you're going to get to 2, but I think even 2.5 broad-based disinflation, I think can get the committee on board. I know Kevin Walsh has this productivity thesis, but productivity is one of the hardest data points to actually measure. It's a bit of a residual. I don't know if he's going to be able to get the committee on board to cut, but in the second half of the year, I think you can get those rate cuts. The market's really nervous about the balance sheet. I think he's going to have a harder time there to either convince the market that, the balance sheet can be shortened, reduced, or even getting the committee on board, because the committee is increasing the balance sheet. I think rightfully so. Banks require those reserves. The balance sheet's not growing because of, the Fed is trying to help asset prices. It's providing the reserves that is required for the plumbing of the banking system.
Priya, what's looking interesting to you across the bond universe? And I'm not just talking about treasuries or other sovereign debt. I'm also talking about, credit and so on. Is there anything that's looking, like it might be the time to jump in and get some of it for your core bond portfolio?
Great point, because we are seeing a lot of opportunities. So when the market's sort of edgy and there's a lot of supply, we've had a lot of credit supply. Overall, we've seen still continued inflows into high quality credit and dispersions picking up. So I think this is the time when you have to do the work, make sure you understand where are the companies with a good, free cash flow coming in, lower leverage ratios, and we're finding high quality credit, whether it's in the investment grade space, whether it's even, high yield. The double B, single B part of the high yield market, which has widened a little bit, we're finding value there. Securitized credit, another area. So I would say credit, as long as the recession risk feels low, which we still think, even if the labor market is fragile, we're not in recession territory. So that's the time when you want to own credit risk, you're picking up spreads over treasuries, and then we like the hedge of owning some duration, owning some curve steepness. It provides the hedge that if you get one data point that gets the market nervous about the economy, interest rates will work, even if spreads widen a little bit. So I think owning that diversified, portfolio of high quality credit, some duration, I think that's how we're positioned, and we feel confident. If the economy stays as we expect, we're okay, we pick up yield. And if not, we've got that diversification from treasuries.
Something for all eventualities. Priya, thank you so much. Always love having you in studio with us. That is Priya Misra of JP Morgan Asset Management. Now to other top stories trending on the terminal this morning. Nuveen buying Schroders in a $13.5 billion deal, creating one of the world's largest active asset managers with nearly $2.5 trillion in assets. The Schroders brand will be retained, and London will serve as the combined group's non-US headquarters and largest office. Sanofi shares are plunging after abruptly pushing out its chief executive. CEO Paul Hudson boosted research spending, which failed to deliver rapid results. Merck Group CEO Belén Garijo has been appointed as Hudson's successor. And the Waldorf Astoria on Manhattan's Park Avenue is coming up for sale following an extensive renovation. Sources say that real estate investment bank Eastdil Secured is expected to bring the hotel to market on behalf of its Chinese owners. The hotel reopened last year to wide acclaim and high room prices. Coming up, midterm anxiety grows. More on the latest rebuff to President Trump's economic agenda. This is Bloomberg.
Is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
We have 2
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. The House has passed legislation aimed at ending President Trump's tariffs on Canadian imports, adding pressure to the Trump administration agenda just months ahead of the midterm elections. Joining us now is Bloomberg's David Gura. So, David, it is a rebuke, obviously, to President Trump's agenda, but does it go past this? It's never going to become law, right?
That's exactly right. So I think it's easy to say this is a symbolic victory here for Democrats, but they were able to pull over 6 Republicans to support this legislation that had been in the works for almost a year now. Gregory Meeks, the ranking member of the House Foreign Affairs Committee, introduced this law, pushing back on the national security justifications that the president has used here. And we've seen House Speaker Mike Johnson over and over again trying to make it so this legislation wouldn't get to the floor of the House of Representatives. It did, and you had these 6 Republicans crossing over. I think it's important to look at that as an indication that there are some Republicans, some of whom are close to the Canadian border, whose districts do a lot of business with Canada, who are pushing back on what the president has done here when it comes to trade policy. I think the broader takeaway here is the midterms are looming. There is growing dissatisfaction and anxiety among the American electorate about the state of the economy and where it's headed. There's some doubt about the president's trade policies, and you're seeing that kind of manifest in the way that this vote turned out yesterday. I should say also there's a bit of political geography at play here. Yes, this happened on Capitol Hill, right across the street at the Supreme Court. The justices there are weighing some of these same issues. Could the president do what he's done here, using national security grounds to justify the implementation of these tariffs? We are still waiting for a decision from the justices that could come in just a few days' time, Bonnie.
Yeah, exactly. Well, David, you make a good point. You know, it seems like maybe voters are prompting this to some extent because they're obviously pushing their representatives or expressing their feelings, and the representatives are then obviously passing that on. But at the same time, does it mean that President Trump might change his mind or do something differently on USMCA, or really dig in on an agenda he thinks works?
Yeah, Bloomberg reporting that the president is having doubts about the USMCA, which is up for renegotiation, maybe expressing thoughts among his inner circle that it's not something that he wants to continue going forward. Of course, that would be alarming to Canada and to Mexico as that process has begun in earnest with hearings and comment periods. Look, he's aware. His advisors are telling him that affordability is the issue that voters are caring about going into these midterm elections, and we have seen over the course of the last few months the difficulty with which the president's engaged with that issue in speeches and in interviews that he's done. He's doubted that affordability is an actual salient issue for a lot of voters, but we know, based on polling, based on sentiment data, it is something that voters really care about. Will it change his perspective on trade policy? I doubt it. We saw this threat from him on social media last night to any Republicans who dare cross him when it comes to the tariffs issue. But it is something that I think he's having to reckon with, the fact that this is something that voters very much care about, Bonnie.
He will have been very pleased with yesterday's non-farm payrolls report, a positive surprise. It also gives him some leeway when it comes to the immigration argument. Potentially, David, is the administration making hay from these numbers?
They are. We saw the reaction to it. Again, I cite his social media posts. He was very happy with the jobs numbers yesterday, as you might expect, and certainly is with merit. These are much better numbers, of course, than Wall Street and others expected. But you look at that in the crucible of what he wants to happen policy-wise, and the person who you were just talking about, Kevin Warsh, nominated to be the next Federal Reserve Chair, talking about cutting rates. All of that greatly complicated by the fact that we have this good number, this good job number yesterday, and we're looking ahead to the new inflation numbers later this week. Yes, there still remains this expectation for 2 cuts this year. How that could change, though, based on the quality of the data, the goodness of the data, to coin a term, I think is something that he's having to sort of navigate as well.
David, thank you so much. That is Bloomberg's David Gurria there. Turning to the latest in AI, Anthropic's funding round, the most recent one, close to raising more than $20 billion with backers, including Peter Thiel's Founders Fund and D.E. Shaw. The deal would value the startup at about $350 billion. Joining us now is Bloomberg's Neil Cantling. Neil, I mean, with every funding round, obviously, its valuation goes up, but are we hearing echoes of the old VC times when, you know, anybody would fund anything just to be involved in the exit?
It's an interesting question that you pose. I think what it is these funding rounds we're seeing are for some of the biggest AI models that are out there. So often they are the same backers for these particular technologies, and really it's betting that you're going to make more returns from betting on a number of these systems by choosing sort of 1 or 2 or 3 winners. And I think interesting here is that a lot of the OpenAI investors, and we see Microsoft, NVIDIA talked about in the articles as well as being investors, have also invested in OpenAI. So it's not just purely on betting everything on one system. There's a number of winners that will emerge clearly from this particular AI trade.
You know, we're talking about companies that have a certain number of products, right? We're talking about ChatGPT, we're talking about Claude. I mean, if you take the pharma industry, for example, they have to come out with a drug and then they have to keep coming out with more drugs or their share prices plummet. We are seeing that, you know, regularly. Are these companies going to have to prove themselves? Is there too much betting on just, you know, 1 or 2 products?
I think what we are actually doing now is moving on from the original AI 1.0, if you like. We move from the large language models now into the AI, the agentic AI, the AI agents, where you are training for specific purposes. You're seeing this in what happened with software last week, when people realized that there are, you know, solutions you can create for certain areas, whether it's the wealth managers or whether it's, you know, other pockets of the market. So yeah, you have to provide not just a broad spread, but clearly with these different models, you require a very specific solution to a specific problem. And they are now much cleverer in terms of the predictability than we had from some of the what they call the hallucinations, the errors these models presented even just a year ago. The technology has come on immensely. But certainly, you know, as with every single technology wave, 2 things are certain in terms of technology is in effect deflationary, which is a positive thing. And the second thing is that there are a handful of winners in every tech cycle. There are also many victims that come about from this.
Neil, Anthropic has a revenue run rate of $9 billion, right? It's not nothing, but at the same time, will it be kind of rushing to the IPO exit in order to give some of these investors an exit, just in case something happens and the world stops believing in the AI train?
It's a great question. It'll be interesting to see, you know, you would normally expect a larger scale in terms of the revenue run rate before you're coming public. And if they are investing at these kind of rounds currently, I suspect because of the appetite for this deal, this particular one is a who's list of potential investors. So it suggests perhaps that they've got no problem in funding. So while there is no problem in funding, there's no need to rush to the market. There's no need for them to be scrutinized as a public company, which is a different level of scrutiny that you get being in a private market. So I wouldn't expect an IPO anytime soon for Anthropic.
Fascinating. Neil, you know, we had real estate services stocks sinking in the latest AI scare trade, waking up every day now just wondering what's going to be next. But it's spread. It's not just the United States. Europe is also now in the crosshairs.
Yeah, absolutely. And we're seeing this. We saw this yesterday, as you mentioned. CBRE is a good example, was hit double digits yesterday. Now, what's different in this particular example is it wasn't because of a new agentic AI that was launched. It was just fear that there could be one launched. So we're now getting to the realms of not just the release of an agentic that's then impacting stocks. We're now predicting where we might see the next one and the disruption that could take place in the future. it's an interesting point is that CBRE itself is due to have earnings in about an hour's time. And clearly they're not going to have seen an impact yet in those numbers, but you can guarantee the analysts are going to question them on the call as to what they perceive the risk to be long-term from the risks and opportunities of AI.
Absolutely, yeah, there'll be a lot of preparation going on for that call, to say the least. Looking forward to it. Neil, thank you so much. That is Bloomberg's Neil Campling. Coming up, we're going to get you set up for your trading day with more earnings and economic data on deck. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Now, a look at what's ahead today. First up, initial jobless claims, 8:30 Eastern, followed by existing home sales at 10. Earnings after the market closed from Applied Materials, Airbnb, and DraftKings in focus. And more Fed speak. We'll have Governor Stephen Miron and Dallas Fed President Lori Logan at 7 p.m. Eastern. Some of the pre-market movers, Cisco extending its post-earnings decline after that tepid margin forecast. Memory chip pricing a problem there. AppLovin, it's the fourth worst performer in the NASDAQ this year, even though it beat in results and its outlook, being hit by AI disruption concerns once again today. And Rollins down 14%, revenue missed estimates there. It's been caught as well at Wells Fargo. Price target at Wells Fargo is exactly here, 56. Let's take a look at the macro picture before we head into our Thursday trading session. Futures pointed higher, a little bit of relief potentially today, tiny bit of weight to the dollar index, and your 10-year yield really going nowhere below 417. That's it for Bloomberg Brief. Surveillance is ahead. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
All of these trades right now are so sort of knife edge. Tech is a much more nuanced sector now.
If you look at places where we've outperformed, it's been the physical over the digital.
The tactical case for a continued bounce from here is pretty strong, I would say.
We think we're going to go back to a high-quality, large-cap trade.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, gripped by tech anxiety, the stronger than expected jobs report failing to ignite an equity market rally as investors are pushing out the prospect of further interest rate cuts from the Fed, and a new wave of AI anxiety is beginning to spread to real estate services, from software to wealth management, and now real estate.
Yesterday, CBRE and Cushman & Wakefield saw the biggest plunges that they had seen during the peak of the pandemic when the world had shut down and offices were dead. That gives you a sense of just how significant some of these drawdowns were on the fear of, guess what, disruption that would eradicate their business model. I keep going back to how can we understand if the business model is going to zero or going to a very small multiple in the very near future or in 5 years? Does it matter? How do you prove the unknown? And this is the technology that we're facing right now that poses that existential threat.
It's difficult to prove the negative. You can't sit here and say it won't happen. A lot of people think it will, or at least they're worried it will. Management teams are super frustrated about this right now. Analysts of the companies are as well, as this just cascades through financial markets one wave after another. It was a really salty quote from the team over at JP Morgan. I actually really enjoyed it. Generalist money flows, responding to the rapid AI product rate of change dynamic, are overwhelming the deeper thinking fundamental software sector specialists. That's the story of the last week.
And that's the reason why you've seen a lot of pushback and, frankly, a lot of buying in some of the sectors that have gotten most beaten up by these waves of AI fears that are washing through things. You know, the real question here is, how do you create a competitive moat? And you asked this question yesterday about some of the wealth management spheres. How do you create a moat around your business? Is it just to get big? Is it just to adopt some of these tools quickly enough? Is it a certain type of personnel? We don't have a clear sense because we don't have a clear sense of what the capacity of AI is going to be, not necessarily tomorrow, but say in 6 months or a year.
They're upset because they think they've already got one. What they can't do is put a moat around the stock. And that's the problem for the stock market at the moment. Futures are positive by 0.3. The next stop is the data. 8:30 Eastern Time, jobless claims following a much stronger than anticipated jobs report. But check out the reaction to the job numbers yesterday. We faded that move so fast. The numbers were really decent. And then you look at things like the Russell. lower on the session. You look at the US dollar, flat on the session. What happened yesterday?
First of all, the breadth of some of these job gains was pretty narrow. It was healthcare, first and foremost, which isn't necessarily a statement on the roaring exuberance in the economy. Then you look at the downward revisions, and then you start to look at some of these seasonal aspects that come together, as TD Security said, in a perfect storm that gave a really good look to this payrolls report. People kind of shrugged it off and said, let's see what next month brings, because ultimately this isn't necessarily giving us confidence that we're not necessarily just out of the woods, but that we're actually on a re-acceleration path.
So next hour, got a fantastic lineup this morning, but next hour, David Tinsley of Bank of America on the Bank of America Institute Consumer Checkpoint report. So we've talked a long, long time about the K-shaped economy. Low income versus high income great, low income really struggling. Middle income and the gap between middle and the top starting to open out. That is of concern, and that's something David will talk to a little bit later.
You know what's a really good example of that? LVMH and Gucci versus Hermes. LVMH and Gucci catered increasingly to the middle class, the aspirational buyer, and they are getting hammered because they are losing market share. Hermes, with your $10,000 Birkin bags, crushing it and able to raise prices, and that gives you a perfect example of where some of the pain is really bleeding into.
And McDonald's, leaning into value, capturing the trade down from the middle to the low income.
They dropped prices last year by more than 15% on a slew of items in order to drive traffic, and they saw that. This is similar to Pepsi. They see a similar type of environment taking place this year, even as that Birkin bag is getting more expensive.
Yeah, that Birkin bag was never on my radar anyway.
To be fair, it was never on mine either.
Equity futures on the S&P 500 positive by 0.3%. Coming up this hour, Julian Emmanuel of Evercore as markets shrug off stronger than expected economic data. Sharon Bell of Goldman Sachs with European equities quietly outperforming, and the Republican Congressman French Hill as the divide widens on Capitol Hill over tariffs. We begin this hour with stocks on the brink of fresh all-time highs. Julian Emmanuel of Evercore writing, although valuations remain extended and market leadership is in flux, the hallmarks of the end of a bull market are not present. Julian joins us now for more. Julian, good morning.
Good morning.
What are the ingredients needed for the end of a bull market?
So the first is signs of a recession. That is the most typical top. And, you know, as choppy as the data is and as much of the negatives that you can unpack, you know, the fact is we had a strong jobs report. And then the others would be either a Fed hiking rates, which no way, no how, no set of economic data will that happen prior to the midterms at the very earliest. Pressure on the long end. I mean, I think as investors, maybe the biggest surprise is how incredibly sedate U.S. 10-year yields have been when the rest of the world's yields have been exploding higher for months and months now. And then, of course, the last one, and the one that we think is going to be seen at some point in this cycle, is really true investor FOMO driving, you know, palpable overvaluation along with a very substantial capital market surge. And from our point of view, the FOMO over the last 2 months has been anywhere but stocks. It's been in gold and silver, and you see what's happened to gold and silver in the last several weeks.
Well, let's focus on stocks. Is there some FOMO in staples?
It's extraordinary. It's absolutely extraordinary. And if you think about year to date, value outperforming, which isn't necessarily a positive look on a go-forward basis for markets. Staples screaming higher, and I would characterize it as FOMO, particularly when you see, you know, snack food price cuts in front of the Super Bowl driving stocks markedly higher. You know, good on them. But also financials underperforming at the same time. Extraordinary. That message tends to say recession ahead, but actually there's a much more nuanced story. It is really a manifestation of this AI disruption trade.
That's the place to hide. Staples.
It is. So when we started coverage on AI almost 3 years ago now, has it really been 3 years? It seems like a century. We took every industry, every company, every job, and parsed it along these vectors about where, what jobs and what industries were most likely to be disrupted. We all knew several years ago software was among the highest. Well, look what's happened to software. The legal profession, but also the financial profession. And lo and behold, you look at year to date, those are the ones that are getting hurt the most performance-wise. But on the other side of the ledger, the ones likely to be least disrupted, metals and mining, agriculture, and consumer staples, services not far behind. The winners.
Do you want to hide from the disruption, or do you want to chase it? Do you want to chase the sell-off? Go into some of these stocks that have gotten beaten up and say, you guys are throwing the baby out with the bathwater.
In our mind, it's getting overdone. We are inclined to dip our toes. And again, remember, when you're doing things that are counter to the trend, you have to be careful, you have to be disciplined, you have to be prepared to have a battle plan and maybe add on weakness. But from our mind, we do think in areas like software, in areas where, lots of stocks have heavy short interest, you do want to dip your toe in.
As an investor, how do you prove, to John's point earlier, counterfactual? I mean, how do you even begin to assess what the actual risk is now and what it could be in 6 months, and then come up with some sort of business model and an understanding of what that moat looks like?
Well, it's incredibly difficult, and it explains why, first off, if you look at the start of this bull market in October of 2022, the only two sectors that have outperformed the S&P 500 have been communication services and information technology, the place where the hyperscalers reside, the place where AI Central is located. So that explains part of the bifurcation. But in my mind, a lot of it is just, this whole idea of the embrace of AI and the potential for it to transform. And we do not believe that AI is a discrete job killer. We think it augments, it transforms jobs, and we're living it at Evercore ISI.
So what's gripping us right now? Do you think this is just the Anthropic Roadshow? Just the big enthusiasm ahead of the IPO a little bit later this year and all the headlines just to entice some attention?
Well, look, we saw these roadshows throughout 1999 and into 2000, and they were real. And when the stocks came out, and this speaks to actually the greater rationality that we're seeing in capital markets now. Think about it from the credit side. High yield technology credits have widened dramatically because there's a chance that there won't be survivors of the smaller. Investment grade credits, you just had a 100-year bond issued.
Eaten up.
The last time that happened was 1997, in the height of the technology boom. And guess what? The NASDAQ rallied another 400% before the top.
So let's talk about the index level stuff. The year-end median forecast in our survey here at Bloomberg for the S&P 500 is something close to 7,600. How do we get 10% upside at the index level, market cap weighted, without tech regaining leadership?
You can't. Full stop. And to be clear, we are very heartened by the embrasure of this rotation. It's very normal in the start of the new year for the laggards to outperform, but the math at 54% of the weight among communication services, consumer discretionary, and infotech means you got to lead with the date that you brought to the prom in the first place.
Which is tech. Julian is going to stick with us. Julian Emmanuel there of Evercore. The equity market at the moment positive by 1/3 of 1% on the S&P. If you strip out the muscle of tech and focus on the equal weight, 4 consecutive days of gains. All-time highs.
And partly it's because people are hiding out in some of the consumer staples and some of these other areas that are physical, tangible goods that you cannot replace with a computer.
Let's keep an update on news worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. U.S. Energy Secretary Christopher Wright says Washington can help Venezuela raise its oil, gas, and electricity output this year. Speaking in Caracas, Wright said the Trump administration will issue new licenses for businesses to buy Venezuelan products and invest in its economy. Wright is the most senior U.S. official to make a public visit since the capture of Nicolas Maduro. The Fed signaling plans to abandon some of the confidential warnings it previously sent to banks to improve operations. Sources telling us here at Bloomberg the remaining flags will focus more on immediate risks to a bank's financial health and less on processes and procedures. Banks have argued that Fed supervision has become too complex and expensive. Apple's long-planned upgrade to Siri has run into snags during recent tests. Sources telling us Apple is now working to spread the improvements across future versions instead of in an operating system upgrade slated for next month. Testing has found Siri cannot properly process queries, takes too long to handle requests, and faces accuracy issues. And that is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie later. Appreciate the update as well on Venezuela. Anne-Marie on the ground in Caracas. Isn't that just the most Anne-Marie thing ever, to go to Venezuela?
If there is a sort of unstable land
Right.
that seems full of conflict and potential for violence, Anne-Marie is there.
My mum messaged me and she said, "Where's Anne-Marie?" And I said, "Venezuela." And she said, "Vacation."
Yeah.
It's like, vacation?
For her it is.
Maybe.
This
Maybe
is,
for Anne-Marie.
You know, it gives you that zip, that vigor.
Hopefully we catch up with her going into the weekend. Up next on the program, challenging Trump's tariffs.
It was just announced our trade deficit has gone down. Now, if you go down 1 point, 2 points, you're like a genius. Gone down 78%. That's because of tariffs.
Up next on the program, we'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television. We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Next up for the data later on this morning, 8:30 Eastern Time, jobless claims in focus following a very, very good payrolls report. An upside surprise payrolls rising the most in more than a year. Emphasis matters here. Where do you put the emphasis? On the green shoots in manufacturing jobs or the fact that healthcare is still doing all the heavy lifting, adding the most jobs since 2020?
Problem is you have to kind of include both points, which is the reason why I really was struck by what TD Securities had to say, that maybe we're no longer at risk of a major downdraft in the overall economy, but this isn't a screaming recovery that really speaks to some of the exuberance that people were talking about. So that's the uncomfortable middle ground that's incredibly unsatisfying and inconclusive that I can give you this morning.
Do we see some signs of stabilization? Maybe we do over the past few months. I hope we do. I hope we see more of the same a little bit later this morning when we get jobless claims. Equity futures on the S&P positive by a third of 1%, on the Nasdaq up by 0.27, and there's your outperformance once again on the Russell. It resumes higher by 0.57%. Under surveillance this morning, challenging Trump's tariffs.
It was just announced our trade deficit has gone down. Now, if you go down 1 point, 2 points, you're like a genius. Gone down 78%. That's because of tariffs, so we're doing numbers that nobody thought were possible. 78% reduction in our trade deficit, and next year we're going to be positive if we keep it all going.
So here's the latest this morning. 6 House Republicans crossing party lines, voting to block some of President Trump's tariffs on Canada. The president responding in a post on Truth Social, writing, any Republican that votes against tariffs will suffer serious consequences come election time. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, welcome to the program. The pressure starting to build down in Washington.
It definitely is, John. I mean, this marks the starkest political pushback that we've seen yet to one of President Trump's signature economic policies as we head into the midterms. Now, to be sure, this measure next has to go to the Senate, where it actually really likely could pass, but President Trump is going to veto any such measure, and then it would take 2/3 majority in Congress to override his veto. So this type of legislation is probably not going to become law, but it underscores that mounting pressure as Republicans are playing defense according to polling on the top issue for voters, which is, of course, the economy. And it's really interesting when you look at the 6 Republicans that voted against the president here, because they represent different factions of the party. Some are, yes, retiring, but others have long been feuding with President Trump over his agenda. Some are citing specific concerns for their states, like one lawmaker in Washington talking about how cross-border traffic has declined when it comes to the tariffs with Canada. And then others are in some really critical primaries in California, in Pennsylvania, where they represent battleground districts. And when it comes to the time for November's election, they're going to have to appeal to that broader voter base. Now, one thing's for sure, President Trump is not going to support any of these candidates in the primary. You read part of his post on Truth Social there, where he is threatening these consequences, and he could follow through. We have to keep in mind he has an unprecedented $483 million war chest that he has amassed and that he is going to use when it comes to targeting some of these lawmakers. Now, John, overall here, we have to keep in mind this specific measure is targeting Canada. Comes at an interesting time, of course, quite timing as the U.S. and Canada escalate tensions. Bloomberg News reporting yesterday President Trump is privately mulling exiting the USMCA, but this is going to be the first in what is expected to be a series of votes. We're expecting the next one later this month. That's going to target Mexico's tariffs in particular.
Tyler Kendall with the latest down in Washington. Tyler, thank you. Middle-income workers are being squeezed, and obviously the individuals that are in a race for the midterms are being squeezed as well. Is there enough runway? The U.S. economy is a super tanker. You're not going to change it overnight. These problems aren't going to go away, but can they improve over the next 9 months?
Well, tariffs is the #1 way that they could improve pretty quickly, and that's the reason why this is the target, and that's the reason why I wonder how much some of these lawmakers are going to be cowed by the threats that we heard from President Trump.
Julian Emanuel of Evercore ISI still with us around the table. Julian, tariffs were last year's story, and it wasn't all year. It was a heartbeat in April. Does it come back on the table this year?
So it is not going to go away completely, okay? Remember, we have an April meeting out there with Xi in China, and the subtext is going to be tariffs. We've had overtures and friction with Mark Carney, and obviously, seemingly better relationships with Sheinbaum in Mexico. But this is going to be a persistent story. Now, what's happened is, again, as we've seen time and time throughout not just this bull market, but through our generations, is that corporate America has become very adept at dealing with the problem, whether it's, some pass-through, some diversion of supply chains, or just eating a little bit at the margin. The fact is that tariffs, and this is part of why the market has been rallying as relentlessly as it has, have become a lesser issue, not a disappearing issue, but a lesser issue than we all thought a year ago.
So markets shouldn't have feelings, but investors do. And when we were in Davos, Switzerland, the Europeans were clearly offended by some of the language being used about the continent and the approach of this administration. When you speak to investors outside of the US, this was the only game in town. And in many ways, it still is. Some of the names listed on the S&P 500. But are you sensing an aversion to investing that additional dollar, that additional pound, additional euro in U.S. equities?
So I think the reality is, and the two things have driven the overweight over the last decade in U.S. equities. Number one, the lead pole position in the technology revolution, which has only accelerated since ChatGPT came to the public fore. And number two, very importantly, a persistently strengthening dollar. Okay, that ended a year ago. We think there's further dollar weakness. We think this is a long-tailed, multi-year phenomenon. And from that perspective, it's sort of rational to gently rebalance one's portfolio. Again, one of the reasons that the Japanese Nikkei 225, despite soaring yields, or perhaps because of soaring yields, has rallied as it has. We think that this is going to go on for a while, but we don't think the next really intense episode of rebalancing, like we saw in the first quarter of last year, happens until the AI trade reaches a crescendo, which we think is still well off into the future.
Some of what you're saying echoes what George Saravelos of Deutsche Bank wrote in a note yesterday, that he called the safe haven myth. And he talked about how increasingly dollar exposure hasn't been an offset to a risk-off move. And as a result, the less attractive the dollar is as a portfolio hedge, the more incentive there is to reduce dollar exposure. Is that kind of the dynamic that you see out there right now?
Well, and if you think about it, what's been very curious about the last year in particular is how correlations amongst assets have been shifting intensely. Take the metals, for example. Last year at this time and into the middle of the year, it was like, how can it be that gold and the S&P 500 are both going up in lockstep? Who knows? It must be something systemic. And then it was like, gold is going parabolic. There must be a problem with the S&P 500. And over the last month or so, it's gold and silver crashing. There must be a problem with the S&P 500. Well, guess what? There isn't. It's just a world that continues to be having the good problem of so much liquidity.
The liquidity right now is shifting, and it's not shifting away from the U.S. It's just going more intensely toward Asia. And you see the Asian equity markets outperforming at the fastest pace to start a year, going back to at least 2000 in some of the data that we're looking at. I'm just wondering, is this a sign that people view big tech in Asia as taking the lead right now over big tech in the United States?
Well, and part of the discomfort people have had with the S&P 500 is 40+% of the weight in 10 stocks. Well, guess what? Go to Korea, and you're getting close to 50% of the weight in 2 stocks.
2 stocks.
Yeah, but that is a manifestation, again, in our mind, of the secular importance of the AI revolution.
Julian, it's good to see you, breaking it down. Thank you, sir. Julian Emmanuel there of Evercore and the AI disruption and division we're seeing in the equity market. The FX piece of this is so important. It was win-win for the foreign investor. You got the price appreciation off the back of the dominance of US tech, and then on the drawdown, you got the dollar appreciation that was the natural hedge. So you just took the exposure on the equity side and on the currency side. And now you're starting to question that. And if you're a domestic investor in, say, the UK or Europe, it's a different decision to make at the moment.
Yeah, and this is a reason why I found George Saravelos' note so interesting. And it's not necessarily that no longer is this a haven status or reserve currency. It's that ultimately it isn't going to offer that hedge, that portfolio hedge. And right now, everybody wants to find a portfolio hedge. To Julian's point, there ain't one. And that's what it seems like increasingly, except for maybe some physical assets that you're going to hold for a long time. But that's the dirty secret. And so it doesn't send everybody to the same place to get that kind of offset.
So the word you'll hear all the time, diversification. And I know it's frustrating because it sounds so cliche sometimes, but you're about to hear it again repeatedly throughout this year.
Diversification means what, though, right? Diversification of locations, diversification of industries, diversification of vulnerabilities to AI disruption. It means a lot of different things. It's not easy, and people don't like not easy things, but here we are.
Just hide in staples.
Yeah, exactly.
Seems to be the
Until
story
it's
at the
overpriced.
moment. Yeah.
And then go back into software.
Some people think we're already there. Coming up on the program, Sharon Bell of Goldman on the state of the Sal America trade, plus Yahira has your morning movers. Shares of Cisco falling as higher memory costs weigh on the company's outlook. That stock is down by almost 8%.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, it's just actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Two days, no gains on the S&P 500 this morning. We're looking to change that, up by 1/3% on the S&P. A stronger than expected payrolls report failing to ignite a market cap index rally on the S&P 500. But the equal weight keeps doing what the equal weight's been doing through most of this year. 4 days of gains and all-time highs. Futures up across the board this morning. The Nasdaq higher by 0.3. Outperformance on the Russell higher by 0.6. With an update on some single names, your morning movers, Yahira has more. Hey, Yahira.
Hi, John. We are seeing Cisco shares under pressure this morning, down 7.5% after it became the latest company to warn that rising prices on memory chips will eat into profits this quarter. That matters because Cisco is the world's largest maker of networking equipment, and it uses those components across a wide range of products. That overshadowing what was otherwise a solid report, with the sales outlook coming in strong due to Cisco's role in the AI build-out. Meanwhile, moving on to App 11, the sell-off here catching some analysts off guard because it posted a better than expected outlook, beat earnings, and yet the stock is down 5.3%. Some on Wall Street calling this a clearing event, so basically strong results, but not strong enough to clear up the bigger debate with concerns over AI disrupting software still hanging over the story. And we end on Fastly. This is a company that makes the behind-the-scenes technology that speeds up online content. Shares are ripping higher after it gave a blockbuster outlook for 2026. It expects earnings to be double what analysts had expected. So it is the top gainer on the NASDAQ this morning and up 40%. John.
Yahira, thank you. Thanks for the update. More from Yahira in the next hour. On our radar this morning, President Trump's tariff policies suffering their strongest political blow so far. 6 Republicans crossing the aisle to pass legislation rejecting levies on Canadian goods as concerns mount on Capitol Hill over the upcoming midterms. Elsewhere, real estate service stocks plunging by the most since 2020, becoming the latest sector hit by widespread AI fears. Investors remaining wary of companies potentially vulnerable to new AI tools that could accelerate automation. And finally, turning to energy, the Trump administration making a special trip to Venezuela as the United States looks to strike a deal on the largest oil reserves in the world. Energy Secretary Chris Wright saying U.S. plans for Venezuela's crude will benefit both countries.
We can drive a dramatic increase in Venezuelan oil production, in Venezuelan natural gas production, in Venezuelan electricity production. All of these are to increase the job opportunities, the wages, and the quality of life for all of the Venezuelans.
Anne-Marie back on tour. She joins us now from Caracas for more. Anne-Marie, just describe what you've seen in the last 24 hours.
Well, it's been almost surreal being on this trip, Jonathan. Of course, we're in Caracas, Venezuela, a country, a city where the leader was captured by U.S. forces at the start of the year. And then some 5 weeks later, we touched down. The first time we've seen the highest-ranking U.S. government official come to this country. The hype on the ground, people are comparing this to when the U.S. left in 2019, when the embassy, they decided to close their diplomatic overtures here. And also, someone else was telling me they were comparing it to when Bill Clinton last came to this country in 1997, of course, the year before Hugo Chavez took over. So it's been quite a surreal experience. There's lots of consternation and trepidation, of course, in the business community about what can actually be achieved. They want to see stability on the ground. They want to make sure that potentially there are discussions about restructuring their debt. A company like ConocoPhillips, will they be paid back for the losses they took in this country? Secretary Wright says all of these conversations are on the table. And when he describes these meetings, and he spent a lot of time yesterday at the palace with the president, interim president, Delcy Rodriguez, he said that he wants to lift the Venezuelan people. He wants to let them free and their economy free. And he says the way to transform this country is through commerce, not through troops on the ground. And that was a message he brought himself from President Trump, who he dined with before he landed here in Venezuela, Jonathan.
Anne-Marie, I hear a siren behind you, and I think some of the tangibles of the experience of being down there are all the more interesting at a time where business is understanding exactly what you said, how much security there is on the ground. What's the environment like? What's the reception to some of the U.S. officials who are there from the rank and file in Venezuela?
Well, a lot of this is, as I've overheard one official talking, nothing will be in a straight line when it comes to the end destination for potentially this bilateral relationship and what the business community can expect. Obviously, there are immense safety concerns, but I was talking to individuals last night who said actually they feel that the country has been more stable in the past few years than many would have potentially remembered decades ago when they decided to leave the country. Now, if you are a company like Chevron, and today we will be going to visit Chevron PDVSA joint venture oil fields with Secretary Wright, potentially even interim President Delcy Rodriguez will be joining us. If you're already on the ground, you're going to be the ones that are able to quickly ramp up, say, production or put more investment into this country. When it comes to the businesses that are on the sidelines right now, and I'm talking to individuals from the embassy that are trying to restart the embassy here, who, by the way, the embassy actually has mold in it because it was left after 2019, they're getting a tremendous amount of outreach, they say, from everyone in the United States, from C-suite America, from Washington, D.C., that want to be the first ones on the ground. Being the first ones on the ground, coming here and seeing what the situation is, though, is very different from making a massive capital investment. And that is really the question lies for the future of this country and how much business and capital and financial interest it can draw.
Anne-Marie, fantastic work, and looking forward to your conversation with the Energy Secretary, Chris Wright, a little bit later on today. That's coming up on Bloomberg TV and on Bloomberg Radio. Anne-Marie on the ground in Caracas, Venezuela, after some big changes in that country over the past month or so.
The idea that suddenly the leader, Maduro, could just be plucked out, brought to the United States, and make it work because suddenly this is going to be a very different country. Interesting, Delcy Rodriguez and her role in all of this, considering that she worked for Nicolas Maduro and actually was part of that administration, how much she actually is welcoming the U.S. to come in with some of the oil majors.
I'm not sure she's got a choice.
Well, that's correct. Yeah. But how much is she actually full throttle ahead and how much she can get popular support online? That's going to be really interesting.
Should we talk to Goldman about buying stocks in Venezuela?
I think that that's obvious.
Not what Goldman
wants to do. Obvious transition.
Let's talk about European equities climbing to fresh record highs. The stock 600 outperforming the S&P 500 so far this year. Sharon Bell of Goldman Sachs writing, the search for insulation from AI disruption risk has accelerated the ongoing cyclical rally in the US. We continue to see rising allocations to Europe as a diversifier with reasonable valuation. Sharon joins us now for more. Sharon, welcome to the program. Let's just build on what you've just written there. The idea that Europeans are starting to look at home again. Are Americans looking abroad? Are they participating in this?
I think it's both. In fact, I would say it's more American investors, US dollar-based investors that are worried that the US market looks expensive. They're very concentrated in their positions in the US dollar. You've got 4 or 5 companies which are all big bets on one thing, AI. So that may pay off, but you don't know. And it just leaves you with some risks. So people wanting to diversify, including US investors, but domestic investors too. Both have been buying Europe this year.
Sharon, apart from just being European, what is the diversification in Europe? What does it offer?
Yeah, offers very different sector exposure, I would say. I mean, there is a tech sector, obviously, in Europe, but it's much smaller, than the sector in the US. You don't have the large hyperscalers not spending as much in the way that the hyperscalers are in the US. So very different from a tech sector perspective. But also, and I think this is more important, Europe offers things like much more exposure to, as a share of the index, to commodity-related areas, materials, industrials, financials, which have all in the last year performed very well.
Yeah, I'm thinking about Glencore, for example, or Shell, or some of the big banks that have also done pretty well in the region. I just am curious, though, if someone is looking internationally and they're not from Europe, why not go to Asia? What is the draw to Europe that has better exposures that's going to somehow outperform at a time when there's a real kind of question around how much they can break out from some of the crosswinds coming from both the US and China?
Absolutely, and I agree with that. Our philosophy has been you want to broaden your exposure and diversify, not just into Europe, but into Asia, into emerging markets. We've just upped our emerging market targets, for example. So, and actually, Asia and emerging markets have seen better earnings performance this year and have performed extremely well, better than Europe and the US stock market. So I think there's plenty of opportunity globally to diversify, including Europe, as part of that as well. But I do agree there are headwinds for Europe. I mean, economic growth is slower in Europe than elsewhere, although it's still positive and it's being boosted, obviously, by the fiscal spend in Germany. But yes, there are headwinds, such as China competition, although I do think European policymakers are starting to acknowledge this now.
You know, we're talking about the motivation, and we talk about the Sell America trade, which has become cliche. It feels like a little bit different than that, and that's the reason why we keep going back to this George Saravelos of Deutsche Bank note, where he's talking about the loss of safe haven status for the dollar, not necessarily in the sense that it's going to go to zero, but you're not getting the same diversification feature in terms of the dollar outperforming when risk assets sell off. How much do you see that as a driver? Not just people wanting to look home or some of the emotions of the moment.
Yeah, I think it's definitely that there's often when you see a change in trend, there isn't one single driver of it. There's several drivers. I think we talked about the diversification sector exposure. I mentioned valuation differences, but I also think concern about having all your exposure in dollars and wanting to diversify that is also another element of this. And the euro, sterling, Swiss franc provides different currency exposure as well. So I think there's many elements to this desire for global investors to diversify and broaden out their exposures.
There's a lot of anticipation about how much money is going to be spent on AI and the beneficiaries of that, Sharon, as you know. It's a big thing for the year ahead as well, with $650 billion of CapEx coming from just 4 companies, which is just absolutely absurd. People are thinking about the miners, Sharon, in a much bigger way. And when I think about miners, I think about the FTSE and some of the listings for UK equities. Are you seeing that generate some bigger returns for large cap UK?
Absolutely. FTSE 100 has done extremely well this year. Index targets have generally been raised. I think, in honesty, it's an index which has been ignored for 10 or 15 years by global investors and domestic UK investors. Doesn't really have very much tech exposure. It's got a very different type of exposure, but that's actually doing quite well at the moment. It's also an index which looks relatively inexpensive. So the UK market still trades at 13.5 times PE, which is not quite half what the S&P trades on, but not far off.
Sharon Bell of Goldman Sachs. Sharon, appreciate the insight and the different character coming from European equities on offer for people looking to diversify. Guy Johnson would often call UK equities Jurassic Park. Now, that used to be a bad thing, and now it's a good thing, because that's what people want to buy into.
Honestly, Jurassic Park has shown the stability of time, right? It has proven the test of time in that we still go and talk about Jurassic Park, and guess what? Those dinosaur bones and bodies created oil that we're now using for financing all of our AI. So look, we're looking at all of this, and it's sort of what's old is new again, and we have to invest in real things, because if it's on a computer, there is a high likelihood it will be disrupted, and that scares people.
Futures right now, positive by 0.3%. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. McDonald's U.S. growth hitting a 2-year high. The fast food chain reporting fourth quarter earnings and revenue that beat estimates. A focus on affordability, helping to boost traffic as diners spend more per visit. McDonald's is planning to introduce new beverages this year, including refreshers, energy beverages, and crafted sodas. The U.S. and Japan are closing in on the first 3 projects funded by Tokyo's $550 billion investment package as part of a bilateral trade deal. Sources telling us here at Bloomberg, all 3 projects are related to a data center infrastructure project led by SoftBank. Discussions between U.S. Commerce Secretary Howard Lutnick and Japan's trade minister aim to finalize details this week. Morgan Stanley CEO Ted Pick getting a big raise. The company boosting his pay by 32% to $45 million for 2025 after a record year for the company. Morgan Stanley shares surged more than 40% last year, far surpassing the strength of the S&P 500. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the program, President Trump defending his agenda.
Tariffs are bringing us hundreds of billions of dollars. Without tariffs, this country would be in such trouble, as they were for many years. Every prediction the critics made about our tariff policy has failed to materialize.
Some pushback on Capitol Hill. We'll catch up with the Republican Congressman French Hill next from New York City. You're watching Bloomberg TV.
Is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop. I'll still be driving some.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Stocks are up by 0.3% on the S&P, on the Nasdaq up by 0.23 on the Russell. Our performance on the small caps up by 0.58. If we switch at the board and get to the bond market, repricing at the front end of the curve, 2-year yields higher, following stronger than expected payrolls numbers yesterday. The 2-year this morning at 350.57. Some commentary from Wall Street, from Bank of America. That jobs report vindicates our view that the Fed won't cut under Powell. BNP Paribas and Andrew Husby going even further. We think the Fed will be cautious on delivering further rate cuts, quote, which aligns with our base case of no cuts through 2027. That's the call from BNP.
Which is essentially validating what we heard from Torsten Slok, because no cuts for the entirety of 2026 would mean that you're continually kicking the can down the road of potential rate cuts. I just wonder, about the Morgan Stanleys and the Citigroups of the world that are reiterating their calls for 3 rate cuts this year on less inflation. How high is that bar for inflation to come down now in order for the Fed to make a move?
Kevin Walsh will be under pressure, won't he? 18 months into the job, no rate cuts?
I think he's already under pressure. He hasn't even gotten the job, so you've got a good point there.
Let's head down to Washington. Under surveillance this morning, President Trump defending his agenda.
We're getting rich because of tariffs, by the way. I hope everyone understands that. Tariffs are bringing us hundreds of billions of dollars. Without tariffs, this country would be in such trouble, as they were for many years. Every prediction the critics made about our tariff policy has failed to materialize. 78% reduction in our trade deficit, and next year we're going to be positive if we keep it all going.
So here's the latest this morning. The president threatening House Republicans taking a stand against his tariff agenda. The president posting on Truth Social, there will be consequences after 6 GOP lawmakers crossed party lines to rebuke the president's levies on Canada. The Republican Congressman French Hill voting against the measure to override President Trump's tariffs, and he joins us now for more. Congressman Hill, welcome to the program, sir. Your reaction to what happened on the Hill yesterday and why you voted the way you did?
Well, good morning, Jonathan. Look, I think we should handle the tariff discussion in a more comprehensive way and not take votes every week on the floor that turns the House floor over to the Democratic Party. That's why I believe that standing with Speaker Mike Johnson on this maintains Republican control of the floor. So this is a very important strategic issue in a parliamentary body like Congress with a very narrow majority. What we should be doing about trade is urging the president to renew USMCA with Canada and Mexico, which is under review for its 5-year review this summer. It's a very important trade arrangement for the 3 countries. Progress is being made in working with the Canadians and the Mexicans. So that's number one. It's not to be connected, in my judgment, to the vote last night, which is, did the president have the right to put tariffs on Canada under IEEPA because of the fentanyl matter? You get my point. Let's stick with the big picture here, which is growing America's exports, growing America's influence, using tariffs as a tool to change trade behavior of other nations. Number one on that list, of course, is China.
Congressman, you mentioned USMCA. Our team down in Washington, I'm sure you're familiar with the work of Josh Wingrove, wrote just yesterday that the president is privately musing about exiting the North American Trade Pact, that according to people familiar with the matter. When you read a story like that, do you just consider that part of the negotiation for the upcoming negotiations, or does that concern you?
Yeah. No, I do, because of the way President Trump is responsible for dramatically improving the North American Free Trade Agreement from the 1992-1993 timeframe in creating USMCA in his first term, and it worked quite well. But there's more to be done on Canadians on dairy, or Canadians on softwood lumber, or how the automotive business works back and forth between the 2 countries, or now the role of IT. We live in an ever-changing economy with ever-changing priorities, but let's face the reality that 30% of GDP in my home state of Arkansas is connected to cross-border trade with Mexico and Canada. So the agreement is important, and it's also important for you to note in that comment that President Trump has, does not impose additional tariffs on USMCA compliant goods. So we are living by the agreement.
Congressman, there's a trade-off here, and I think a lot of people would be sympathetic with the idea of trying to get certain trade partners to change behaviors, and thinking particularly of China. On the other hand, there's a real affordability crisis, and this is a real issue for a whole host of representatives who are coming up for election later this year. I just wonder how much influence you think that Republicans on the Hill have over President Trump's negotiations around tariffs to potentially either abstain from putting additional ones on or rolling some of the existing ones back.
Well, what you've seen him do is fine-tune the efforts with individual countries or regions like the EU, UK, Japan, for example. I want to see consolidate the wins from those agreements that he's done over this first year in the first place. Secondly, you've seen him roll back some tariffs on commodities that we don't make here in the United States, but we need to use, whether it's a fruit or vegetable or a coffee, for example. And I think that makes sense. You don't want to burden the consumer as you're attempting to change trade policies in other countries, or compel them to follow Americans' lead on something like transnational drug cartel countering those drug cartels. But on the affordability side, Lisa, I think the most important thing we can do is stay focused on the supply side. The One Big Beautiful Bill last year, signed into law by President Trump, will see real wage increases this year for American families. In Arkansas, we expect some $10,000 in benefit to a family of 4 from the increased child tax credit, the lower taxes on tips, the use of the standard deduction, lower taxes on seniors' Social Security. So on that supply side, combined with what we're doing on regulations and the proposal I made for housing in the 21st Century Housing Act, we got 390 votes on the House floor for that this week.
I personally would like to boost consumption by taking a flight to a number of places in the next week, and I'm just wondering if TSA is going to be in operation. Is the government going to shut down tomorrow night, Congressman?
Oh, Lisa, I hope not. Look, it was so hard on my TSA agents in Little Rock and up in the tower at Little Rock National Airport, the air traffic controllers. That was a bad 42 days. That's not how to run the government. President Trump has used Tom Homan as a leader to consolidate both ICE and CBP operations in Minneapolis, bring transparency to the operation, streamline it, make sure the training is in place, make sure the operation is consistent with federal law. They're using body cams. Let's take that as the right direction and keep our government funded in Homeland Security. So important to so many people.
Congressman, it just feels messy down in Washington, but you pointed out the Housing for the 21st Century Act. We can get things done. We can find support on both sides. Congressman, what was actually achieved down in Washington, and how important is that to you?
Well, it's very important. You know, Jonathan, on the priorities I've had to have conservative center-right policy on redirecting regulation and policy for people's investment opportunities, more crowdfunding, more public offerings, community banking, making community banking great again by lowering the regulatory burden on small banks that make 60% of the home loans in this country. And now 21st Century Housing, we got 300 votes for those policies, as we did for our digital assets and crypto work last year. That shows that Republicans and Democrats, when it comes to economic policy, can get on the same page and pass legislation that President Trump should sign into law that will make people's lives better. Costs will be brought down, supply side capital will advance, and community banking will thrive in this country. And those are all good things.
Final question, Congressman. I've got about 20 seconds. Are you happy you don't have to chair the House Judiciary Committee? Because that was wild yesterday.
Well, I had a pretty wild hearing last week with my ranking member and Mr. Besant's testimony. So I know wild, but it was. But that's what happens on Capitol Hill. We bring the public and their elected representatives together to try to find solutions, and it can get spicy sometimes.
Congressman, appreciate your time. Thank you, sir. Congressman French Hill, thank you, sir, down in Washington, D.C. Serious topic yesterday in front of that committee, and things got very rowdy very quickly.
Well, this seems to be a theme, because you're right. They had the Scott Bessent hearing in the prior week, and it was just as spicy. There's a lot of animosity, and there's a lot of anger, and you could feel that emotion down in Washington, D.C.
Without a doubt. Coming up on the program, we'll catch up with Kristen Bidley of Citi, Monica Guerra of Morgan Stanley, David Tinsley of Bank of America, Steve Rasciuto of Mizuho. The second hour of Bloomberg Surveillance up next.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
People would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
If the data continues like we see, we're not going to get to that rate cut.
The Fed probably won't see the need to do too much more.
The bigger issues are the macroeconomic conditions of the consumer.
Rate cuts, if and when they come, will be based on inflation.
The data will lead the Federal Reserve.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P 500 firmer by 1/3% on the NASDAQ, up by 0.3. Outperformance on the Russell up by 0.6. That outperformance yesterday didn't hold. It didn't stick. The Russell actually ended the session lower, even with stronger than expected payrolls data. Bond yields at the front end repricing higher, pushing out Fed rate cuts. 2s above 350. Yields just about unchanged on the session. Going into this, 90 minutes away, 8:30 Eastern time. Another read on the labor market. Jobless claims in focus.
It might take on a little bit more import simply because it was inconclusive yesterday. Yes, the headline number came in better than expected, blew away expectations, 130,000. At the same time, under the hood, downward revisions. Also, you've got some seasonal effects, and people poked holes, not in that this was a good number. This was a good number, but in that it showed a reacceleration in the U.S. economy that was required to get the likes of small caps reignited.
And the Hawks are starting to feel good.
Exactly.
After questioning their stance at the back end of last week, they're feeling good. The Cleveland Fed President Beth Hammack this week, based on my forecast, we could be on hold for quite some time. Over in Kansas, President Jeff Schmidt, further rate cuts, risk allowing high inflation to persist even longer.
Which is the reason why you've got a number of Wall Street firms saying forget about it for any kind of rate cut in 2026. Others, whether it's Morgan Stanley or whether it's Citigroup, talking about a potential for 3 rate cuts this year. How much are those rate cuts necessary for some of the more cyclical areas to get reignited? Ultimately, it depends on what the data show and how much can we really say that a Kevin Warsh Fed is not going to cut rates. And that is a political discussion that a lot of people will say has been answered for us.
So I have exactly the same response to all of this. When BNP Paribas come out and say no rate cuts through 2027, that is no longer just an economic assessment. You're making an assessment about a new Fed chair selected by the president almost exclusively to cut interest rates. And you're making the forecast that in their first 18 months on the job, they won't reduce interest rates?
This goes to the question of how much control they have. and whether they can influence a Fed committee to cut rates if the data shows a good degree of growth. What that forecast sets up to me is a massive battle and a tirade going on Truth Social about what potentially should be happening at the Federal Reserve. So ultimately, there's going to be conflict one way or another. Ultimately, it comes down to what the data shows in terms of understanding just what momentum there is in the U.S. economy.
Two Fed hawks already digging in, and you can see that based on the recent Fed speak. Coming up this hour, we'll catch up with Kristen Bidley of Citi Wealth as equities inch higher, Monica Guerra of Morgan Stanley as President Trump's Canada tariffs hit a snag in the House, and Steve Rasciuto of Mizuho as investors await fresh labor and inflation data. We begin this hour with stocks holding near all-time highs following a choppy 24 hours. Kristen Bidley of Citi Wealth writing bifurcation will continue within software and the broader market, highlighting the need for diversification. Kristen joins us now for more. Chris, good morning.
Good morning.
Let's talk about that bifurcation. At the start of the year was software versus hardware, and that's been going on for a number of months.
A number of months.
Have things got a little bit more complicated?
I think in a good way, actually. I think things have gotten more complicated where it's no longer we're just going to take at face value the AI trade and everything's going to grind higher. I think this bifurcation of saying, okay, let's look at earnings, let's look at the CapEx spend, and we're going to delineate between those who are actually seeing an ROI on that expenditure and those who are just spending money. If you don't see the ROI, investors are getting less patient, and I think that's healthy.
As we see this disruption cascade from industry to industry, there are others who are just hiding elsewhere. Julian Emmanuel Evercore was on the program in the previous hour. People are just hiding in staples.
I know,
because
which
they
is
don't really know what to do.
Amazing.
So everyone's talking about the cyclical upswing, and you've got staples up double digits year to date. Does that make sense?
And I think it doesn't entirely make sense because you would normally think if people are putting money into staples, it's almost recessionary fears are front and center. But I would say, where can you hide in certain industries that cannot be penetrated by AI? I think it's as simple as that. You have the valuation play as well as something where it's like, is this industry going to be disrupted? Where people are starting to ask the question, what is going to be disrupted? And then also, when are they going to start to see the productivity gains? Which is also why we're seeing some of those sell-offs when it comes to even what came out about wealth management, real estate services. What does it mean for those models going forward?
I won't press you on wealth management for obvious reasons.
I would love to talk about it, actually.
The disruption divide seems to be the story. It doesn't feel like anymore it's a cyclical story. It just feels like it's based on the disruption divide.
But I think this is, again, you have the first part of this equation is infrastructure. And then looking at that significant amount of spending, is that a bubble? When are we going to see the ROI? It's not a bubble. It's really kind of the infancy stages of this. And that's going to then benefit a number of other industries. Then you have the application of that infrastructure spend, which will flow through to areas like financials, like insurance companies, like logistics and trucking. And so then it's who are the beneficiaries, and are they making the right investment decisions to then be true beneficiaries of this?
Let's talk about wealth management. We went there in terms of the disruption and how much you could actually be taken out of a job for AI, because we're all wondering the same thing about ourselves, and how much can this sort of iterate in order to make us completely obsolete and irrelevant. Was it interesting to you when it hit the industry that you're in to understand what people were not understanding, or did you get a sense of just abject fear and go into a bunker?
No, we've been preparing for this for quite some time. So when you think of how AI impacts wealth management, it makes us better at our jobs. So there's that common phrase where it's, the person, AI is not going to take your job, but the person using AI is going to take your job. So this makes all of us more productive. But what we also need to take a look at is, it's not just about the AI tools. Who has the data? So the underlying data becomes critical. So for example, within my business, we've been covering law firms for 56 years. We have extensive data on the state of the law industry, also on lawyers themselves in terms of their financial plans, their career progression. So if you're going to take something like a financial planning software, yes, it's great to have the underlying balance sheet kind of calculations, but if you can combine that with really powerful data and insights on industries that are unique to you, at Citi we have credit card data, we have data on the consumer, we have data on how people are investing, it then multiplies that.
So data is the edge. You work with law firms. That's another area that people are now talking about potentially being disrupted. Why get an associate that's never going to sleep and have a miserable life when you could just use ChatGPT that's never going to complain? I'm just wondering at what point...
Those are real structural changes.
So those are real. So then at what point does that really reduce headcount and reduce the need for the human in the equation?
So when we talked about the employment backdrop, one of the things that we've talked about on this program together before is I am concerned about the youth unemployment rate. That is an area, we talk about it within like the legal legal profession that you used to have this pyramid structure, and it's moving to more of a cylinder because you don't need as many first-year associates. And you're seeing that actually come to fruition, not in the future, but in today in terms of hiring plans. So there will be structural changes in terms of what your workforce and labor force looks like. And I think that's going to impact not true advisors, but it will impact some of the entry-level positions.
If you're wondering where the rant came from because it felt so personal, Lisa was almost a lawyer. And then
is this a
backed
true
out.
story? All right.
Bramo chose to be a journalist instead of a
Actually,
lawyer.
do you want to know the truth? A law professor who is my advisor said to me, you would love law school, you would hate being a lawyer, go be a journalist. And I said, okay, I'll do that.
Will AI change that for you?
Go back to being a lawyer? I can adjudicate things while on air.
Kristen, so much of this is happening, and that's true. So much of this is happening in the US. So much of it's driven out of the US. And yet we had a guest 30 minutes ago talking about the opportunities elsewhere in Europe. Is it the end of US tech dominance? Is it the end of supremacy in the equity market?
I don't think so. I think, like, look, the flows year to date absolutely are showing that people are diversifying away from the US, both in terms of the dollar as well as the equity market. So if we look at what's rallied, you can look at Japanese equities, you can look at Korean equities, you can look at emerging markets in terms of the price action that we've seen year to date. But we need these mega cap stocks to perform, and they are the ones that are really driving the expenditures, they're driving the innovation. And when you look at their earnings growth, it's still really impressive. So this is like, they are delivering from an earnings standpoint. So to be on the forefront of innovation and the investment and what's really going to drive long-term secular growth, the US has to be there, and these mega cap companies need to as well.
What we hear repeatedly, and I'm sure you hear the same thing, is that the international investor base is nervous about taking additional dollar exposure. Now, I know additional dollar exposure because they've taken so much over the last decade. Do you hear the same thing?
I think the major thing that we're hearing, and I actually just came back from Europe, I was in London and Madrid last week, the major thing is, like, when you look at last year was painful, right? In terms of, like, yes, you had US equities rally, but when you then translate that back into your home currency, if you're a euro-based investor, that totally changes the equation. But for, like, your average, like, US investor who is very dollar-based and very dollar-centric, it's not really an issue.
I'm curious, given the fact that you do travel, given the fact that you talk to so many investors, how has sentiment shifted from the end of last year to now, which feels like about 15 years?
So we did a poll. We had a couple of events in Madrid and in London, and we did a poll, and it basically ended up exactly the same in both locations. So it was, you know, instead of us talking about our outlook, which is constructive, and we do believe that there are tailwinds with volatility, it was about 60% of participants. It was consistent across both locations. 60% of our investors were constructive and bullish and saw some tailwinds in terms of the earnings backdrop, and particularly even within the US market. 20% concerned, and a lot of it was around, are there structural changes that we need to be anticipating? And the remaining 20% just admitted they were entirely confused.
Count me in that bucket.
I think I'm in that group too. Chris, it's good to see you. Thanks for
Good to
dropping by.
see you
Thank
too.
you. Kristen Bidley there of City Wealth. Can you imagine if we lost Bramo to the legal professional? That would just be awful.
There is a huge cohort would probably be clapping, so, you know, too bad, sorry.
I'd hate it, Bramo. I'd hate it. Let's give you an update on stories elsewhere with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. CarMax topping hotel industry veteran Keith Barr as its next CEO. Barr will take the helm in March and will be challenged with improving CarMax's online sales experience and lowering costs. He previously served as CEO for IHG for 6 years. Anthropic nearing the completion of a deal to raise more than $20 billion. Sources telling us here at Bloomberg the funding round is co-led by investors including Peter Thiel's Founders Fund, D.E. Shaw, and Dragoneer Investment Group. Anthropic is said to be valued at about $350 billion, and that announcement could come as soon as this week. WhatsApp says the Russian government has moved to block its messaging app. Russia removed technical internet records that help connect platforms like WhatsApp, making the services unreachable from inside the country. The Kremlin pressing citizens to adopt a state-run app called Max. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, trade policy, pushback.
It was just announced our trade deficit has gone down. Now, if you go down 1 point, 2 points, you're like a genius. Gone down 78%. That's because of tariffs.
6 Republicans crossing party lines, some pushback on Capitol Hill. That conversation up next with Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Pretty decent. Strong payrolls data just yesterday. Later this morning, about an hour from now, you'll get jobless claims. Another read on the labour market in America. The estimate in our survey, 223. The previous number, the wrong kind of upside surprise. We got 231. We're looking for that number to come back down and get further signs that this labour market is stabilising. In this equity market, equity futures look like this. On the S&P 500, firmer by 1/3%. On the Nasdaq, up by 0.26. On the Russell, up by 0.6%. Curious that the gains in the Russell and the small caps did not stick yesterday. Didn't hold even with that stronger than expected economic data. Something that did stick, this move here in the bond market. Repricing at the front end of the curve. Just pushing out, not totally pricing out, but pushing out the prospect of further interest rate cuts from the Federal Reserve.
The hawks got ammunition. Why would they cut rates if you see the labor market potentially stabilizing and not exactly falling off a cliff? Ultimately, tomorrow is going to be really important. The idea that we're going to get the inflation read, CPI, will give us a sense of just how much leeway they have to potentially cut rates on disinflationary trends, even if you aren't seeing any kind of deterioration in labor.
You mentioned Morgan Stanley a little bit earlier. Mike Gapin is the one looking for precisely that. Not weakness in the labor market, but softer inflation, leaving the door open for them to reduce interest rates. And they're the kind of cuts that Kevin Walsh would love to deliver, because they're not complicated. You come out and say inflation's lower, I'm cutting interest rates, as opposed to everything's fantastic, growth is absolutely flying, and you're cutting interest rates because why?
Yeah, exactly, which leads to the whole political question. There also is a really bad message that he could send if the labor market does crack. You don't want to say, I'm cutting interest rates, because guess what? We need them, and we need them badly. That is not the right message the market wants to hear either.
Some pressure on that man before he even gets confirmed at the top of the Federal Reserve. Out of Savannah's this morning, trade policy pushed back.
It was just announced our trade deficit has gone down. Now, if you go down 1 point, 2 points, you're like a genius. Gone down 78%. That's because of tariffs, so we're doing numbers that nobody thought were possible. 78% reduction in our trade deficit, and next year we're going to be positive if we keep it all going.
Congress isn't celebrating. Here's the latest this morning. 6 House Republicans defying the president, voting to block some of his tariffs on Canada as unease over the administration's economic policies continues to grow. The president vowing consequences for any members of his party opposing the levies. Tyler Kendall has more for us. Hey, Tyler.
Yeah, hey, John, good morning. Well, this marks the strongest political pushback that we've seen against one of President Trump's signature economic policies as we head into the midterm elections. And House Speaker Mike Johnson tried to prevent his members from taking this politically fraught vote. He had tried to delay it until at least after the Supreme Court rules on President Trump's broad-based IEEPA tariffs, but at this point, they're now all on the record. And if you're a reporter here in Washington, you get inundated with campaign emails. And I have to say, after this vote took place, my inbox was flooded with Democrats targeting Republicans in farm states who voted in favor of the president's tariff policies. Now, Democrats want to make this a top focus as Republicans play defense, according to the polling on the economy. But the White House is still defending its policies, and we should say that the vast majority of Republicans did vote with the president on this one. But still, if you were one of the 6 that didn't, President Trump really could make good on some threats to hurt them come the primary season, because he has amassed a record $483 million war chest. And people familiar with the matter told us last month that he plans to be personally involved in how that cash gets deployed. Plus, keep in mind, this is just the first in what's expected to be a series of votes targeting President Trump's tariff policies. This vote was about Canada, but we're expecting another one later later this month looking at the tariffs levied against Mexico. John, with all of this said, and just to be sure, this measure now goes to the Senate, where it actually really likely could pass, but then it will come to President Trump's desk where he would veto it. It would take a 2/3 majority in both chambers to override that veto. So none of this legislation is probably going to turn into law, but at this point, it really is showing that perhaps more symbolic push on the behalf of lawmakers as we head into November.
Tyler Kendall with the latest down in Washington. Tyler, thank you. Joining us here in New York is Monica Guerra of Morgan Stanley Wealth Management. Monica, good to see you.
Good to see you.
So the calendar, let's get to the calendar. So at some point, USMCA renegotiation, there's a meeting with Xi Jinping in the spring. There's already pushback on Capitol Hill. How is that going to shape outcomes for the year ahead?
So when we're thinking about USMCA, it's really critical to remember that this is a review, and typically you don't get a renegotiation, but what we're seeing is that renegotiation's on the table. So you had China and Canada have a conversation. While we have reason to believe that Canada did communicate that with the U.S. in advance, it still is setting the stage, right, for hardball when we're thinking about actual renegotiation this summer. So we're waiting to see what that looks like, and then we have this pressure from Congress adding to the table. So everyone wants a voice in this negotiation, not just the president.
This isn't NAFTA. That's gone. The president called it USMCA. It's his. What doesn't he like about his own deal?
One of the biggest areas where you get the pressure is with the UAW, right, the United Auto Workers. They're really looking at essentially lessening the pay differential between U.S. Mexico, U.S. Canada. You're also seeing a lot of fair trade and fair worker concerns. So you're getting this from the trade unions. They're looking to have a lot of pressure alleviated off the table. The president also wants Canada and Mexico to affirmatively pull away from China. You've seen some, more firm action on the Mexican side of the border, but not necessarily with Canada. Canada's now saying, hey, we're an open buyer. We don't necessarily have the same, geopolitical viewpoint. We aren't the founders of the Monroe Doctrine, so we're okay with, starting negotiations elsewhere.
How much does this latest House vote constrain the president? And I say this because he's going to renegotiate this without necessarily a vote of faith and confidence from particularly a number of Republican Congress members that are on the border, that actually have business with Canada and are realizing this isn't going to be good for their constituents.
What this really shows is cracks, right, in the party. We've seen really lockstep support of the president. Where does it actually move the needle? Potentially, I would say right now from a legislative standpoint, no, you're not going to be able to get this through the Senate. What's interesting about this, though, is that if you have GOP members defecting, they are pretty positive, I guarantee it, pretty positive that they could withstand a primary. So this is essentially not necessarily a game changer for them with their electorate because their base is concerned about this issue. Right? So any sort of challenger that would come in, I think that would be a very difficult fight.
They're concerned about affordability, and that has been something that keeps coming up. It seems to be the word of the year, at least on the political front. I just wonder what more Congress can do. Can they provide additional stimulus with the support that they have, with the concerns about the deficit, and frankly, with the jobs number that we just got that beat expectations?
So one of the things that we're really looking at from a stimulus standpoint is, pre-midterms. So again, once we get through that USMCA renegotiation, you get through August, then it's going to be full-blown campaigning. And that's when you're likely to see more of the affordability measures come in. Maybe you get more on housing. You're likely to get some movement in healthcare, whether that's pharma caps or a Trump healthcare plan. We don't know yet. But they're going to essentially look around the edges and see where they can make good on that affordability promise. The other thing that's really critical that people aren't paying really close attention to is the OBBA tax cuts and how those tax refunds this year are going to be at record highs, about 40% higher than we had in the last year. This is notable because what it does is that it alleviates the debt side of the equation and the consumer staples side of the equation. People think, oh, you get more cash on hand with a tax refund, that would go to consumer discretionary. That's not historically what the behavior is when we're thinking about behavioral finance. People take that money, they pay down their credit card debt, they pay off the debt that they incurred over the holidays, and then they essentially get their house in order. So we think this is a real boon for consumer staples throughout the year and not necessarily discretionary.
So let's stay on this. For people who don't follow your research, you do have the winners and losers of the legislation coming out of Washington. Winners staples, losers discretionary. That doesn't sound like stimulus. And when I was reading through your note, I was sitting there thinking that because so many people are coming on this program talking about these refunds. funds, and talking about the stimulus that it will provide for the US economy. You don't share that view, do you?
Well, I wouldn't say I don't share it. It's going to essentially benefit, right, the lower end retailers. So you have to think about it really not just sectorally, but where within those industries. The thing that where you're going to get stimulus is going to be on defense spending. It's going to be on these major bills that they're likely to get through in that second half of the year. Affordability measures are helpful. They're a nice talking point, but they don't really come home to roost until 2027, 2028. So when we're thinking about stimulus, you got to look at where is the money actually being allocated, and that's likely to be with defense and other areas.
Speaks to where the outperformance has come from, Bramo, so far year to date. For lots of different reasons, not just the AI story and hiding in a bunker, but the staple stories really perform well.
When you think of stimulus, you think of discretionary spending.
Things that help the cyclical trade.
You think of things like traveling more. You don't think of people buying more food to stock up their pantries. You don't think of people reloading on shampoo and conditioner. So this really speaks to how different the financial backdrops are for some people than others, and that the people who are most likely to spend this extra income are the people who are going to be spending it on Campbell's soup and maybe some shampoo.
Well, this really speaks to that K-shaped economy. So on the upper end, the reason why they're not stimulating up at the upper end is because that spending's already happening. That travel is happening, the discretionary spending's happening in that space. So what they're looking to do is speak to that lower leg, right? Those that really need that, feel that affordability pinch. And that's why it's important when we're thinking about staples, it is going to stimulate on that end in a way that we haven't seen.
Monica, this was great. It's good to see you. Thank you. Monica Guerra there of Morgan Stanley. Staples year to date, not just an AI trade, what you just heard there from Morgan Stanley, also a tax refund trade. Year to date, up by double digits. In just a moment, we'll catch up with David Tinsley of the Bank of America Institute as the K-shaped economy opens up. And they note in their data a widening divide, not just between low income and high income, but middle income and high income. The problems are migrating up from low income to middle income.
Housing costs and healthcare costs are eating into the average family's income in a way that isn't being priced into how we categorize some of these levels.
We'll speak to David in about 5 minutes' time. Plus, Yahira has your morning movers. Strong demand for memory storage, lifting shares of SanDisk and Micron. Big moves in the pre-market on those names once again. Big moves so far year today. Wild rallies worldwide. Equity futures on the S&P up by 1/3% on the S&P 500. 1 hour from now, jobless claims the next stop for your economic data following a stronger than expected payrolls report in America.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslinda Amin in Davos, Switzerland, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
2 days, no gains. Let's see if we can turn it around. We're positive by 1/3 of 1% on the S&P, on the Nasdaq, up a similar amount, and your outperformance from the Russell higher by 0.6%. In the bond market, talk lots about a 2-year back above 350. Just a break of that, we're down a basis point. On 10s, we're down another basis point too, and down 2 at the long end of the curve. 30s to 478. Just how quickly we faded that post-payrolls bump in equities and in foreign exchange, and now to some extent in the bond market.
How many notes did you read? Take it with a grain of salt. You know, I'm not necessarily confident that this indicates some sort of shift. How about that birth-death model? How about the downward revisions? I mean, how many holes were poked in it in some of the notes that we got overnight? You can argue, okay, nonetheless, this is a pretty good number. This doesn't necessarily, though, scream of growth that really would supersede any kind of disinflation that potentially could cause rate cuts.
Look, there's an obvious bias, I think, for a lot of people, conditioned by experience of the last 12, 18, 24 months, just to mentally revise the jobs figure down, because ultimately in 12 months' time it will be done anyway by officials, so why wouldn't you? Can you really put much weight on this? I hope we see it continue. I would say that the only supporting factor right now in the data that I've seen over the last week or so is the ISM. Outside of that, a lot of it is going against the grain. Jobless claims being one. I hope it turns around in an hour from now. Challenger job cuts were problematic. Jolts were problematic. The sentiment surveys haven't been great either.
And in the payrolls, you did see construction workers actually pick up in terms of employment, some of the other areas in the industrial sectors. To your point, how much does this really up the volume, increase what we do when we pay attention to jobless claims in order to really correlate what we saw yesterday?
Claims 60 minutes away. We'll look out for that as we count you down to the opening bell, 2 hours away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Cisco is the latest company to warn us that rising memory chip prices will eat into profits this quarter. So shares are falling 7% in the pre-market. That overshadowing what was otherwise a solid report by Cisco, with its sales outlook coming in better than expected due to its role in the AI infrastructure build-outs. And that pricing warning is lighting a fire under the memory chip stocks looking to cash in. You're seeing SanDisk up 6.6%, Micron up 3.5%, as more companies talk about memory shortages and higher prices during this earnings season. Analysts at Goldman calling it the great memory crunch, as AI data centers can't get enough and supply just isn't keeping up. And speaking of data centers, we end on Equinix. This is the world's largest the largest operator of data centers. Shares are up nearly 10% in the pre-market after the company reported record fourth quarter sales and a better than expected 2026 outlook, all due to AI-related bookings. John?
Yeah, I'm not shocked at all. Yahara, thank you. If you operate data centers right now, we can imagine who your customers are, can't we?
There are a couple of names, and they are big, and they are competing with one another to try to get capacity to make sure that their competitor isn't going to get it. So a definite race going on in that space.
Spending serious money. And I raise out this morning, the Congressional Budget Office issuing a fresh warning for the U.S. fiscal outlook. The CBO raising its estimate of deficits for the coming decade by $1.4 trillion. President Trump's tax law and immigration policies outweighing tariff revenue. Elsewhere, Apple's latest Siri upgrade facing the possibility of further delays. Sources telling us here at Bloomberg that testing of a new update revealed sluggish response times and accuracy issues. Features meant to be released in March may not be available until May. And finally, McDonald's fourth quarter U.S. sales growing at the fastest pace in more than 2 years. The company's offering of more affordable menu items and value meals is paying off.
It increased traffic, right? It increased customers coming in the doors and buying extra value meals that had been cut in terms of price by 15% or more late last year. This is similar to what we heard from Pepsi. This is similar to what we've heard from other fast food retailers. And I just want to read you this quote from the CEO, Chris Kempczynski. As I've said before, and I will say again, McDonald's is not going to be beat on value and affordability. This raises the question about how much you end up with some sort of war in terms of lowering prices, and it speaks to the fact that going forward, this is not changing. This is the bottom of the K that is not improving, is not seeing their circumstance really materially get better, which is a reason why it really has to come down to adding value, i.e. cutting prices and giving customers something that they feel is worth it.
They've had to lead on basically franchises to get them to cut prices. I think we all saw that value meal for $18 in Connecticut. Did you see those pictures?
Yes.
In the last year? Warren Buffett would say price is what you pay and value is what you get. If I'm paying $18 for a meal at McDonald's, I'm not getting value. And by definition, that is not a value meal. And that's where the big effort has been in the past 12 months, just to push those prices lower and to give them the support they need to make it happen.
There are two ways to view that. On one hand, you could view this as they went too far with some of the price increases over the past couple of years. The second thing is that people are becoming that much more sensitive to what those prices are and are pushing back in a more serious way than they have in the past. And that latter point is the concern, given what we are seeing in terms of both the labor growth dynamic as well as what we're seeing with debt and so the ability to pay, certainly in delinquencies.
Consumer price tolerance was right up here coming out of the pandemic. Charge what you want, people to pay it. That's what people thought. Consumer price tolerance has absolutely sunk over the last year or so. Let's stay on that story. Credit card spending rising to its highest level in nearly 2 years last month. The Bank of America Institute writing, we are concerned, though, that a K-shape is opening up between higher income and middle income households alongside the existing gap with lower income households. David Tinsley of the Bank of America Institute joins us now for more. David, welcome to the program. Let's talk about the headline number and the strength we're seeing, and then we can get to the disparity and the bifurcation beneath. David, the momentum at the top line, are you encouraged by that?
Yes, I mean, like you were saying in the graphic there, 2.6 year over year. That's a pretty strong number, strongest in nearly 2 years. Bear in mind, it was a pretty bad month weather-wise. You know, bits of the east, bits of the south were sort of shut down at the end of the month. So I think in aggregate, the story is a solid one.
In aggregate. And that's really the headline, David, because beneath the surface, it really isn't. I was going through the stats that you and the team put out in the last 24 hours. This gap opening up between middle and high-income Americas, just how wide and how quickly is that widening happening?
Well, yeah, that's exactly the point. The aggregate is fine, but then when you look beneath that, there's like the jaws of a crocodile, in which the top of the K, higher income households, spending growth 2.5–3% over the last few months. Lower income households, 0.3 in January, sort of quite close to zero, really, over the last few months. What we're really concerned about in the data right now is that the middle income group, which for a good period of time last year was in the middle between that lower and higher story, is sort of drifting down closer towards the lower income consumer end. And of course, you know, put simply in a macro sense, the lower income consumer doesn't drive the economy, but the middle income consumer is a very important part of the overall consumer story. So you can't really afford to lose those guys.
Why do you think this is? Why has the picture gotten worse for middle-income individuals, considering the fact that the stock market is up? Is it a lack of an exposure to the stock market? Is it their jobs that they're in are not seeing wages increase as fast as elsewhere?
Well, you know, when we look at our spending data and then we look at across the wages data we see coming into our customers' accounts, we get a very consistent story. So these middle-income households have seen a softer wage growth picture over the last few months. It's running about 0.4 percentage points, 0.5 softer than the last 6 months of last year. So, you know, to answer your point, I think mainly it's a labour story, and really most of these households don't have a lot of equity. They're not really exposed to the wealth effects. That's very much a kind of top income tier story there. And there, you're seeing a much more consistent story in terms of spending.
Based on that backdrop, do you think that we're underestimating or overestimating the influence of some of the tax cuts that are expected to trickle through in the first couple months of 2026 in the United States?
Well, what we see in our data when we look back over the last few years is that people tend to spend their people who are going to get larger tax refunds tend to file early, and when you look at lower income, younger households, they spend more of that tax refund than the other groups. You know, in a sense, it's very intuitive. So I think we will see a jump in spending and some easing in the affordability issues from those lower income households, those younger households. My concern isn't really so much as the sugar rush of tax refunds, it's when they wear off. So in our data, we see deposits staying high for about 6 months after these tax refunds come in. People kind of whittle them down slowly. But, you know, look at the end of this year, say, if that labour market position remains soft, then that makes me more concerned about how, essentially, what is going to be the driver of consumption at the back end of this year.
David, just on the spend, typically, when you track that money, where does it go? We had a guest from Morgan Stanley on a moment ago who said a lot of that cash is just going to go to staples and not discretionary. What's your read on things? What do you see in the actual data?
Yeah, it's a sort of mixed bag, really, and I think that is right. Basically, you know, affordability issues are at the forefront right now, and when we look at things like trade down, we're seeing lower income consumers spending at grocery stores running much stronger than they're spending at premium stores, and we're also seeing rental costs. To give you an idea, around a quarter of lower income households, their monthly rent is worth more than 50% of their household income. So these are quite restrictive affordability issues. So I think, yes, I think the tax refunds will ease affordability issues. We'll see some leakage into discretionary, I'm sure, but to the extent that it's a lower income and middle income story, it will be more on groceries. Maybe there'll be some easing in terms of quick serve restaurants, you know, referring to your piece earlier, you know, the value meals, etc., might come back into vogue a bit more.
David, it's good to see you. Thanks for breaking down the latest data.
Thanks a lot.
Thank you, sir. David Tinsley there of the Bank of America Institute following their Consumer Checkpoint report. If you missed that yesterday, consumer spending showed solid resilience in January. Total card spending from internal data rising 2.6% year over year, strongest pace in nearly 2 years. That's kind of where the good news ends. Beneath the surface, the wage growth gap between higher and middle income, the largest in nearly 5 years. And it's that middle income squeeze that team is concerned about.
You know, if you think about some of these jobs that typically are thought of as middle income types of work, office managers, sales managers, executive assistants, some of the roles that might get disrupted by artificial intelligence. There are others that won't, right? Registered nurses, I'm thinking of, in other areas. But you start looking at this, you start wondering, okay, how much of this is also because there isn't the same kind of price pressure for labor that there has been in the past. This is the reason why people really want to understand that dynamic, because it is affecting that K-shape and how it is becoming pernicious.
That's the latest on the US consumer. If you want to check the markets, equities session highs up by 0.4% on the S&P, with an update on stories worldwide with your Bloomberg brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. U.S. Energy Secretary Chris Wright says Washington can help Venezuela raise its oil, gas and electricity output this year. Speaking in Caracas, Wright saying the administration will issue new licenses for businesses to buy Venezuelan products. Wright is the most senior U.S. official to make a public visit to Venezuela since the capture of Nicolas Maduro. Federal agents are looking along roadways in the Catalina foothills near Tucson as part of the investigation into the disappearance of Nancy Guthrie. The Pima County Sheriff's Department and the FBI are saying they're following up on 18,000 tips. The mother of Today's Show co-host Savannah Guthrie has been missing since February 1st. The Fed is signaling plans to abandon some of the confidential warnings it previously sent to banks to improve operations. Sources are telling us here at Bloomberg the remaining flags will focus more on immediate risks to a bank's financial health, less on processes and procedures. Banks have argued that Fed supervision has become too complex and expensive. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in 30 minutes. Up next on the program, the Fed faces the data.
What today's jobs data showed you is that underlying economic growth is fine, but when I look forward, I see inflation coming down quite dramatically this year. So I view there's being a variety of reasons still why I would want to see lower interest rates.
Up next, we'll get the view of Steve Rasciuto of Mizuho from New York City. You're watching Bloomberg Surveillance.
The problem we've got as an industry is when the government's overtax, and let's say they tax at 30 or 40% of net gaming revenue, what happens is it starts making it uneconomical for the regulated operators like ourselves. And then the customers land up going to the black market, and the black market don't pay tax, do whatever, and there's no customer, there's no responsible gaming, and the fiscals of these governments don't collect any money. So it's finding a balance between overtaxing and then not regulating. Anything from 15 to 25% of the net gaming revenue paid on tax is probably the right number. And when you start going above that, the metrics start becoming a bit more complicated for lots of the operators.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
So this is the bull case. We heard from Eric Johnson of Cantor a little bit earlier this week. This is what it sounds like. Market's going to break out soon. Upcoming corporate buyback season, tax refund checks over the next 6 weeks. ISM turning higher, massive AI capex numbers we've all seen just announced. Throw in the payrolls report and it's going to happen, except this keeps happening. Keep bumping up against 7K. And the market cap weighted index, the S&P 500, just is struggling to break out. even with the decent data we saw in the ISM last week, even with the payrolls we saw in the last 24 hours?
There's some structural anxieties underneath this. There's, on one hand, the real economy, which we don't have a real handle on, and then there's, of course, how much AI is going to be adopted and just be disruptive to a whole host of different industries, and all of these anxieties are leading to a mush that is leaving everyone just kind of churning.
Feels constrained, doesn't it?
It does.
The fear, and I will say the fear and the anxiety that this just cascades through the financial system and then ultimately ends up in the sector you're in, so you hide where staples, which was ultimately what Julian Emmanuel Evercore communicated to us about an hour ago. He's basically making the point that a lot of people are just worried and looking for somewhere to hide. They don't want to be the next software, the next real estate, the next, where were we in the last 24 hours? Wealth managers. Yeah. Who's next? Which sector?
I keep going back to Christian Bitterly's poll. 60% relatively bullish, 20% very concerned about some of these disruptions, and 20% utterly confused. Pretty much sums it up.
It was easy when the Fed was just cutting interest rates and you piled into small caps and it all made sense.
This is so much more fun, though. I actually really enjoy the single name stories and how much things are changing.
Repricing the Federal Reserve in the last 24 hours. Under surveillance this morning, the Fed faces the data.
What today's jobs data showed you is that underlying economic growth is fine, but when I look forward, I see inflation coming down quite dramatically this year. So I view there's being a variety of reasons still why I would want to see lower interest rates. And while today's jobs data made me feel really good about the economy, I think the truth is that pushing out the supply side of the economy still allows for monetary policies to accommodate that.
So here's the latest this morning. The Federal Reserve facing a busy week of data on both sides of the central bank's mandate. The U.S. economy delivering a blowout payrolls report ahead of a fresh read on inflation with CPI due tomorrow. Stephen Rasciuto of Mizuho writing the first half of the year is seen benefiting from strong individual tax refunds, and the second half from last year's 75 basis point reduction in the funds rate. Steve joins us now for more. Stephen, welcome to the show. It's always good to catch up with you, sir. How much weight should we put on that payrolls report? Is it the real deal?
Well, I think when you back it up against the claims data that we've been seeing on a regular basis, I mean, ignore last week's numbers. When you look at where claims are, you look at where continuing claims are, and you look at the decline in the exhaustion rate, i.e. people falling off the continuing claims roll, you're seeing a healthier labor market environment, and you're seeing it actually picking up speed. You see a healthy labor market environment in the NFIB numbers. You saw some healthy data in the ISM numbers. I think, you have to look at all this data and say, well, why is it taking place the way it is? And I think the answer is because the economy is fundamentally healthy. And I think it is going to accelerate as we go forward into 2026. And I don't worry about the second half of the year, as I wrote in that little piece, because primarily we think the interest rate story comes up to really replace the tax cuts as the driver of the economy as we go into the second half of the year. Remember, in 2025, we had a real acceleration in growth in the second half of the year after a disappointing first half of the year, and the Fed was all worried about the first half growth decline, and that what they used to justify the rate cuts. But at the end of the day, the economy accelerated in the second half as a result of the rate cuts in 2024, and I think that continues to dominate again this year.
Well, Steve, I want to pick up on that point, the 12-month lag. What is the 12-month lag about? Because for someone just following financial markets, they might sit here and say, I might sit here and say, highly financialized economy, it goes through financial markets almost immediately, and you can feel the effect straight away. What takes 12 months?
It takes 12 months for people to reassess their situation, and we're really talking about a 6-month lag, which I think is the important piece of the equation, because there's usually this belief that monetary policy takes anywhere from 6 months to 18 months to be reflected in the economy, the long and variable lags that all Fed chairmen like to talk about. But the reality of the situation is those long and variable lags really depend on the underlying health of balance sheets. And I know you were talking before about the K-shaped economy and the adjustments taking place in the economy. But when you look at where the economy is and you go back, you're looking at 5 years ago, which was the COVID environment. And we're renormalizing to a pre-COVID environment, and that's what you're seeing in a lot of the data. When you look at things like delinquency rates relative to balances very low, so delinquency rates look high. But when you scale them by income or you scale them by GDP, suddenly delinquency rates don't look to be a problem. This is all the type of normalizing analysis that I think we've been doing relative to other people that I think is really, really driving the point that this economy a solid fundamental trajectory. And I disagree completely about the argument that we're going to get inflation coming down. We've been talking about inflation coming down from 3% for several years now, and it isn't happening. How long are we going to continue to wait for Godot? That's the real problem, because the Federal Reserve has to wake up and smell the roses that inflation is stuck at these levels.
We'll get to inflation in just a second. I'm just curious. I'm dealing with whiplash right now after David Tinsley was just telling us that the middle class is falling into the same type of affordability crisis as the lower income individuals in this country. How do you square that story with this idea that there is stimulus that is working its way through the system?
Well, I think you come around with the fact that the corporate stimulus came last year. The consumer stimulus comes this year. A lot of people are just now filing their tax returns. They're just now getting their refund distributions. We're on the real exponential rise in refund check distribution. So we expect to start seeing it showing up in the data in the next couple of weeks. With regard to the concept of the middle income households, you remember, you just went through the longest government shutdown in history. You went through a very, very cold winter, early winter environment. You went through the reciprocal tariff adjustments of last year. So seeing some disruptions get developed as a result of that is not surprising. It's where do we go forward that becomes the critical issue. The indicators that he's been looking at are basically indicators that tells you where we were, and not looking at, well, if the economy does get the cyclical boost we're expecting, if labor markets do get the cyclical, then guess what? You wind up reversing all those trends after being worried about them for so long.
Stephen, going back
and
to
the data is beginning to show that's happening.
Going back to the inflation point that you're making, the pushback that you're hearing across Wall Street, and Tiffany Wilding of PIMCO put this out there, that after a period of stubbornly high rental housing inflation, you're actually seeing the opposite, surprisingly low housing-related inflation, and this is being borne out in a whole host of different data. I'm just wondering, where is the inflation going to come from?
Well, you're going to see it in the good side. I mean, we honestly believe that the acceleration in growth in the economy is going to lead to a greater demand pull equation. We think we're going to see it in a lot of those factors that really lead to higher prices. A tighter labor market environment will lead to higher wages. Higher wages will help contribute to stronger demand. Stronger demand will contribute to higher prices in some of the areas where good prices have been declining. This is why CPI is an index. It's not one component. And this is the thing everyone keeps on forgetting about CPI. Remember, 2 years ago, it was all about, oh my God, you got to ignore the rising insurance rates that were driving CPI higher. The reality is you can't ignore rising insurance rates. You can't ignore all the other components. You have to look at the aggregate of the index. That's what really matters, is the aggregate, not all these individual components. You look at the number of components. I can always find something to hang my hat on to be bullish. Like, people looked at the payroll employment number, and they started doing some really apples to oranges comparisons in the birth-death model. The reality is it's the best data we have. Stop arguing with the data. The data is the data. Accept the data for what it is. Make your analysis off the data. Stop looking for arguments within the data to discredit the data.
Steve, don't stop. This was great. Steve, good to see you. I've got 20 seconds. Quick question. Next move, hike or a cut at the Federal Reserve?
Nothing. They do nothing for at least 12 months.
Steve Rasciuto of Mizuho. Steve, thank you, sir. 12 months on hold over at the Federal Reserve.
Love the data, hold the data, embrace the data,
The
own the
data
data.
is what it is.
The data just is the best thing that we've got, so stop arguing with it. It sounds very parental.
Preach.
Well,
Seriously.
come on, but preaching to deaf ears in terms of Wall Street right now.
Unchanged for 12 months at the Federal Reserve. It's another call, seen a few of them. It's not alone.
Yeah, a lot of people think that this doesn't give a justification to cut rates.
Coming up on the programme, Joe Amato of Neuberger Berman, Devin Ryan of Citizens, Matt Lazzetti of Deutsche Bank, George Bory of Allspring. The third hour of Bloomberg Surveillance. Up next.
A cidade estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me.
I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersetchi in Davos, Switzerland, and this is Bloomberg.
All of these trades right now are so sort of knife edge. Tech is a much more nuanced sector now.
If you look at places where we've outperformed, it's been the physical over the digital.
The tactical case for a continued bounce from here is pretty strong, I would say.
We think we're going to go back to a high-quality, large-cap trade.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P positive by a third of 1%. Call it a quarter on the NASDAQ. On the Russell, up by 0.6 in the bond market. Yields at the front end of the curve around 350 as we start to reprice this Federal Reserve. Going into more economic data later this morning. That data is 30 minutes away. Jobless claims follows a blowout jobs report.
Jobless claims take on more import right now because there were so many questions around the non-farm payrolls report. Yes, it was a very big number. It was a beat, 130,000 jobs created. Nonetheless, people looking at all of the things that Steve Rasciuto just told us to ignore and saying, hold on a second, can we really get confidence that there is a reacceleration in the U.S. labor market? The peripheral data will matter to confirm the story that people are telling.
Well, Steve's point is that the rate cuts we saw at the back end of last year are going to hit in the second half of this year. And that's where you'll see the growth. So for those of you that just think you get a one-off bump from the tax refunds, they're wrong in Steve's mind, because you'll get that bump also in the second half. That's why he's bullish the next 12 months.
The hard thing for me is that to speak in averages right now is so difficult, given that the circumstances for different cohorts of the economy, both on a company side and on a family side, is just so disparate that it's very difficult to understand which way overall averages are going to break.
Lots of disparity beneath those averages, and we can talk about the bifurcation elsewhere in just a moment. Futures positive by 1/3% on the S&P 500. Coming up this hour, Joe Amato of Neuberger Berman as markets search for direction, Devin Ryan of Citizens challenging the AI disruption narrative, and Matt Lazzetti of Deutsche Bank as Wall Street watches for the latest read on the labour market. We begin this hour with stocks steady near record levels. Neuberger Berman President Joe Amato writing, a mix of past and future stimulus, rising business confidence and improving loan growth set the stage for further equity gains. Joe joins us now from what? Joe, good morning.
Good morning. Good
Where are those equity gains coming from?
Well, you've seen this rotation. So the things that have been driving the market over the last couple of years have now switched over. So the broadening out theme that we've talked a lot about, we were probably early in that theme. It didn't play out necessarily fully last year, but you're seeing it this year. So while the market, as most people would describe it, the S&P is up just a little bit this year, you know, value's up 8%. Small cap stocks up 10, 12. You've got European stocks up. You've got Japan, the best performing market, major market in the country. So this rotation into things outside of what's worked over the last 2 years, I think is an important trend. And I think it's driven by accelerating growth in overall economic activity.
Equal upswing, or is there an AI disruption theme to all of this as well? Are these just better places to hide from getting smacked around the head one day by some update somewhere?
I think it's both. I think, yeah, we coming into this year, we did think that the nominal growth was going to increase, cumulative rate cuts, fiscal stimulus. So a number of those things have in fact played out. So you're seeing GDP growth, whether it was the second half of last year and going in the momentum continuing in the first quarter of this year. But at the same time, you have disruption. So, you know, AI has been sort of like a heat-seeking missile looking at different sectors in the equity markets. You know, first it was software, then it was private credit, then it's data service providers, this morning real estate companies. So, you know, that disruption, and I think we may have even talked about it last time I was on the show, which is this AI is going to be the most massive creative destruction process we've ever seen, and it's going to be happening faster than we've ever seen it. In the last number of weeks, we've seen it manifest in the markets, but it's hard to prove the negative about, you know, if you're a company that's still seeing good financial results, yet you have some vulnerability to AI disruption, you know, the market's just selling first and, you know, and then moving on.
You should trademark that analogy, a heat-seeking missile in terms of the AI trade, because it really just describes what's been going on in markets over the past couple of days. I'm curious, and we'll get to that heat-seeking missile in a second. I am curious, though, does that mean you see the cyclical part of the market as being maybe less sensitive to the economic data than other people do, because it is this dual type of trade?
It's a little bit of the revenge of the old economy. So you're seeing manufacturing pick up, some of the pressure, the areas that suffered from very modest growth over the course of the last couple of years are now seeing better growth, and they are vulnerable. You know, the automation trend going back 10 or 20 years ago put pressure on blue-collar jobs and a lot of pressure on those businesses, and professional services are now seeing the impact of that disruption.
So, from your perspective, do you avoid that heat-seeking missile, or do you follow it? Are you the ambulance chaser that goes in and tries to pick up the pieces after it's already done its thing?
I think we're more looking to sort through when everyone's throwing the baby out with the proverbial bathwater, you know, who may be more, you know, competitive in the context of whether it's a software company, whether it's a private credit entity or what have you. So I think the market overreacts to these things naturally. The pendulum always swings too far in both directions. And I think it presents some opportunities for intermediate to longer term investors.
Things are moving so quickly, so fast, and that's something you just mentioned, alluded to, and I think that's a major feature that we need to discuss. Typically, we embrace creative destruction in this country. It's a feature of American dynamism, or at least it used to be. Now it's moving so quickly, I just wonder how much constraint there will be down in a place like Washington, D.C., how much pushback we'll actually find.
Well, I think the manifestation of that's going to be in the labor market, and you've got these trends of stronger economic growth. A big chunk of the economic growth was AI infrastructure investment, right? So you saw good economic growth the second half of last year with virtually, you know, not zero job growth or very little job growth in the second half of last year. So, you know, I think there are going to be important public policy and political decisions to be made when some of this disruption starts to manifest itself in a tough labor market.
Does that influence how you think about investing over the long term through this cycle?
It does. I mean, you've got more volatility. I wrote about in a recent piece I did around, you know, just wider ranges of outcomes of policy you're seeing over the recent election periods. And I think that becomes more challenging for businesses to plan longer term. So we're seeing businesses themselves be shorter term in their thinking, because policy and regulatory issues may change. Think about, regulatory policies during the Biden administration, now in the Trump administration, was almost a 180. So that makes it harder, and that's, I think, contributed to the short-termism in markets, which is frustrating for us, because, again, we like to think longer term, maybe 1-3 year, 3 to 5 year type horizons. It's tough given the volatility in policy.
Does that potential overhang of regulation, of a policy prescription that could potentially constrain some of this tech development, also constrain the potential for big tech to really be the leadership in the equity space?
Well, I think regulation is coming to AI and tech in general. The more power that tech has in the economy, I think the more attraction they're going to get from politicians and consumers concerned about some of the excesses that could occur. So, the balance between federal regulation versus state regulation, for instance, in AI, is going to be an important determinant of how the U.S. remains a leader in AI, or whether it gets dragged down by a patchquilt of state regulation.
How much is this part of why Chinese technology, South Korean technology, Asian technology in general is getting bid up to a much more significant degree than U.S. technology right now?
I think those dynamics are going to come to every economy that you see disruption. So obviously the regulatory framework in China is going to be different than the U.S. But you are seeing the sort of China-dominated tech ecosystem and a Western and really U.S.-dominated tech ecosystem, and they're probably not going to interact much. But I think the dynamics affecting the labor market are going to be similar over the long term, and whether you're a Chinese regulator or whether you're a U.S. regulator, you have to deal with it.
Joe, where are you finding diversification at the moment?
Well, value, small cap, non-U.S. So that's really where we've been overweight, and that rotation has.
Can I just pick up on the non-U.S. piece of that? Lisa just talked about the gains we've seen in places like South Korea. Is it still just the same trade as U.S. tech, or is it different?
South Korea, Taiwan, these are very narrow markets, only a couple stocks driving the indices. So I would think a more broad-based market like Japan is more broadly investable to diversify from what, again, has been working over the last couple of years. We're not negative on the U.S., but it's just we think this rotation and the growth and the broadening out is going to be an important thing.
Is Japan working despite higher yields or because of higher yields?
I think Japan has shifted from a deflationary regime to an inflationary regime, which is a hugely important issue for equity markets. You combine that with constructive fiscal policy. We are certainly looking at the JGB market, because if that gets unhinged, that could derail this growth.
Is it unhinged?
But not yet. But probably most importantly in Japan is the emphasis on driving better shareholder returns and a focus on improving returns on equity for their companies, which has really been a secular trend that we've played for the last few years.
A big push since the Governor Kuroda days and Abe.
Yeah,
10 years
it's
or
really
so
a continuation of Abenomics.
Without a doubt. Joe, it's good to see you.
Yeah.
Thank you very much. Joe Amada there of Neuberger Berman, the president. Japanese equities up by 15%. It's close to that level year to date.
And guess what? Japanese bond yields have actually been falling. They fell some 10 basis points in the long end overnight. Why? Because people have more confidence in the idea of who is going to govern and how they're going to govern. And frankly, the Prime Minister has come out pushing back against some of the profligacy of fiscal spending plans in the past. So right now, actually, it is exactly the opposite of what people thought if she consolidated her majority.
Some better news out of Japan, let's put it that way. Elsewhere, stateside, equities out by 0.25% on the S&P 500. With an update on news worldwide with your Bloomberg Brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. AI company Anthropic nearing completion of a deal to raise more than $20 billion. Sources are telling us here at Bloomberg the funding round is co-led by investors including Peter Thiel's Founders Fund, D.E. Shaw and Dragoneer Investment Group. Anthropic is said to be valued at about $350 billion, and the announcement could come as early as this week. President Donald Trump says he told Israeli Prime Minister Benjamin Netanyahu that he intends to press ahead on talks with Iran. In a Truth Social post, Trump said nothing definitive was reached during their meeting in Washington, but he insists his preference is to reach a deal with Tehran. Netanyahu's office says the two leaders agreed to continue coordinating closely. New York's Waldorf Astoria is getting put up for sale. Sources tell us here at Bloomberg the Chinese owners are selling it only months after reopening following renovations. Real estate investment bank Eastdil Secured is expected to bring the hotel to market on behalf of the owners. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie. later this hour in about 30 minutes' time. Up next, the morning calls, plus Devin Ryan of Citizens pushing back on the AI disruption narrative. That conversation up next, live from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
If you look at the start of this bull market, the only 2 sectors that have outperformed the S&P 500 have been communication services and information technology, the place where the hyperscalers reside. We don't think the next really intense episode of rebalancing happens until the AI trade reaches a crescendo, which we think is still well off into the future.
Julian Emmanuel of Evercore weighing in on this equity market. I think Julian over at Evercore has a price target on the S&P of 77.50. And his argument is basically that if you want the index level to have another 10% of upside into year end, you need those names, those big tech players to participate, which is why he thinks the leadership will return at some point later this year, even if he does like other parts of the equity market as well. Speaking of the equity market, equity futures right now in the S&P 500, heading into data later, about 15 minutes away. Futures positive by 0.2% on the S&P, higher by 0.16% on the NASDAQ. There's that move in the Russell, the 2,000 up by 0.55%. In the bond market, yields just a little bit lower. We're down a basis point at the front end of the curve, 350 after repricing high yesterday, following much stronger than anticipated jobs data. That's the market setup. Let's get you some single names, some morning calls. First up, Citi raising its price target on Cisco to 90, citing multiple expansion for AI stocks. That name's getting hammered. We're down 7%. Your second call from JP Morgan, downgrading Kraft Heinz to underway, saying ongoing challenges could weigh on volumes through the year. That name is softer, lighter, lower by 1.5%. And finally, Piper Sandler reiterating its call on Newmark as overweight, saying even with AI fears driving a sell-off, its bull case is unchanged. Let's stick with AI. Wealth management firms struggling to recover from this week's sell-off. The Charles Schwab CEO, Rick Wurster, pushing back on the narrative that AI is bad for business.
For us, AI is a real accelerant. We're best positioned in the financial services industry to help clients with AI because of our size, our scale, the depth of our relationships, and all the data we have, which is a key ingredient to winning in AI. AI is a beneficial to our business, not a hindrance, and it's going to help us flourish and grow and serve clients in new ways and ultimately lead to the growth of the company.
Devin Ryan, the Director of FinTech Research at Citizens, believes the AI vigilantes are overreacting, writing, "This feels far more like evolution than mass disruption. What these headlines ultimately point to is a familiar pressure point, pricing." Devin joins us now for more. Devin, good morning.
Morning.
I could sense that Rick Wurster was slightly annoyed by the price action. I've noticed from other research notes that other analysts are too. I shared this quote a little bit earlier from another bank. The generalist money flows are responding to the rapid AI product rate of change dynamic, overwhelming the deeper thinking fundamental software sector specialists. That was about software in the last week. You're the deep thinker, the analyst that covers these single names. Do you feel like the tourists have arrived and taken over your sector?
That's what it seemed like earlier this week. AI is not a new theme, and it's something that I think is going to be a really big deal. So I think they got that part right, but in terms of it being a big negative, at least in the near term, I think is absolutely wrong. And when I kind of go backwards, I started covering this space over 20 years ago. There was 300,000 financial advisors. Today, there's about 300,000 financial advisors. So there's the same number of advisors, yet the number of assets is up 7x. So these advisors need tools. They need technology. They need ways to do more with their customers, drive efficiency, and be more productive. And AI is an area that I think a lot of these companies are already using behind the scenes to help drive productivity, drive efficiency, and we think that'll continue. But this is a non-commoditized financial service. Fees are opaque, and it's going to take a long time to really disrupt this industry.
Well, let's keep it going. So we've seen this cascade from industry to industry, wave after wave, over the last week or so. What's the biggest thing that people are getting wrong?
Well, I just think that near term there's any impact. I actually think that it's the opposite. Like, these companies are going to make more money, not less money, using AI, and that's what they're getting wrong. I think people are just going to the lowest common denominator of AI disrupts everything, so therefore bad. And I think it's right that AI is going to change this industry over the next 10 years, 20 years, where people are going to have to use these tools, and there will be more automated advice, just like 10 years ago, 20 years ago, the robo-advisors were coming for wealth managers, and we saw zero fee compression from that. What it did is lower the bar for people to get access. And I think that's what AI will enable advisors to do, cover more clients, cover more assets, and really just have the tools that they need to have that personal relationship, which I think the personal relationship is what people are willing to pay for.
You used the word commoditized, and you talked about how fees are still pretty opaque and that there's a sense that that is going to be difficult to really erode into. Isn't there a demand in an increasingly commoditized world to have more transparency, to drive down those fees, especially if there is an increasing amount of the job that can be done with a computer program?
Yeah, the way I think about, Lisa, is that every person has different needs. So if you're covering a couple hundred clients as a financial advisor, each one of your clients has different goals, different family situation, and so what you're charging them for is different for each client. You maybe have different fee structures on different clients based on what you're doing for them, and so therefore it doesn't lend itself. These aren't fees that are put up on a billboard. They'll cover the retail brokers when they went from $9.99 to $4.99 to $0, because everybody's competing on this commoditized service. When you're working with families, you're working for their goals, for their complex lives, it's less about the fee, and it's more about the relationship and the trust and what you can do for them. So again, these are things, people are going to work with their advisors. At some point, things may change, but it's to me, this is like decades, whereas there's a lot of other areas within financial services that are going to change faster as we go to this kind of lowest common denominator.
But I guess doesn't this point to the fear that people have in the wealth management unit, but also the optimism that people have elsewhere, that if you have a greater degree of transparency, and you have a greater degree of desire for data that can then be plugged into different programs that can be far smarter than I can about exactly compiling it and giving you a narrative, it's going to cause a much faster pace of evolution that's going to really compress some of these profit margins dramatically in a way that previous technological shifts just haven't done.
Yeah. Well, I think at the financial service level, the highest level, that is true. But you have to go through business by business. So in wealth, where you're dealing with people and you have a person involved in that, the technology itself is going to do more. It's going to provide better advice in some cases. It's going to allow advisors or without an advisor to really lower the bar for people to get access to all different types of asset and liability strategies that were reserved for family offices and the highest net worth. And I think that's going to change. But advisors are going to be able to use these tools to do more with their customers. That's on the revenue side. Think about the expense side, the back offices and all the areas of expenses these firms have where AI is already call centers and it's automating tasks that you had a lot of people doing. And we've already been seeing that. So my point is, this isn't a new concept. These companies, the largest wealth managers, Schwab, Morgan Stanley, Raymond James, they've been working on this for years. So this isn't a new concept.
Are they going to employ a lot fewer people?
So I think that over time there will be fewer people, and I think that what the technology is doing will essentially automate a lot of jobs that people have. So I think that's where you get mass efficiencies, and it really also just repositions people. So advisors, for example, a lot of advisors' jobs over time have been the manual tasks, things they don't like to do. You know, it's order entry, it is back office that even the advisor's doing. This is going to enable them to go out, get more clients, do more with their existing clients, spend more time with them, where they can. People want to pay for that personal relationship. They want the concierge. And not everybody's going to want to pay for that. And they get the all-digital experience. And they already have that today. AI will enable that. But on the full service, if you want the concierge, I think people are willing to pay a small fee for that non-commoditized relationship.
If all of these companies are employing fewer people, where does the asset growth come from?
So asset growth comes from, I mean, I guess the question is, do assets appreciate? So you go back to, I started covering the space in the early 2000s, and markets are up 7x.
But they're not managing markets, they're managing people, aren't they? And people's wealth.
They're managing people's wealth, but there's an inflationary aspect to people's wealth. And also, if you go back 10, 20 years, it was about stock picking, right? Advisors were picking stocks, helping them beat the benchmark. Today, it's about all your financial, your assets, your liabilities, how many kids you have going to college, when are you trying to retire by? And that's the whole point. This is not, you put it into a cookie cutter box and you get an outcome. It's everybody, you have family members sick. And so you have a lot of things that are constantly happening where people have their advisor that they've gone through a lot with. And, again, the next generation may change it. This big generational transfer of tens of trillions of dollars, that's going to potentially be different. That's happening over the next 3 decades. So for the next couple of decades, as long as the people are alive that have the money today and they have their trust relationship, there's a high switching cost to exiting your advisor relationship.
Forgive me for taking this to the extreme, but I think it's something we've got to think about over the long term. If fewer and fewer people are holding the assets because fewer and fewer people are being employed by these industries, isn't the government coming after a slice of all of this?
That's a whole other question, John. I mean, is the government going to look to put higher taxes on or some other type of excise, if you will, potentially in the future? But based on where we are right now, I think that this is an industry where technology is actually needed. And you would say, it's slow moving because, like I said, there's 300,000 advisors today than there were 20 years ago. But technology is going to improve the process for advisors and I think their customers, and ultimately lead to better financial outcomes too. So I think the good news is, to Lisa's point, you're going to get better advice, and you're going to get better products, and ultimately advisors are going to have to do more to earn the fee that they get today.
Devin Smart. It's great to get the pushback. Appreciate it. Thank you, sir. Thank you very much. Devin Ryan there of Citizens, pushing back against some of the disruption we've seen in that sector over the past few days.
You brought up government regulation. I found a particular press release that came out earlier this morning, absolutely fascinating. Anthropic coming out saying that they're donating $20 million to Public First Action, talking about how some 69% of Americans think the government is not doing enough to regulate the uses of AI. We agree. It's being adopted very quickly. You need to get on the ball and actually create regulation. So pause. A company that right now is raising billions upon billions of dollars to create AI programs that are going to potentially disrupt millions of jobs is coming out and saying to the government, please regulate us. Please explain.
What's it say at the top of the statement?
Try Claude.
There you go.
But it just it highlights, how big of a concern this is. Is this a PR move? Is this trying to get ahead of the regulation to try to influence it? Is it something to stay in the public imagination as that heat-seeking missile, as Joe Amato said, continues to go after each industry? These are the questions that this really raises, but it's fascinating that they put this out especially today.
The change is real. I'm not here to push back against that. The change is real. I don't think anyone should be naive. I do think, though, you should be eyes wide open about what's happening here. This is the roadshow for the IPO. These companies are raising a tremendous amount of money over the next 12 months. Don't wait for the opening bell. This is the roadshow. It's happening. A lot of this is marketing. Some of it's real, but a lot of it is marketing.
I'm just trying Claude, sorry. Don't mind me.
See, there you go.
I'm over here.
Breaking jobless claims up next. Matt Lazzetti will break it down over at Deutsche Bank. He's here to react from New York City. You're watching Bloomberg TV.
know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Live from New York City, welcome back to the program. 60 minutes away from the opening bell, seconds away from some economic data. The scores look like this going into jobless claims. Equities firmer by 0.25% on the S&P, on the Nasdaq up by 0.2%, on the Russell 2000, the small caps higher by 0.7%. In the bond market, yields repricing higher in yesterday's session following stronger than expected payrolls. This morning lower by a basis point at the front end, down by almost 3 at the very long end of the curve. 30s down to 477.89. Here's the jobless claims number, and it stays somewhat elevated relative to the previous week. 227, that is the wrong kind of upside surprise, just on the margin. Our median estimate was 223 here at Bloomberg, and the continuing claims slightly higher as well. So jobless claims coming in at 227,000. The survey was for 223, and the previous number, a revised 232. So yields stay just a little bit lower, down a basis point at the front end, and down by a little more than 2 at the very long end of the curve.
Yeah, continuing claims popped up to the highest going back about a month. So that's what some people are going to be watching to get a sense of just how much people are taking a longer time getting a job. Look, this just goes to the inconclusivity of what we got yesterday. If it was such a rip-roaring labor market, why are initial jobless claims ticking up just ever so slightly week after week?
Levels versus change. Levels, the 4-week average of around 220 is not a big problem in any way, shape or form. If you look across history, 220 is a pretty low number for jobless claims, but I'm with you, change. It has crept higher over the past few weeks, and when you compare it to the blowout payrolls report yesterday, this is why some people are poking holes in a bull case for the U.S. economy.
And if you take a look at the revisions for the prior month, you can see that that actually was revised upward just a touch, nothing dramatic. Again, we're not raising a red flag or saying that the world's on fire. 232,000 versus 231. Nonetheless, there is a confirmation here that things are not completely rosy, which is the reason why people are saying, look, you might get some stability, but it isn't exactly a runaway labor market that's going to speak to acceleration and growth.
To weigh in on all of this, Enda Curran down in Washington, D.C. to break down the data. Enda, as Lisa pointed out, there's no big fireworks, no drama here. What stands out for you?
Maybe a little bit of a reality check, Jonathan. As you mentioned, it was expected to stabilize this reading, but it's come in a little bit above expectations. And the previous month being revised up as well suggests that, you know, the labour market softness story hasn't gone away despite yesterday's bumper number. So I would say something of a reality check. And also, by the way, I think in the wake of yesterday's numbers, there's been more focus as the day went on the revisions. Yes, the January number was strong, but the revisions for the totality of last year, as we now know, mean it was the worst hiring year outside of a recession since 2003. So that puts a lot of question marks on, is January signaling a turning point? Are we turning a corner in the labour market, that stabilisation story, or is it going to be something of a blip that will ultimately be revised back? And when you get to jobless claims this morning, as you say, they're not a game changer in and of themselves, but it's probably a reminder that the soft labour market story hasn't totally gone away.
Governor Myron responded to the strong jobs data yesterday, and he made the point that, yes, that's strong, but the reason I want to cut interest rates is because what I think is going to happen with inflation. That takes us to CPI tomorrow morning. Are you expecting to see more signs of disinflation building in this economy?
I think that's the broad expectation. I mean, Governor Myron has certainly been, a bit of an outlier, as you know, John. He's been calling for deeper rate cuts, and he's putting a lot on the fact that rental inflation will come off much faster, and he sees much faster disinflation than others do. But the inflation story tomorrow is expected to be somewhat intact. But I think there's no immediate, or at least Fed watchers don't see any immediate change on the horizon for Fed policy near term. Rates seem to be on hold. Policymakers are signaling they're comfortable with where rates are at the moment. And I think over the coming months, we're very much going to be on a wait and see, especially on the labour market front.
Enda, good to see you. Enda Curran down in Washington, D.C. We'll catch up with Enda again tomorrow when we get inflation data, 8:30 tomorrow morning. If you're just joining us, welcome. Upside surprise, as we often say with claims, the wrong kind of upside surprise, 227. The estimate in our survey, 223. That's down just a little bit from a revised 232 for the previous week. With us around the table, Matt Lazzetti of Deutsche Bank. Matt, welcome to the programme. I'm going to start with a bit of jargon. You're going to translate. What is residual seasonality? What is that? That phrase gets thrown around on Wall Street. What does that mean?
I love starting with residual seasonality on 8:30. So, we get data that comes in and it's non-seasonally adjusted. The government agencies go through this process of seasonally adjusting it. And essentially you're trying to take out the typical seasonal patterns that you would have throughout the year. They're not able to do that perfectly. And so what you tend to see in some of these data is in different parts of the year, you have stronger data or weaker data. Over the past several years, you've seen stronger inflation data to start the year. I would add that you've actually seen stronger labor market data to start the year as well. So the upside surprise we got yesterday, we had gotten upside surprises in prior years as well. From my perspective, and I think if you translate this for the Fed, they should not get overly excited about a month or two of very strong data. They should also not get overly depressed or pessimistic about a month or two of very weak data, as you saw in the back half of last year.
So if I want a clean read, forgive me, to get a clean read on the labour market, where do I go?
That's certainly a difficulty. I think you want to be smoothing through over longer time periods. So inflation, I think there's all this focus on 3-month annualized changes. I think that's not the right measure that you want to be looking at. I think the year-over-year rate, it smooths through all the seasonal differences that we get. And so therefore, it's giving you a little bit of a better read of underlying trends in the inflation data.
And what does that say? I mean, in terms of just how much you get job growth that does stabilize at the same time that you get inflation that's starting to come down. I mean, is that picture confirmed when you smooth out the data? You take the crystal ball, you shake it up, you put a little patina on it. Yeah. Is that what you get?
Yeah, I want to paint a little bit of a brighter picture of the labor market data than I think we were just presenting. I think as you look at jobless claims, I think it's pretty clear that the weather has impacted those over the past 2 weeks. So last week, initial jobless claims, half of the rise was in New York, New Jersey, Pennsylvania. I think we could all relate to that being in this area, the snow that we've had. Half of the rise in continuing claims this morning, which is a week delayed, was also driven by those 3 states. So I think we're still working through some weather effects. I think as you broadly look at the labor market at this point in time, the unemployment rate has come back down to 4.3%. The quits rate, which is a very good measure of labor market slack, has basically been unchanged over the past 12 or 18 months. You have a layoff rate, which remains well below where it was before the pandemic. So you still have this somewhat uncomfortable environment of low hiring and low firing, but it's a labor market that's been pretty stable over the past 12 months.
So where is the hiring coming from, and is it good enough to sustain this? And I ask this given the fact that we're talking about wealth management potentially laying people off or not hiring people because of artificial intelligence, the fact that we've seen that roll through the tech sector. We're seeing that sort of sector by sector. How much do you start seeing that with wage pressure that really doesn't speak to this consumption boom and real acceleration backdrop that so many people are talking about?
I think that's one of the holes that people might poke in yesterday's jobs report. So you had 170,000 or so jobs added in the private sector, about 130,000 coming from education and healthcare workers. That's been the trend. You have this outside support coming from this particular sector. But I would actually add the diffusion index, which measures kind of more broadly where are we getting jobs from, picked up to a 2-year high. You saw goods producing industries actually add the most since mid-2023 yesterday. Manufacturing picked up, construction picked up. So there was some early evidence that maybe there's a broadening out of job gains that are taking place. On AI specifically, I think there's been a lot of focus on the younger age groups, that 20 to 24 age group, particularly those that are college educated. I think really importantly in the data yesterday, you saw the 20 to 24 unemployment rate. It's down 2 percentage points over the past several months. It basically hasn't risen over the past 6 or 12 months. So that was a positive development, I think, from yesterday.
You mentioned the improving breadth outside of just healthcare. Are you seeing data elsewhere that corresponds with that supports it?
I think when you look at the ISM Manufacturing Index as an example, that has shown some strength as of late. Some of the survey-based indicators have looked a little bit better, but look, it's all tentative. You don't want to kind of ring the all clear signal here for the Fed. I think for the Fed, as we look over the next several months, Yesterday's report, I think, for me, was strong enough where it says, now if you get 1 week jobs report, that's not sufficient for them to cut rates.
The bar's higher.
The bar is now higher as you look ahead, and the market responded with that by taking out rate cuts over the next 2 meetings. The market's still building in this big premium when Kevin Warsh comes in as the Fed chair in June, that all of a sudden he's going to start cutting rates at that point.
Do you think he will?
No.
Why?
I think there's two things that are ongoing here. One is the reaction function of the committee, and the reaction function may be somewhat more dovish for the new Fed chair, but he's coming into a committee that at this point sees very good reasons, I think, to keep rates on hold. The second part of this will just be the data. The Fed has to be responding to the incoming data, and I think as you get evidence that the labor market is stabilized over the next several months, and with inflation, core PCE, which is what they're targeting, probably remaining between 2.75 and 3%, it's pretty clear from their dual mandate objectives. They're missing very clearly on one, but the labor market looks much closer on the other.
I'm thinking of what we hear, but, what about the other side of the mandate? Maybe they're not missing just as much as they have been expecting, given the fact that you see rents coming down in a significant way. McDonald's is cutting prices for value meals. Pepsi is cutting prices in order to bring in more customers. I mean, isn't there a potential disinflationary rush that we could see as early as tomorrow that could potentially give credence to some of the doves on the committee?
I think as you look ahead, there is a potential disinflationary trend that's in place. I think shelter will be key to that. One of the surprises in the last CPI print was actually that shelter and owner's equivalent rent bounced back more strongly than anticipated. So we'll have to see whether or not that continues tomorrow. I think bigger picture, we are expecting disinflation. Shelter is part of that. Core goods inflation, I think, should be part of that as well. We think tariff rates are going to come down over the course of this year, continue to come down. But the Fed has missed their inflation target by a wide margin for now 5 years. And the labor market is very close to what they think full employment is at this point in time. With that context, I think it makes a lot of sense to them be cautious about adjusting policy lower.
And yet they cut 3 times at the end of last year. And Steve Rasciuto of Missouri was on the program earlier suggesting that in 6 months, that will lead to another economic pickup. What's your thought on the long and variable lags? Just how long are they? How variable are they?
Yeah, I think the analysis that's done there, and for the U.S. Monetary Policy Forum, we did some work on this last year. Those long and variable lags that Milton Friedman talked about, we're kind of in year-over-year data and the cumulative effect over time. Yes, they might peak in about 18 months. When you look at the impact on quarterly data, it's pretty short. So it tends to happen over the first or second quarter. I think as you look at financial conditions today, the Fed's own metrics tell you that financial conditions are adding a percentage point to growth over the next year. That's the easiest that they've been since 2022 before they started raising rates. You have fiscal policy, which becomes more supportive over the course of this year. People worried about AI CapEx might be coming down. We're getting upside surprises from those companies there. So yes, I think the economy has a lot of support at this point.
We've seen a series of upside surprises there over the last week. Matt, it's good to see you. Thank you,
good
sir.
To see you.
A clinic, as always, Matt Lazzetti there of Deutsche Bank. Equity session highs were up by 0.4% on the S&P 500, within striking distance, not too far away from all-time highs on the S&P. With an update on stories elsewhere this morning with your Bloomberg Brief, let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Recapping the data we just got, jobless claims coming in at 227,000. That's just an edge above estimates called for 223,000. It's a slight tick down from the previous week that saw claims revised to 232,000. Continuing claims also remaining elevated, coming in at 1.86 million. That's more than what estimates had called for. Nuveen is buying Schroders for about $13.5 billion. The acquisition is creating one of the world's largest active asset managers with nearly $2.5 trillion of assets. It ends more than 2 centuries of independence for the UK's largest standalone asset manager, although the Schroders brand will be retained. Morgan Stanley CEO Ted Pick getting a big raise. The company boosting his pay by 32% for 2025 to $45 million after the record year for the firm. Morgan Stanley shares surged more than 40% last year, far surpassing the performance of the S&P 500. And that is your Bloomberg Brief. John.
Not bad, Ted.